The Investment Trusts Handbook, 2025, Investing Essentials, Expert Insights and Powerful Trends and Data, edited by Jonathan Davies, read by Gareth, Authorised Voice Replica. Please note that this audiobook is an edited version of the full book. Some content has been removed as it is not suitable for audio format. The full contents, including the tables and charts mentioned in this audiobook, are available in the free ebook, which is available to download via all major ebook channels and directly via Harriman House. Editor's Introduction, by Jonathan Davies. The good news first. Let's start with the good news. In the 12 months, give or take, that have elapsed since I wrote these notes in the last edition of the Investment Trusts Handbook, the great majority of listed investments have made good money for shareholders. No fewer than 80% of the 300-odd investment companies, excluding VCTs that I track, have produced positive share price. Total returns since the end of September 2023. On a NAV total return basis, the figure is even higher. The return on the Investment Trust Index, which includes some 180 of the trusts that are included in the FTSE All-Share Index, and is therefore a reasonable proxy of the overall performance of the investment trust sector, has been 11.5%. Given that the Consumer Price Index rose less than 2% over the same period, that represents an excellent real or inflation-adjusted return. These are welcome numbers and bear out my comment. A year ago, that the large discounts which had opened up since the start of 2022 were creating once-in-a-generation opportunities that are too good to miss. I also quoted Nick Greenwood, the manager of MIGO Opportunities, saying, "We are likely to look back at the autumn of 2023 as the perfect time to invest in investment trusts." So indeed it has proved. By chance, the turnaround in sentiment towards the investment trust sector happened almost to the day on the date I signed off these notes a year ago. You can see most clearly in the way that the average rating across the sector suddenly changed. At one point in October it was just over 19%, the widest it has been since the depths of the global financial crisis in 2008 and the brief COVID pandemic sell-off in 2020. By the end of the year, the average discount had moved into 13.2%, which can be compared to 11.5% at end of 2018, 2022, and just 2.3% at end of 2021. A combination of strong equity market performance, the first interest rate cuts for 4 years, and those narrowing discounts have all contributed to the positive performance of investment trusts this past year. The numbers give hope that we have finally turned the corner after the painful and seemingly never-ending derating that began in early 2022, as higher inflation and interest rates slowly and steadily sucked money out of the sector, making it a disappointing and challenging experience for trust shareholders. Still some clouds. The renewed sense of optimism is justified, but it has to be acknowledged that the recovery is not yet complete, and there are still a few clouds on the horizon. Inflation may appear to have been tamed, but against a backcloth of richly valued equity markets, rising government indebtedness and intensifying geopolitical challenges that include ongoing wars in both Ukraine and the Middle East, the scope for setbacks in global financial markets remains high. At the same time, there are aspects of the investment trust experience that still need to be resolved. There has been no new investment trust launch of any size for 3 years. Instead, the sector has been shrinking fast, with a series of mergers, sales and liquidations that shows no signs of slowing. The re-rating of the universe that started so promisingly in the last quarter of 2023 has ground to a halt since. The average discount as I write this year is actually higher today than it was at the start of the year. Only one subsector in the trust universe, and a very small one at that, is trading at a premium today. What that means is that while the absolute returns investment trusts have delivered over the past year have indeed been positive, and in some cases extremely good, they have not been as good as you would normally expect, at least in relative terms. Year to date, in particular, the share price performance of the Investment Trust Index, excluding dividends, has lagged the FTSE All-Share Index by 4%, the FTSE All-World Index by 7%, and the S&P 500 by 9%. There is plenty of catching up, in other words, still to be done. It is disappointing that it has not happened yet, but equally an opportunity for investors in the future. What is not in doubt is that investment trusts are once again demonstrating, as they have throughout their history, that their ability to change and adapt to changing circumstances remains one of their greatest strengths. In the past, boards of trusts have sometimes rightly been criticised for erring on the side of complacency, but the clear message from this year's news cycle is that the great majority of directors are very much aware that their primary concern is, as it should be, putting the interests of shareholders first. Prodded and prompted in some cases by activist shareholders, they have been busy driving a process of necessary change and consolidation that in true Darwinian style is set to leave the sector much leaner and fitter in the future. There are plenty of examples already, as is noted by our expert contributors in the pages that follow, and yet nobody I have spoken to in the industry doubts that the process has further to run. Some participants think that the number of surviving trusts could fall by as much as a third by the time we are done. I suspect that is an exaggeration, but in a period when passive funds and so-called LTFs, long-term asset funds, will continue to provide low-cost competitive alternatives, the investment trust sector certainly needs to refocus on the things that it does best if it is to return to its historical record of outperforming other types of fund. That means using to their full extent the structural advantages that investment companies enjoy: access to patient capital, the ability to gear, stronger corporate governance, low and falling fees. More specifically, it also means taking action where appropriate to reduce discounts, another recurrent theme in this year's edition. While some large trusts, such as Scottish Mortgage, Smithson, Finsbury Growth and Income, Pantheon International, have made exceptional efforts to reduce their share count with share buybacks this year, contributing to a record total for the industry, others have been more reticent. To be fair, the evidence that share buybacks immediately help to reduce discounts is not clear-cut. They do reduce supply at times when demand is weak, but it can take time for the market to react. A study by the brokers Peel Hunt earlier this year suggested that even if they fail to narrow discounts, buybacks do at least reduce discount volatility. Regular or performance-triggered redemption opportunities, which are offered by an increasing number of trusts, and have also been a notable feature this year, may in some cases be a more effective way to rebalance supply and demand. The ultimate option for boards of underperforming trusts is to shut down their trust in one form or another, whether that be by merging with another stronger trust, selling all the assets, or simply going into a voluntary wind-up. A record number of trusts have adopted this route in the last 2 years. It is sad to see them go, but it offers convincing evidence that the sector can still put its house in order. The contrast with open-ended funds, where in the absence of independent boards, historically poor performers can linger around for years as there is no incentive on the managers to give up the fees they continue to earn, is marked, although the FCA's new consumer duty rules are finally having an impact in forcing rationalisation there too. The upside for shareholders is that boards throwing in the towel can lead to helpful gains on realisation. Shareholders in the commercial property sector, for example, where there has been a flurry of bids and other corporate activity, have typically made good gains from where the share price was before exit deals were announced, even if they typically have taken place at a 5 and 10% discount to the reported net asset value, or NAV. Eliminating the weakest players leaves the sector overall stronger and more resilient. In the handbook this year, as regular readers will know, the Investment Trusts Handbook is an independent editorial publication in which we look to pull together all the most important developments of the past 12 months into a single, handy reference volume on its way, or so I always cheekily claim, to becoming recognised as the wisdom of the investment trust world. This is the 8th annual edition, and I'm happy to say that it appears to be as popular as ever. The handbook has been bought or downloaded tens of thousands of times, and we remain grateful for your continued support. The 2025 edition follows a now familiar pattern. A detailed review of the last 12 months by our resident experts, covering a range of themes, a look ahead to a still uncertain future and what it may bring. Q&As, profiles and other conversations with analysts and fund managers. My own thoughts on the year just gone and the one that lies ahead. Summaries of medium and longer term trust performance. And a detailed how-to/data section at the end of the book, completely revised and updated. Many readers of the handbook continue to listen to the free Moneymakers Investment Trust podcast, our regular weekly conversations with experts from the investment trust world, which I am proud to say this year won me the award for Best Broadcaster in the AIC's annual Media Awards. Over the past 4.5 years, we have clocked up more than 230 episodes, and listener numbers continue to rise. Hundreds of you also subscribe to the Moneymakers Circle, a subscription newsletter which, for a modest monthly or annual fee, gives you access to a range of premium content that is particularly relevant to an investment trust investor. These include in-depth profiles of more than 160 trusts, weekly summaries of the latest results and market movements, and commentary by myself and others on the latest news. Our promise to subscribers is that you won't miss anything important that has been announced or happened in the investment trust sector. My thanks again to the many readers who have come up to introduce themselves to me at events, including the AIC's annual Investment Trust Showcase event, the annual Master Investor Show, and JP Morgan's new annual Private Investor event. You can find out more about both the podcast and the newsletter from the Moneymakers website, www.moneymakers.co. I also want to thank the investment trust partners whose support enables us to offer a free PDF version of the handbook to anyone who wants one. Providing an educational resource to spread the word about the pros and cons of investing in investment trusts is a central part of our mission. Performance in context. As in previous years, I'm including a few charts here to illustrate the general background to the last year's investment trust performance. The first exhibit is an updated version of the simple 5-year asset class chart which I showed last year. While the UK equity market has finally started to outperform inflation, it lags well behind the all-world index and even more behind the US equity market, which has powered ahead again on AI-related excitement. The figures in the table below the chart are annualized rates of return over different periods. See tables and charts in the free ebook, 5-year asset class performance. Gilts, on the other hand, while they have stemmed the dramatic loss of value experienced during the inflation spike of 2021 to 2022, have made only a modest recovery. The Bank of England announced its first interest rate cut over the summer, but uncertainty about the tax and spending plans of the new Labour government, faced as it is with a mounting debt burden, has so far failed to trigger a new bull market in government bonds. With interest rates still around 4% at the time of writing, they continue to pose a particular challenge for investment trusts, as the correlation between interest rates and trust discounts remains high. You can see that from the next chart, reproduced courtesy of the brokers at Winterflood Securities. Correlation does not of course mean causation, as statisticians regularly remind us, but nobody disputes that there is a close relationship between the two, and investors certainly believe it to be the case. See tables and charts in the free ebook, Sector Average Discount versus Gilt Yields, since 2021. As the third chart shows, however, it is important to differentiate between the impact on conventional equity trusts and on alternative asset trusts. The former have seen discounts stabilise or improve this year, and derated much less than the latter, which have moved from what was often a premium in the post-GFC period to mostly stubborn double-digit discounts today. See tables and charts in the free ebook, Relative Discounts, Equity Funds versus Alternative Assets. There are specific factors that explain why alternatives have suffered more than conventional equity trusts. One is that most of the alternative asset classes that have spawned new investment trusts are valued mainly for their ability to generate consistent, above-inflation returns. When interest rates were close to zero, their 5 to 10% yields were hugely attractive to savers. Now that interest rates are much higher, a lot of savers' money has been diverted back to cash and bonds. A second factor is that in many cases the attractive higher returns that alternative asset trusts offered were only achieved with the help of gearing, meaning debt. That debt has now become more expensive and burdensome, while at the same time the ability of alternative trusts to raise new amounts of equity to strengthen their balance sheets and fund new projects has effectively disappeared, because discounts have closed the option of issuing new shares. The third factor at play relates to valuations. By definition, because they deal in illiquid assets, the reported net asset values of most alternative asset trusts are based to varying degrees on a combination of historic data and forward-looking models, in which the assumptions chosen, notably on inflation, interest rates and future revenue growth, can make a big difference to the outcome. It is a valid question to ask how fair and realistic they are at any one point in time. There is an inevitable subjective element to them. It may be that the wide reported discounts you see quoted simply reflect the fact that the NAVs are wrong, or that shareholders at least don't believe the NAVs. Trusts in private equity, which is in one of its periodic down cycles, commercial property and infrastructure have all therefore faced a challenge as their prospects for future growth have become constrained. To survive and grow, they need to restore trust in their business models and current valuations. In practice, that means choosing between a complex menu of options, selling assets to prove valuations, paying down debt, buying back their own shares, cutting dividends, or, in the extreme case, shutting up shop. The trend towards clearly articulating a capital allocation policy, which an increasing number of boards have adopted, is a healthy development that should in time help to bring in discounts here as well. Cost disclosure rumbles on. If qualified optimism has been the hallmark of the year, it has nowhere been more evident than in the saga of cost disclosure regulations that has rumbled on for getting on for 3 years now. As Ben Conway explains, see page 97, the industry has campaigned long and hard for reform of the legacy European fund regulations, which uniquely penalise investment trusts by forcing them to double count the costs they are forced to disclose in standard pre-sale documents for investors. In September this year, after a coordinated effort involving intensive lobbying of Parliament by a well-organised campaign group drawn from all sides of the investment trust world, the Treasury announced that investment trusts would temporarily be relieved of the duty to report their double-counted costs in this way, pending the introduction of a new UK-specific regulatory regime by the Financial Conduct Authority in 2025. It was greeted as a famous victory by fund managers, boards, analysts, and shareholder groups alike. Unfortunately, as far as private investors are concerned, this moment of triumph turned out to be quite short-lived when it quickly transpired that most investment platforms, including Hargreaves Lansdown and AJ Bell, the two largest holders of trusts on behalf of private investors, insisted that investment companies continue to use the older, higher figure that was required under previous regulations. They blamed both the technical challenge of adapting to the new set of circumstances and the requirements of Consumer Duty, another recent set of rules introduced by the FCA that apply to all types of fund, investment trusts included. Given how important these platforms are for private investors, at the time of writing none of the larger fund management firms, even if they publish their own figures on the new basis, have so far felt able to challenge the platform's interpretation and write lower cost figures into the data template they are obliged to send to the platforms. The risk for them if they don't comply is that the platforms will simply de-platform their investment trusts, making it possible for private investors to sell their shares in future, but not to buy them anymore. The stalemate has left the industry in a partial limbo that will take some time to resolve and means it is too soon to declare final victory in this long-running debate. Cost disclosure is a complicated and nuanced issue that would take more space than I have to explain in full. One underlying problem is that regulators are understandably keen to see a uniform system of disclosure that applies to all types of fund, enabling consumers to make like-for-like cost of ownership comparisons between investment trusts, open-ended funds, tracker funds, and so on. That, however, is much easier to achieve for conventional equity trusts than it is for other types of investment company, including private equity, commercial property and infrastructure, which are different in kind and are more akin to operating companies than they are to pure investment funds. This produces absurdities. Tritax Big Box, a commercial property investment trust, reports an ongoing cost figure of more than 2%, while Saggar, which is essentially in exactly the same business but categorized as a REIT, not an investment company, is not required to publish an ongoing charge figure at all. Similarly, a trust like Murray International, which has made an attempt to deal with the issue by publishing its own statement of operating costs drawn from its report and accounts, continues to display an ongoing charge ratio of 0.7% on the HL platform, 0.2% higher than the more accurate figure it now quotes in its own fact sheet and other literature. Tritax Big Box continues to show an OCF of 2.1% on the platform, even though the just-announced Treasury statutory instrument allows it to report a figure of 0% should it choose to do so. All the relevant data that investors need to determine the true cost of owning a trust is set out in the report and accounts, so you might wonder what the fuss is really all about. The answer is that for alternative asset trusts, which may be forced to quote unrealistic figures as high as 5% under the regulations, it matters a lot. Wealth managers don't like being forced to quote those inflated figures in their reports to clients and so avoid investing where they are required. Private investors who compare costs of different types of fund on platforms are also disadvantaged when a calculation ostensibly designed to help them make better choices actually misleads them. The whole thing is a mess, and the sooner it is resolved, the better. It is fair to say that nobody knows for sure how far the old rules have actually damaged the investment trust sector. Feelings run high on the issue, however, as you will see from many of the comments in the pages that follow. With luck, by the time the next edition of the handbook comes round, common sense will have produced a solution, and investment trusts, alternatives and conventional equity trusts alike, can finally live in a regulatory regime that is both fair and transparent to everyone. Personal highlights. As I have noted already, the arguments for optimism that I made a year ago have been largely borne out since. Looking through my own portfolio, it has been encouraging to see the additions I made a year ago, reflecting my belief that the investment trust derating cycle had finally turned, have all mostly prospered. The biggest disappointments have been in the alternative asset trusts I own, which have continued to pay out handsome inflation-beating dividends but mostly failed to re-rate as I was hoping. The share prices are down 10% in some cases this year, although the total returns from 12 months ago are still positive. Fortunately, I've always mostly confined myself to owning the larger, well-established names, such as 3i Infrastructure, the highest quality animal in its field, Greencoat UK Wind and Bluefield Solar, and avoided the disasters that have befallen some of the more speculative recent launches. Amongst the private equity names I own, HG Capital and Oakley Capital have led the way in returns, excluding 3i, which continues to trade at a remarkable and surely unsustainable large premium. But Literacy Capital has recently disappointed after introducing higher fees. In retrospect, given that I was skeptical that interest rates globally would come down as quickly as many in the markets expected, I should have been less confident. Like most other experienced investors I know, I would also have been better served by having more exposure to the US equity market, which continues to defy all the gloomsters and recently touched new all-time highs, and to the technology trusts, which have enjoyed another stellar year. History teaches us that it is rarely right to underestimate the dynamism of US companies, nor their strength in innovation and entrepreneurship. Whether or not you believe that AI has been overhyped, it is no surprise that US companies should dominate the advances that have been made. However, it has been notable that most of the bigger global equity trusts, including JP Morgan Global Growth and Income, F&C, Alliance, Monks, and AVI Global, have all performed strongly, with NAV total returns of more than 20% over the past 12 months. The merger between Alliance Trust and Witan, which will create a new FTSE 100 company, looks like a positive development for a flagship multi-manager approach. Alliance's reboot 7 years ago has been a textbook example of how a trust which had lost its way can reinvent itself, even if it took the intervention of an American activist investor to first trigger the change. Brunner and Mchattie Investments, not ones I own, are other trusts that are performing well under a new portfolio manager. UK small and mid-cap trusts, traditionally one of the strongest investment trust sectors, have also proved a very profitable hunting ground. Of the ones I follow, I can count at least 7, which are up more than 25% in total return in the last 12 months, and 10 that have returned more than 20%. As you will see from the form on page 155, there are some good reasons to think that smaller company shares, not just in the UK but globally, will do well over the medium term after what, until the last 12 months, has been a long and torrid period of underperformance. It does, however, depend on the course of interest rates and global growth remaining helpful, on which there are some grounds for concerns in the short term. When were there ever not? The UK budget is another potential hurdle that has caused a pause in the performance of UK small-cap trusts more recently. After their disappointing performance I highlighted a year ago, it has been encouraging to see the popular multi-asset trusts that many investors own, for defensive reasons, make something of a recovery in the last 12 months. The reliably consistent personal assets leads the way, with a total return of nearly 9% as I write, followed by capital gearing, which has reinstated its zero-discount policy after an unfortunate administrative oversight interrupted it last year, with 6.5% and Ruffer with 4.0%. REIT Capital, despite its excellent long-term record in Jacob Rothschild's heyday, continues to be a huge disappointment, but on an unprecedented 30% discount can surely improve, if the new management team, which is putting a welcome emphasis on improved communications and disclosure, can start to turn it around. As a long-term skeptic about the attractions of emerging markets, I am probably not the best person to comment about developments in that space. India and China, the two biggest components of the emerging markets universe, have continued to perform in diametrically different ways. Indian equities performing strongly but remaining expensive, Chinese shares dismally but exceptionally cheap. A valid question to ask is, why own a generalist emerging markets trust when individual country trusts that dominate the emerging market benchmarks offer such different opportunities? It is fair to note, however, that Fidelity Emerging Markets, which was profiled in last year's edition, has performed well since, a near 20% share price return helped by discount improvement. And this year, aware that the outlook seems more positive, I have happily also included a number of pieces about trusts which operate in Asian markets, as the outlook there remains positive. Japan is not in the Asian or emerging market sectors, but I have been pleased to see that the two Japanese trusts which explicitly seek to profit from the clear trend towards improved corporate governance, one of which I do own, have had another good year. A less happy development that I think is worth recording here is the decision by Baillie Gifford to drop its valuable sponsorship of literary festivals after a campaign by a group called Fossil Free Books FFB, which, according to The Guardian, called on the company to cease its investments in the fossil fuel industry and divest from companies linked to Israel, as it believes solidarity with Palestine and climate justice are inextricably linked. The organisers of the Hay Festival, who you would think had more sense, also cravenly decided to cancel the Edinburgh firm's sponsorship on similar grounds. It is hard to think of a more ignorant or pointless gesture, evidently based on little understanding of where and how Baillie Gifford actually invests. Good riddance. One particular pleasing thing to report this year is that amidst the general trend of rationalisation, the investment trust sector is finally shedding itself of its most notorious bad apples. The boards of both Home REIT and Asian Energy Impact, formerly known as Thomas Lloyd Energy Impact, have both this year bowed to the inevitable and acted to put the surviving shareholders out of their misery, having earlier attempted to keep them going with better caretaker management teams. Asian Energy Impact is now in liquidation, while Home REIT is to adopt a managed wind-down, designed to maximise what remains of value in its portfolio of homeless accommodation. In those two cases, the shareholders who invested at launch or in subsequent equity issues stand to receive just a fraction of their original investment. In the case of the music royalty company Hipgnosis Songs, which has also now disappeared, shareholders were able to exit at a price above the launch price, thanks mainly to the determined efforts of some prominent shareholders who first challenged the previous board, then removed most of them and put two new directors in place. The revamped board then skillfully played their hand to extract an improved price from Blackstone, the US private equity business, which ended up taking the company private. Finally, we have also recently learnt that Digital 9 Infrastructure, another more recently launched trust which raised an awful lot of money but has turned out to be a disaster for shareholders, is also going to be wound up. All four of these cases have produced months of bad headlines, damaging the reputation of the investment trust sector. The problems in each case have been slightly different. Home REIT came to market with what were absurdly inflated valuations of properties that in many cases were not fit for purpose, and is being investigated by the FCA and police for what looks like fraud. Hipgnosis Songs also suffered from inflated valuations and blatant but unresolved conflicts of interest in its management arrangements. Digital 9's biggest issue has been excessive use of debt, compounded by aggressive and over-optimistic expansion. In each case there is plenty of blame to throw around. It is no accident that all four had IPOs at a time when the investment trust sector was booming, and most alternative assets trusts were trading at a premium. In such conditions, you will always find lower quality companies coming to market that might never make it through the vetting process in more normal times. A useful lesson for the future. In every case, although to varying degrees, the boards failed to recognise the flaws early enough and proved inadequate in their roles as stewards of shareholder money, leaving replacements to clear up the mess. Credulous shareholders and greedy promoters must also take a fair share of the blame, however. From the outset there were plenty of red flags around Home REIT, and the flaws in the others also became apparent to them quite quickly. It is not very heartening to see that ambulance-chasing lawyers are now proposing to launch legal action against at least one of the failed companies, which almost invariably ends up working out better for the lawyers than for the shareholders involved. My message is simpler. Good riddance to all these bad apples. It is a useful reminder that for all the many excellent features of the investment trust structure, things still can and do go wrong. It is important to learn from them. Looking ahead. Just as advocates have long noted, investment trusts have a long and proud history of working their way through periodic ups and downs. To say that is not just to spout rhetoric to keep the spirits up. The evidence is there in the history books. It is no surprise that this past year has been so dominated by corporate activity, just as we predicted a year ago. It is the mechanism by which things change for the better. A particular mention must be made of the activist shareholders who have helped to drive some of the necessary changes. Saggar Capital, the American fund management group, deserves credit for its bold approach in taking stakes in a swathe of underperforming trusts and pressing successfully for change. Another feared US investor, Paul Singer Elliott Management, appears to have been influential in persuading Scottish Mortgage to initiate the largest share buyback programme we have seen from any trust this year, and indeed ever. Nearer home asset value investors, Capital Gearing, City of London and other fund management groups have been actively lobbying for action by boards. Mostly this is done behind closed doors, but occasionally, as in the case of Hypnosis Songs and more recently PRS REIT, they have gone public and secured positive results. Of course, there are issues of valuation, governance, cost disclosure and performance that need to be worked through still. The global outlook remains coloured by geopolitics, uncertainty and excessive government debt. In the UK, the budget that is imminent as I write will certainly have an impact, hopefully not too bad but potentially negative, on the prospects for UK smaller companies. But in my view, there are good grounds for believing that the next 12 months will see further positive performance from the quality investment trusts that survive as we move into the next phase of the current cycle. To that end, I hope that you will find plenty of useful facts and ideas on which to chew in the pages that follow. Jonathan Davies, editor of the Investment Trusts Handbook, 20 October 2024. Jonathan Davies is one of the UK's leading stock market authors and commentators. A qualified professional investor, his books include Moneymakers, Investing with Anthony Bolton and Templeton's Way with Money. After writing columns for the Independent and Financial Times for many years, he now writes the private circulation Moneymakers newsletter. Find out more from the Moneymakers website, www.money-makers.co. Important information. Please note that everything you read in these pages is independently edited and provided for information and research purposes. Without knowledge of your individual circumstances and tolerance for risk, it is impossible, and prohibited by the Financial Conduct Authority, to give individual investment advice. However, all the opinions expressed here are honestly held and believed to be accurate at the time of writing. Please remember also that past performance, while helpful, is not a reliable guide to future performance. The value of investments and the income from them can go down as well as up. Stay informed. For market commentary, performance data, in-depth trust profiles, and weekly links to all the latest investment trust news, please check out the Moneymakers Circle, our regular subscription newsletter, see www.moneymakers.co for how to subscribe. Year in review. Bouncing back, Ewan Lovett-Turner, head of investment trust research at Deutsche Numis, reviews the year and looks forward to more Darwinism. How has the investment trust sector performed over the last 12 months? In general, share price returns have been strong in the 12 months to 30 September 2024. Interest rate expectations shifted towards rate cuts in October 2023, the first of which were finally delivered over the summer, improving sentiment towards many asset classes and fueling a market rally that has seen the US and some other markets hit new all-time highs. However, equity market performance continued to be dominated by a small number of stocks, particularly those with exposure to artificial intelligence, AI. This meant that many equity IC strategies underperformed regional indices despite strong absolute returns. Manchester and London, which has over 50% of the portfolio in Nvidia and Microsoft, unsurprisingly performed strongly, plus 24% share price total return in the 12 months to 30 September 2024, as did Allianz Technology and Polar Capital Technology, both plus 16%, albeit behind their benchmarks. There was a long-awaited improvement in sentiment towards UK stocks, with UK small, Aberforth smaller companies plus 19%, and microcap ICs Onward Opportunities, Rockwood Strategic, both up 25% performing well, as well as Temple Bar plus 15% and Artemis Alpha plus 18%, with the latter benefiting from corporate action. ICs with India exposure also did well. Few equity ICs share prices were down in absolute terms during the year, although notably Japan ICs struggled. Bailey Gifford, Shin Nippon, Fidelity, Japan. The strongest performers, in share price terms across the whole sector, included many alternative asset ICs, recovering from prices that reflected extreme pessimism. An improvement in sentiment towards private assets was reflected in Seraphim Space, plus 56% share price total return in 12 months to 30 September, leading the way, as well as strong share price returns from 3i Group, 38%, IHG Capital Trust, plus 20%, and Chrysalis Investments, plus 20%. Several ICs in the property sector were amongst the strongest performers, recovering from lows plus 37% balanced commercial property, plus 25% Tritex Eurobox, plus 24% PRS REIT, plus 23% Schroeder RE, driven by a change in the interest rate environment and significant levels of M&A. Companies returning capital or opting to adopt wind-down strategies often saw healthy gains. In addition, numerous specialist debt ICs benefited from a higher rate environment to deliver attractive returns. Disappointments included the battery storage ICs, where revenues evaporated. Gresham Street Energy Storage, minus 52%, Harmony Energy Income, minus 35%, Gore Street Energy Storage, minus 31%. As the tide goes out, we are finding out who was swimming without trunks, as various stock-specific issues emerge. Regional REIT, minus 56%, undertook a highly dilutive rights issue, ahead of a maturing retail bond, whilst Digital 9 Infrastructure, minus 45%, suffered significant write-downs given it is unable to provide the capital required to support the growth of its portfolio companies. What has happened to discounts, and where might they go from here? Over the last year, discounts have narrowed for ICs across most asset classes and geographies, from admittedly a wide starting point. On average, the sector discount has narrowed from 18.5% to 14.7% excluding 3i in the 12 months to September 2024, with alternative asset ICs. 3i narrowing from 27% to 20%, and equity ICs moving from 13% to 11%. See tables and charts in the free ebook, Investment Companies Sector, Long-Term Discounts. The most significant narrowing has come from the property sector, which has re-rated in the wake of several trusts being acquired or wound up. Private equity trusts have seen discounts narrow, although they remain wide, helped by most funds adopting capital allocation programs, typically returning a proportion of realization proceeds through buybacks. A focus on capital allocation has also prompted many infrastructure trusts to sell assets, generally at or above valuations, in order to pay down debt and fuel share buybacks. Specialist alternatives trusts saw discounts narrow meaningfully, in part reflecting the departure of several trusts, including the acquisition of Hypnosis Songs and Roundhill Music Royalty, as well as efforts to return capital from the likes of Riverstone Energy E and Tufton Oceanic. In addition, most equity sectors have seen modest discounted narrowing, particularly emerging markets trusts, 21% to 18%, and global trusts, 16% to 14%, helped by significant levels of share buybacks, whilst Japan trusts and Asia Pacific trusts have seen discount widen, and most Asia trusts continue to lag behind benchmarks. Is the consolidation we have seen this year done? It has been a record year for mergers and acquisition activity in the investment companies sector. There have been 17 M&A transactions announced in 2024 to date, up from 8 in an already active 2023. This includes smaller trusts that have failed to reach scale, as well as relatively large ones seeking to create an investment option of significant scale, such as the creation of a circa £5 billion Alliance Witan. Private buyers have also seen value with a pickup in outright acquisitions, including Hypnosis Songs by Blackstone and LXI by London Metric. In addition, several companies have gone into managed wind-downs, particularly subscale trusts in the property, residential secure income, Aberdeen European Logistics, income, and debt, GCP asset-backed income, Blackstone loan finance, sectors. Although the speed and valuation of these realizations is likely to vary significantly from fund to fund. This clear-up is shifting towards some of the 2019 to 2021 vintage of infrastructure IPOs, with Hatrato On-Site Energy and Aquila Energy Efficiency winding down. We expect this investment company's Darwinism to continue. There are around 130 trusts with a market cap of less than £200 million, and we expect many will come under pressure. Size is not everything, and there can be rationale for small trusts in specialist asset classes, such as microcaps, but generally trusts need to achieve a certain scale to appeal to a wide range of investors. This breadth of demand is required to narrow discounts. Large trusts also face pressure to justify their relevance to investors, with boards needing to assess objectively the rationale and performance. Various trusts are likely to face pressure from value-orientated investors, with Saber Capital, a US activist, holding meaningful stakes in numerous trusts. The right answer may not always be to continue with the status quo. We view this creative destruction as a healthy feature of the sector, filtering out disappointing strategies and focusing the sector on the strongest offerings. How well are boards responding to the challenge of managing trust discounts? It is impossible to give a single answer, given each investment company is exposed to its own set of circumstances and each board acts differently. Ultimately, we believe the record levels of M&A, as well as widespread adoption of capital allocation policies, are signs that positive steps are being taken to enhance shareholder value. 2024 is already a record year for returns of capital, fueled by a significant increase in buyback activity including Scottish Mortgage, repurchasing more than £1 billion, partly to tackle the entry of Elliott advisors onto its shareholder register. Overall, buybacks are at record levels. Importantly, shareholders are being more vocal in expressing their views, particularly when dissatisfied. This is essential to give boards the information to take appropriate action. We have seen shareholders voice their disappointment with the board of PRS REIT after it agreed the extension in the length of the management contract and given the wide discount. This has led to the chair stepping down and Rob Naylor and Christopher Mills joining the board. This duo have a record of adding significant value to shareholders after engineering a competitive bidding war for Hypnosis Songs, which saw Blackstone acquire the assets at a much keener price than they had initially proposed. There are certainly some boards that have overseen value destruction, and we would expect these to have black marks against their names. In addition, there are always calls for boards to act more quickly. Significantly, it is much more difficult for boards to do nothing when they are getting clear feedback from shareholders of all types. What methods of discount control are proving most effective? There is no silver bullet to solve a discount. Ultimately, there are a wide range of factors that impact demand for an investment trust, including performance, mandate, marketing, fees, trading liquidity, transparency, and corporate governance. The options available to manage the discount will depend on the nature of the portfolio, particularly the liquidity, ability to sell the portfolio, cash flows received, balance sheet, and the nature of the shareholder register. Amongst equity trusts, we have seen a record level of share buybacks, with over £4 billion of repurchases so far in 2024, and numerous mergers. Private equity trusts have made positive steps by implementing capital allocation policies, which are typically based on returning a portion of net cash flows. This is a positive change. Although investors are still waiting for the pickup in realizations that is needed to fuel more significant returns of capital. In addition, several infrastructure trusts have sold assets, proving valuations and providing capital for buybacks. Addressing the supply-demand imbalance through returning capital is one piece of the puzzle. We welcome these efforts by boards to tackle the supply side. However, once implemented, boards also need to look at more steps to boost demand. We are aware of a number of boards that are assessing options for education and marketing campaigns to broaden awareness. It will be interesting to see these strategies develop. The most successful approaches will be the ones that do not stop with a single proposed solution, but work through tackling each headwind to demand, in combination with increased efforts to attract new buyers. While there's still no IPOs, how long might the drought last? Issuance in the first 9 months of 2024 to 30 September was £672 million, all from existing investment companies. There have been no IPOs in 2024, following just 2 very small IPOs in 2023 and a barren year in 2022. Most trusts are trading on discounts, and several of the 2020 to 2021 vintage of IPOs are proving to be problem children within investors' portfolios. As a result, there remains little appetite for new issues, although it is positive to see the pace of activity in the equity IPO market picking up. What will it take for primary and secondary issuance to pick up again? Very few investment companies have been able to issue new shares. JP Morgan Global Growth and Income has dominated, issuing £314 million of shares, representing an unprecedented 47% of total issuance, benefiting from its strong relative performance, high yield, partly paid from capital, and a strong following from investors. Ashoka India's strong returns helped fuel £101 million of issuance, whilst Regional REIT's Rescue Rights issue raised £111 million. In addition, several specialist debt trusts, such as Invesco Bond Income Plus and 24 Select Monthly Income, have been beneficiaries of rising interest rates, leading the high yields to be popular with investors. It is too early to start talking about widespread issuance. We believe we are still in a period of consolidation as the sector right-sizes to balance investor demand with supply. This is healthy. The focus should be on dealing with discounts on existing trusts, rather than launching new ones. As this progresses, more trusts should move towards issuance territory and eventually the IPO market will reopen. It may be some time off, but we note that new ideas have often been spawned from new regulatory backdrops, which may come from the change in government, whilst there may be a place of valuation opportunity-inspired launches at some point. Strong structuring with significant investor protections if it does not go to plan will be key to generating demand. How do you see the outlook for the sector as we move forward into 2025? The investment companies sector continues to face challenges, but in many places action is being taken to address these. We believe the sector can emerge stronger if smaller, from this current period of consolidation. The key trends in our view are Darwinism. We expect consolidation to continue. Returns of capital, mergers, acquisitions and wind-ups will likely continue at a high level. Ultimately, this will lead to the strongest offerings surviving, delivering on objectives. Very few existing investment trusts are trading on premiums or tight discounts. Amongst other things, narrowing discounts requires trusts to deliver on their investment objectives, and for many in alternative assets that means continuing to prove valuations with asset sales and potentially accretive returns of capital to shareholders. Cost disclosure changes. We also expect changes to cost disclosure rules to be extremely helpful. They have the potential to meaningfully increase demand for investment companies over time. The FCA recently issued forbearance which paves the way for removing the double counting of fees that UK investors in trusts have historically been forced to report. It will take some time for the market to digest and apply them. However, we believe this will put trusts back on the agenda for many traditional investors, including wealth managers and multi-asset investors, that were turned off by the cost disclosure anomaly. The rise of the retail investor, inflation, rising interest rate and economic uncertainty has seen individuals tighten the belts and focus on meeting a barrage of higher costs. As a result, investment has taken a back seat for many. A moderation of these headwinds would be useful for demand, given retail investors have become a significant portion of shareholder registers, whilst some larger wealth managers have arguably outgrown the sector following industry consolidation. The sector must sell itself. There is need to stimulate fresh demand through increased promotion to attract new investors and attract back some traditional shareholders. Investment trusts need to focus on selling themselves in a competitive market for attracting capital. This is not an easy task, but we believe the structure has many benefits, particularly for accessing illiquid asset classes. It also offers exposure to many high-quality managers and portfolios, which should have widespread appeal. Have faith in equities and diversification. Investment trust expert John Barron explains why he has been increasing the equity exposure within the 10 live trust portfolios managed on the website, www.johnbarronportfolios.co.uk. My chapter in last year's handbook, The Darkest Hour, referenced why our portfolios had been defensively positioned in order to reflect the new investment landscape and why, with sentiment poor relative to outlook, our portfolios were now increasing their equity exposure within the perimeters of the new regime. 1 year on, we remain positive about the outlook for markets. However, given expected volatility, adequate diversification relative to portfolio remit is now more important than ever. Travelling with some insurance is never a bad idea, if only for peace of mind, and particularly so if approaching financial goals. Climbing the wall of worry. Equities are enjoying a good run of late, with even the much-maligned UK market doing well. This is confounding many investment strategists, while year-end forecasts are being revised up as previous estimates become redundant. Despite the many economic and geopolitical challenges facing policymakers, markets are climbing the wall of worry. The question is whether this can continue. All-time highs often make investors nervous. Yet, while accepting volatility will be a constant companion, there are good reasons to believe progress is sustainable. The geopolitical challenges are well rehearsed. The war in Ukraine may be edging in Russia's favour, and many Eastern European countries are understandably nervous. Diplomacy and strategic alliances are also having to contend with China's intentions regarding Taiwan and a widening conflict in the Middle East. The current demise of Western influence is perhaps illustrated by the UN vote on Ukraine last year, which saw governments representing more than half of the world's population refusing to condemn Russia's invasion. Meanwhile, wars exist elsewhere, particularly in Africa. Economic concerns abound. At time of writing, despite markets recognizing interest rate cuts are part of the equation, interest on cash and government bond yields still present a headwind for equities. Higher yields elsewhere offer greater competition for investors' funds. Meanwhile, geopolitical events and conflict in the Middle East risk sending oil prices higher, while the gold price is reflecting wider uncertainty and some aggressive central bank buying. There are also market concerns about the extent of budget deficits and debt levels. The situation is not helped by economic growth slowing globally, as productivity has stalled in recent decades. The exception is the US, despite productivity there remaining below its long-term average. Productivity has levelled off in the UK and EU, and the gap with the US has therefore widened. It is no surprise economic growth has outpaced that of Europe, and this is reflected in their respective unemployment rates. The UK has done better on this measure, though. At least part of the divergence between the US and Europe can be accounted for by their different approaches to risk and concomitant attitudes to regulation. While governments must ensure a safety net for the vulnerable, they must also encourage growth. Yet Europe abounds in regulations. In the UK, overzealous regulation and guidance, now finally removed, has previously made investment trusts look unduly expensive, so hindering investment into sectors such as infrastructure, renewable energy, and so on. In Europe generally, MiFID rules are hindering bank lending to smaller companies. Far fewer government regulations on AI have been passed by the US when compared with Europe. The list goes on. Reasons to be positive, yet there are reasons to remain positive about markets. The recent graph, Overleaf, from Montanaro Asset Management, shows the correlation in direction between the US economy and global equity markets over the last 25 years or so. While no correlation is perfect, it does highlight the importance of the US economy in providing markets with a sense of direction. This is rational given its size, transparency, and dynamism. And given the usually long economic cycles, the current juncture suggests further equity gains, despite markets being close to all-time highs. See tables and charts in the free ebook. The US economy drives global equity markets, and things look pretty good. A common refrain is that terminology such as all-time high can spell danger, in that prices are higher than ever before, and so buyers should beware. Yet logic suggests that for markets to advance, they must break through previous highs, otherwise no progress can be made. A journey consists of an increasing number of steps. Indeed, recent research regarding the S&P 500 index has shown that investing solely at all-time highs would still have produced returns close to the index average over the last half-century or so. All-time highs are very common. The greater danger is missing out on the best market days, which is why investors should remain invested relative to remit. Of course, volatility will be a constant companion as markets digest the various challenges, and the gradient of the market's rise will depend on several factors, particularly the extent and timing of interest rate cuts. For reasons I first cited in the spring of 2021, there has been a long-term structural shift in inflation. 3% will become the new 2%. This is helping to shape a new market landscape, yet overall the backdrop continues to be supportive of equities over the short to medium term. However, this narrative should not encourage complacency. Having turned positive on equity markets in the spring of 2023, my Investor Chronicle columns at the time and since have highlighted market and sector preferences when increasing exposure. The 10 live investment trust portfolios managed on the website, www.johnbarronportfolios.co.uk, are underweight the US in favour of the UK, Japan, and emerging markets. Portfolio holdings for these markets include Pershing Square Holdings, PSH, Edinburgh Investment Trust, EDIN, CC Japan Income and Growth, CCJI, and Utilico Emerging Markets, UEM. Favoured international generalists include JP Morgan Global Growth and Income JGGY NAVI, Global Trust AGT. At a more granular level, we favour smaller companies given this point in the cycle. Holdings here include JP Morgan UK Small Cap Growth and Income, JUGI, Montanaro UK Smaller Companies, MTU, Scottish Oriental Smaller Companies, SST, Nippon Active Value Fund, NAVF, Smithson Investment Trust, SSON, and Herald, HRI. Private equity is another attractive sector given discounts and track records, and holdings include Patriot Private Equity Trust, PPT, Pantheon International, PIN, Harbourvest Global Private Equity, HVPE, and CT Private Equity Trust, CTPE. Positive on the UK. Within the portfolio's increased equity exposure, the UK has been assuming greater importance, given it continues to languish at a 40% discount to global markets. Commentators and investors alike have all but thrown in the towel. Even some of the MSCI PIMFA benchmarks used as a long-term reference for the portfolios have recently reduced their UK weighting. Yet, I dare to suggest there is hope. Catalysts for a re-rating lurk in the shadows. Explanations as to why the UK market remains cheap are well rehearsed. An overweight exposure to old economy sectors, at the expense of more highly rated technology companies, 5 prime ministers in 8 years and the concurrent political challenges, onerous listing rules and obligations seeing many companies move to the US, a huge divestment in recent decades by pension funds of equities in general, and the UK in particular, and a perception economic growth has been relatively pedestrian. These have all contributed to the malaise. Any good news has paled into insignificance. Certainly, in contrast to the perception created in certain circles, economic growth has been among the fastest across the continent since Brexit, as evidenced by an unemployment rate remaining well below the EU average and inward investment continuing to compare well. The corporate sector is in good shape with company balance sheets strong and investment gathering pace. Personal taxes are higher than liked, but one of the most generous furlough schemes and energy support packages ensured no one was left behind. Meanwhile, interest rates are now on the turn, even though the Bank of England again risks being behind the curve in responding to the short-term inflation outlook. Perhaps another misconception should be tamed. This is the view that the UK market is bereft of technology. It is true the UK, like many other countries, is not home to the likes of the US's Magnificent Seven companies. For some, the jury is still out as to whether the lofty ratings afforded these companies are justified. Regardless, many large British companies are busy embracing technology and the application of digital tools, including AI. Examples include London Stock Exchange, Sage, Experian and RELX, and the price tags for these stocks are disproportionately cheaper. What of possible catalysts? In an increasingly uncertain world, the UK offers political stability, and the election of a Labour government contrasts starkly with far-right parties gaining political influence on the continent. Our parliamentary system was always more robust and responsive than its detractors believe, but first past the post ensures the minority of extremists in our society, whether left or right, find it difficult to break into the political mainstream. By contrast, proportional representation has sadly conjured an ill wind on the continent. This is being acknowledged by international investors, who are also encouraged by the continued thawing in relations between the UK and EU. The drive by city regulators to relax London's listing rules, and so help stem the flow of companies moving to international rivals, offers hope. In the biggest shake-up in decades, rule changes simplify the process for companies coming to market, including the elimination of the two-tier system of standard and premium listings, relax the restrictions on dual-class shares that confer more voting rights for founders, remove the need for firms to provide a 3-year financial record, and reduce shareholders' rights regarding M&A decisions. Despite the governance concerns of some, the rule changes bring London more in line with international competitors. The regulation of the graveyard has little future. In addition to proposed pension fund reforms encouraging greater investment in domestic equities and infrastructure assets, perhaps there is another factor worth mentioning. Current headlines focus on inflation falling and the speed of interest rate falls. Yet, as highlighted previously, the structural shift in inflation over the medium to long term has implications for discount rates, which will be high enough for questions to be asked regarding the lofty ratings afforded the larger US technology companies. Once the penny drops, investors will have another reason to look at the UK market. The portfolio's increased UK exposure has been courtesy of 7 companies, which promise to outperform their respective benchmarks as the UK plays catch-up. These magnificent 7 companies are Temple Bar Investment Trust, TMPL, Finsbury Growth and Income, FGT, Henderson High Income, HHI, the Merchants Trust, MRCH, Fidelity Special Values, FSV, the Mercantile Trust, MRC, and Montanaro UK Smaller Companies, MTU. Stay diversified. However, while remaining positive if not selective about markets, it is important to maintain investment discipline to ensure portfolio balance is retained and diversification is adequate to remit. This is particularly so when financial goals are nearing. Rising markets can sometimes be seductive and so distract from the task at hand. The journey is better enjoyed if an element of insurance is in place, should things go wrong. Of course, those assets helping with diversification can also be themselves good investments. There is a minority view that diversification is second best to putting all of one's eggs into the basket, but watching that basket very closely. I tend to disagree. I've always considered diversification an important investment discipline, yet one which is often overlooked, particularly when markets are rising. Investors can underestimate just how risk-averse they are until a market correction takes place. Better then, as time passes, to increasingly diversify a portfolio away from equities toward other alternatives, meaning uncorrelated assets, which tend not to move in the same direction as equities, over the same period. While few investments will escape a major market correction unscathed, adequate diversification will help to reduce losses and so protect past gains, while providing firepower for opportunities that usually avail themselves when markets are volatile. Assets used by the portfolios include bonds, infrastructure, renewable energy, commercial property, gold, commodities, and capital preservation companies. Some of these assets also help portfolios achieve a high and growing income, which may become increasingly important to investors as time passes. There are no fixed rules as to the pace and extent of diversification. An investor's income requirement, investment risk profile, influenced by portfolio size relative to other assets, financial objectives and proximity to goals, are key factors. The table shown on the free-to-view diversification page on the website www.johnbarronportfolios.co.uk quantifies the approach we take with our portfolios. The rationale page shows the growing yield of these portfolios, courtesy at least in part to their increasing exposure to high-yielding alternative assets. 4 companies recently bought to assist the portfolios achieve their diversification remits are BHMG, CYN, SREI, and TRIG. John Barron is one of the UK's leading experts on investment trusts, a regular columnist and speaker at investment seminars, and author of The Financial Times Guide to Investment Trusts. Since 2009, he has reported on 2 real portfolios in his popular monthly column in the Investors Chronicle, for which the fees are donated to charity. His website www.johnbarronportfolios.co.uk reports in real time on the progress of 10 live investment trust portfolios which achieve a range of strategies and income levels and possess good track records relative to benchmark. John also chairs the investment committee of Barron & Grant, a discretionary fund management company, www.barronandgrant.com. John has used investment trusts in a private and professional capacity for over 35 years. After university and the army, he ran a broad range of investment portfolios as a director of both Henderson Private Clients and then Rothschild Asset Management. Since leaving the city, he has also helped charities monitor their fund managers. Boards in the spotlight. James Carthew looks at the increasingly high-profile role that boards of investment trusts have had to play as the sector has derated and shrunk over the last 3 years. In my view, the role of the board is vital to the success or failure of investment companies. I spent the middle part of my career when I was managing Advance UK Trust, encouraging and cajoling boards into taking action to tackle discounts, address underperformance, and otherwise improve things for shareholders. In 2001, when I started that job, it often felt like pushing water uphill. Over time, the process became easier, and now I would go as far as to say that the vast majority of boards are doing a good job. However, there are always exceptions, and those are the ones that grab the headlines. Shareholder power. The director's main job is to represent shareholders' best interests. If shareholders feel that directors are not doing their job properly, they can vote to oust them. In extreme cases, as with the debacle of Home REIT, which truly is one of the worst examples of corporate governance failings in this sector, shareholders can band together to sue the company and its directors. Boards hire and fire all of the service providers to the company, including the investment managers. Part of the battle 20 years ago was to ensure that directors were truly independent of the manager. Now, this is less of an issue, but as the recent row at PRS REIT has demonstrated, any suspicion that this is not the case tends to be dealt with severely. PRS REIT was launched in May 2017 and has raised £556 million of equity to finance the construction of homes to rent. By the time its remaining few houses under construction are complete, it will own 5,576 houses. Occupancy is high and it has a good track record of rent collection. However, in 2022, when investors became convinced that interest rates were rising, the shares moved to trade on a wide discount to NAV. When the trust was launched, the manager's notice period was set at 12 months, but notice could not be served until 5 years had elapsed since the IPO. Most notice periods are between 6 months and a year. There is good logic to this in that if the manager resigns, replacing them will take about that long, and if a trust wants to terminate a contract, it is usually because the manager is not doing a great job, in which case you want them out the door reasonably quickly. However, initial notice periods after fund launches are often longer. This helps compensate the manager for the money, time, and effort it puts behind getting the IPO off the ground. It also recognises that it takes time to bed a new fund in and assess whether the strategy is working. PRS REIT's manager's notice period has now been extended twice, first in January 2021 when the portfolio was still relatively immature, with about 3,200 completed homes in the portfolio, and then again in July 2024. The manager cannot now be given notice until 30 June 2029. Shareholders said that they were not consulted about this and argued that this creates a poison pill. There are some things that a board cannot do without consulting shareholders. However, setting terms of contracts is not one of them. In frustration, investors in PRS REIT banded together to try to replace 2 of the directors, and the newly constituted board will now review the company's strategy. The row at PRS REIT echoed the tussle between shareholders, the board and the manager at Hypnosis Songs Fund. Again, there was underlying disquiet about a persistent wide discount, but the real anger stemmed from the board's proposal to sell a portfolio of songs to parties connected to the manager at a knockdown price. This time, the idea needed shareholders' approval. Again, it created an impression that the board was too much in the manager's pocket. A shareholder revolt led to the ousting of directors and a change of direction that ultimately resulted in the sale of the company. It is understandable that stories like these create a sense that there is something wrong with the investment company structure. However, the opposite is the case. The corporate structure, with a board that is accountable to shareholders, gives investors far more control over their fate than would be the case with any other type of fund. When something goes wrong, resolution can be swift, and radical remedial action can be taken. Discounts and buybacks. Discounts reflect an imbalance in supply and demand for shares. There is no quick fix for this, although it should help enormously that the government and regulators are taking steps to address the failings of the cost disclosure rules that have been deterring many professional investors from taking advantage of the bargains on offer. When discounts started to widen a couple of years ago, it was great to see how proactive boards were in addressing the problem. The volume of corporate activity since then has been remarkable. Boards have been deploying a variety of solutions. The most common approach is to shrink the supply of shares through share buybacks. The scale of this is impressive. For example, while I felt it could have acted sooner, on 15th March 2024, Scottish Mortgage announced a £1 billion buyback and has already sailed through this figure, unfortunately without fixing its discount, which remains in the teens. Over the month of August 2024, 117 of 309 investment companies bought back shares worth over £500 million between them. That contrasts with 61 of 354 investment companies buying back shares worth around £200 million in August 2021. One trigger for wider discounts was investors' growing concern about the impact of rising interest rates. That knocked companies investing in alternative assets such as infrastructure and renewables in particular. Most of these were used to trading at premiums and issuing stock. Some had even run up balances on short-term floating-rate debt facilities, anticipating that they would be able to issue new shares to pay off the balance as usual. However, these funds have a particular problem in that the illiquidity of the assets they invest in makes it hard to free up cash to fund share buybacks. This is also a problem that has long faced trusts investing in private equity. In August 2023, one of the largest private equity trusts, Pantheon International, hit the headlines with a plan to repurchase £200 million worth of its shares, or 15% of its then market cap. In May 2024, with that buyback almost complete, the trust outlined its new capital allocation strategy. As cash flows off its portfolio, a proportion of that may be allocated to buybacks, with the amount used this way dependent on the prevailing discount. This approach has been warmly received by investors. However, while other trusts such as Patria Private Equity and more recently Partners Group Private Equity appear to have had some success in narrowing their discounts through share buybacks, Pantheon International's discount is only a little lower than it was in August 2023. The nature of private equity trusts is that they are designed to recycle capital from successful investments into new opportunities. The same is true of trusts providing growth capital. Chrysalis Investments is another trust that has set out a formal capital allocation policy. The board will keep a prudent cash reserve on hand, but any other cash generated by the portfolio will be used first to buy back £100 million worth of stock, and thereafter it is aiming to distribute 25% of net cash profits on realizations. On 26th of September 2024, Chrysalis sold its stake in Featurespace and started buying back shares. For the most part, infrastructure and renewable infrastructure funds were designed to generate long-term income from the investments that they made, holding investments for decades. Boards have had to be inventive in the way that they free up capital for buybacks. Next Energy Solar Fund's board decided to launch a capital recycling program aimed at freeing up cash to pay down debt, buy back shares, and help fund some of its pipeline of new investments. It put a for sale sign on its 5 subsidy-free solar projects. 2 of these have been sold to date and buybacks have started. I find it immensely frustrating that the renewables sector is shrinking rather than providing finance for the UK government's ambitious investment plans for the sector. Here the costs disclosure issue has been most evident, as professional investors turn their nose up at well-covered 7 to 8%, even 10% plus dividend yields. To address the problem, Bluefield Solar has entered into a partnership with GLL, an infrastructure fund backed by a group of local authority pension funds. This has provided finance for the purchase of a solar portfolio, a reduction in gearing, and some new projects that should boost the trust's NAV and revenue in time. Other ways to manage discounts. Buying back shares is only one of a number of strategies that boards are using to manage discounts. The buyback statistics that I quoted above also highlight the extent to which the number of funds has shrunk in recent years. But this is understated, as included within the 308 funds in existence at the end of September. 2024 are 37 that are in managed wind down, meaning that they are gradually selling off their portfolios and returning the net proceeds to investors. Liquidating trusts ought to be a last resort, but many boards, too many in my view, have reached for the self-destruct button. Given the time and expense associated with raising money for investment companies, I am more in favour of finding ways of redeploying capital into trusts and strategies that investors will back. To that end, the surge in merger activity in recent years has been very welcome. There was a suspicion that directors were resistant to the idea of liquidations and mergers because it inevitably means that some of them will lose their jobs. However, the evidence suggests that boards are putting shareholders' welfare above their own. Spreading the word. At the time that it announced its capital allocation strategy, Pantheon International also articulated a need for it to increase its marketing efforts. Some progress has been made on this front, but much more is needed. My observation is that in most cases boards are doing a good job of addressing the supply side of the demand-supply imbalance. However, as an industry, I feel that much more needs to be done to stimulate demand. It pains me how often I talk to retail investors who are not aware of, or do not understand, investment companies. If we strip away the noise associated with a handful of bad apples, the rest of the sector is doing a great job. We need to invest more in communicating that to a wider selection of the investing public. James Carthew has been a director of Quoted Data, the investment trust research firm, www.quoteddata.com, since it was founded in 2013. He is a regular contributor to the Moneymakers podcast. Creative Destruction Lives. Investment trust expert Andrew Mchattie explains why the investment trust sector has been shrinking and why that is a healthy development. However you slice it, 2024 has been a record year for consolidation, corporate action, mergers, return of capital, takeovers and wind-downs. The vocabulary varies, but the underlying action is the same. The sector is being squeezed, and the number of investment trusts is shrinking. During recent months, it has seemed that barely a day has passed without another trust sounding the death knell or announcing a strategic review. It is interesting to consider why this has happened and where the industry may be heading as a result. For a long time we became used to the industry expanding year after year through a mixture of new arrivals and trusts raising extra capital. The pace of expansion accelerated markedly with the arrival of alternative assets, trusts investing directly into property, infrastructure and environmental assets, which tapped into a strong desire for income during the period of near-zero interest rates, often raising very large sums of capital. COVID and consolidation. Between 2014 and 2019, the amount of money invested by investment companies in alternative assets grew by 92% from £39.5 billion to £79.5 billion, and the train kept on running until the pandemic changed the economic landscape, interest rates started to rise, and IPOs hit the buffers. We have had barely any new issue activity since, but negative investor sentiment and persistently wide discounts have instead focused attention on the more prosaic tasks of debt reduction, share buybacks, and cleansing the sector of trusts that have lost their rationale. The consolidation of the sector was foreseen by some industry observers and is perhaps a reaction to some prior overexpansion. Numis stockbrokers argued in July 2020 that the industry could be heading for a period of change they called creative destruction. Even those sages probably would not have expected quite the degree of activity we have seen though, which has been enduring, occasionally shocking and showing no great deference to size or history. The formation of the huge Alliance Witan Global Trust that was agreed in June 2024 signalled the end of Witan Investment Trust's independence despite its £1.7 billion of assets and 115 years of existence. Sometimes size is the reason for corporate action. Over recent years, driven in particular by consolidation in the wealth management industry, the need for firms like Rathbones and St James's Place to have greater liquidity means they have been pushing up the market capitalisation required to establish a place on their coveted buy lists. The minimum size for institutional investment has risen from £100 million to £200 million, and then quickly on to perhaps £400 million to £500 million, at the same time as increasing regulatory requirements have loaded additional cost onto investment companies. Falling by the wayside. This means that more trusts have fallen into the subscale category, where they are failing to attract investors of size, falling to discounts, and ultimately feeling they cannot continue. The board of Riverstone Credit Opportunities decided in April 2024 that a realisation opportunity was likely to leave the trust too small to continue and proposed a managed wind-down. Size was a big factor too in the decision by the board of JP Morgan Midcap at the tail end of 2023 to merge with its stablemate JP Morgan UK smaller companies, combining two relatively small trusts to form one of reasonable scale, and this has been one of several recurring themes. In mid-2023 there were 11 Japanese trusts, two of which had a net assets of a little under £100 million. Now there are 8, because those two, Aberdeen Japan and Atlantis Japan Growth, have folded into Nippon Active Value Fund, which has grown to £355 million of net assets as a result. And because in July 2024, the £190 million JP Morgan Japan Small Cap Growth and Income Trust decided to merge with its larger stablemate JP Morgan Japanese. Depending on exactly which trusts are counted, there are probably around 70 trusts remaining now, with less than £200 million of assets. Some of those may be small for good reason, but there could also be some more fruit to be picked here. A second reason for trusts to disappear is when they are just too similar to others on the market and have no real reason for a separate existence. It is all very well having half a dozen trusts from which to choose in a particular sector, but if they all look the same, that is probably too many. Lack of differentiation probably explains why Henderson Eurotrust merged with Henderson European Focus Trust, HEFT, in the spring of 2024, where their holdings had over 50% commonality by value. This was one of a number of mergers that have taken place within the same management group, and there was an extra factor at play there too, which was the imminent retirement of the long-serving lead manager of HEFT, John Bennett. This ushered in the possibility of change, and there was a fairly similar situation for Artemis Alpha Trust, ATS, which proposed a merger into Aurora Investment Trust in August 2024. Again here, more than a third of the portfolios already overlapped, and the co-manager of ATS was retiring. The question of continuation. The winds of change can blow more explicitly too, with certain corporate deadlines such as continuation votes. These can be a significant catalyst for action. In September 2024, Aquila European Renewables proposed a wind-down after shareholders indicated they were not inclined to support the trust's planned continuation vote. Similarly, the previous month saw JP Morgan Global Core Real Assets fail its continuation vote, triggering a strategic review and a likely exit of some kind. While scheduled continuation votes are not necessarily a harbinger of change, they can be of consequence. It can also be worth noting the arrival of certain names on the shareholder register, such as Saba Capital and Harwood, who are often agents of change. Saba has been very successful with its investments in the sector, and Harwood instigated board changes at PRS REIT in September 2024 that led to a strategic review. Whatever the headline reasons might be for a trust to disappear, there does tend to be one underlying factor running through most cases, which is disappointing or subpar performance. Star performers that have delivered excellent returns to shareholders are not generally going to be under threat. One particularly interesting case to illustrate this point is Aberdeen Dragon Trust DGN, quite clearly the worst performer in its sector over the last 3 and 5 years. In May 2024, Ashoka White Oak Emerging Markets Trust, AWEM, said it had been approached by dissatisfied shareholders unhappy with DGN's poor record. This led to the extraordinary situation where AWEM, a trust with a 1-year track record and net assets of around £35 million, was proposing a combination, effectively a takeover, of a £700 million trust, arguing that DGN shareholders could benefit from a significantly better rating, top quartile performance, a superior fee structure, and an anticipated cost reduction. This followed only 6 months after DGN had effected its own merger with Aberdeen New Dawn, and showed that all underperforming trusts had become fair game in the market for ambitious trusts with a desire to grow at a time when new capital raising was nigh on impossible. Dealing with discounts, often allied to poor performance, though not always, there is the issue of persistently wide discounts to net asset value. To some degree, these have been sector-wide, indicating an oversupply of trusts. The average sector discount, excluding 3i Group, widened out to a maximum of around 19% in November 2023 and has since settled down to the 13% to 15% range. Many trusts are on far wider discounts, and at the time of writing there are more than 40 trusts trading on discounts wider than 30%, and implying a considerable potential uplift to shareholders in the event of some kind of exit close to net asset value, or in the event of a merger with a more highly rated trust. For as long as these discounts persist, so will the temptation to do something about them. A whole raft of trusts have decided they cannot continue on wide discounts, notably in the renewables infrastructure and property sectors. At the very end of 2023, for example, Triple Point Energy Transition proposed an orderly realisation of assets, accepting it had been unable to effectively battle the persistent discount to NAV, the lack of liquidity, and the generally poor capital market conditions. Several of the late-cycle arrivals in the renewables infrastructure sector have followed a similar path, having been unable to achieve the required scale to survive. The other sector that has been especially embattled is property, where debt is always a part of the asset mix and can prove far more costly when interest rates rise. Higher interest rates have often been characterised as the tide going out, uncovering all sorts of underlying problems, and that has been the case for trusts in difficult sectors like social housing, or in the traditional areas of retail and offices that have both been challenging. A whole list of trusts have disappeared through takeovers and mergers. Wind-downs are difficult for property trusts, including Civitas Social Housing, CT Property Trust, LXI REIT, UK Commercial Property Trust, Balance Commercial Property Trust, and Tritax Eurobox. Looking ahead, this cycle is continuing to spin, and it does not seem as though this stage is yet complete, although it will probably slow into 2025 and eventually the pendulum will swing back towards expansion. More corporate activity seems probable in the near term, with more trusts likely to be taken out. Any subscalely, insufficiently differentiated poor performers on wide discounts in challenged sectors will be counting their days. Some we already know are heading for the exit doors because their boards have announced periods of consultation or strategic reviews that most often lead to some form of corporate action. There has been a change of mindset from boards and investors who seem far less willing to tolerate a suboptimal status quo when others have demonstrated how value can be unlocked through change. In some ways it is sad to see the sector shrinking. It does not speak to its merits or to great popularity, and investors are no longer able to access certain opportunities, such as music royalties. Overall, however, it seems reasonable to shine a positive light on this trend. The best trusts are not leaving. Some, such as JP Morgan Global Growth and Income, are benefiting from mergers to gather more assets and strengthen their proposition. Renewing and refreshing those that have lost their way seems like a sensible approach to maintain the long-term status of the investment trust industry, which has such a proud heritage. It does not seem unreasonable to suggest that the sector will emerge stronger, fitter and healthier after dealing with grave disappointments like Home REIT and Digital 9 infrastructure. There remains much to celebrate. Andrew Mchattie is the editor of the Investment Trust newsletter, available by subscription at www.tipsheets.co.uk. Shield that rising tax bill. Alex Davies, the founder of Wealth Club, reviews another eventful year in the venture capital trust market. A notable fundraise. At 9 a.m. on Monday, the 2nd of September, the Mobius VICTs launched their 2024 to 2025 offer. By 10 a.m, they had raised £9.6 million through our platform alone. It was their fastest ever raise, 140% faster than the previous record. It was a remarkable feat by all standards, but more so after a relatively long period of uncertainty and market sluggishness. Since the exuberance of the COVID pandemic, when it looked like young technology companies could do no wrong and increasingly commanded eye-watering valuations, investor sentiment has been battered by seemingly endless challenges, geopolitical, economic and fiscal. Is Mobius's rapid raise a sign that the tide is finally turning, or a red herring? The truth probably lies somewhere in the middle. The Mobius VCTs are, and have been for years, exceptionally popular. They have a well-deserved reputation as generous dividend payers. The annual yields have ranged from 5.4% to a remarkable 24.9% over the last 5 calendar years. Compared to many other VCTs, their portfolio has also been pretty insulated from the fall from grace of growth at any cost tech companies. That popularity goes some way to explaining why investors flock to the recent share offer, but it doesn't tell the full story. It is impossible to ignore the fact that the Mobius fundraise came 2 months after the general election, and when the news was dominated by gloomy predictions about the autumn budget, including potentially damaging changes to taxation. The desire to avoid higher taxes is always an important element in driving demand for VCTs, and was surely an additional factor in the stampede for the Mobius offer. Let's look at the role tax savings play in driving VCT demand. Tax savings as a catalyst for growth. To assess the impact of tax savings, we have looked at the fundraising figures for the 2023 to 2024 tax year. By way of context, in the first quarter of 2024, global venture capital funding declined 30%, with startup funding at one of the lowest points since 2018. In the UK, Q1 2024 was the worst quarter since the early months of the COVID pandemic. Against that backdrop, VCT fundraising showed considerable resilience. VCTs raised £882 million, the third largest amount on record, and only 18% lower than the previous year. Our analysis shows that the pace of fundraising accelerated sharply in Q1 2024, which coincides with the run-up to the end of the tax year. Indeed, 30% of the funds raised by VCTs in the 2023 to 2024 tax year were raised in March 2024, and the first 5 days of April alone. Whichever direction the macroeconomic winds might blow when confronted with the realities of a looming tax bill, it is evident that for VCT investors, pragmatism continues to trump sentiment. A significant tax saving today trumps concerns over what tomorrow might bring. That in turn is a positive for economic growth and innovation. The higher the amount invested in VCTs, the more capital is funneled through to young and entrepreneurial companies. The more capital they have, the more people they can recruit and the more they can grow. Growth usually breeds confidence, which in turn fuels investment, creating a virtuous circle from which the whole economy stands to benefit. The Venture Capital Trusts Association, which represents more than 90% of the VCT industry by value, reports its members have provided £3.6 billion of vital funding to ambitious startups since 2016. Over 300 emerging companies received £505 million in 2023 alone. That funding has a ripple effect through the economy. For instance, Albion Capital, the manager of the well-respected Albion VCTs, has supported 74 companies with £168 million in funding, £81 million into new companies and £87 million in follow-ons in the last 3 years. This has translated to employment growth across the portfolio from 3,490 employees in 2020 to over 4,700 in 2023. A case in point is Albion VCT's largest investment, Quantexa. This big data analytics firm uses artificial intelligence to uncover hidden relationships and emerging risks, helping financial institutions spot and prevent fraud. Its clients span blue-chip banks including HSBC, Standard Chartered Bank, and Danske Bank, insurers and government organisations. It was established in 2016, and in just 7 years it has grown from 30 people in the UK to around 650 globally. In 2023 it became the first British unicorn of the year, having received a £100 million investment at a valuation of around £1.4 billion. The business is investing £80 million over the next 3 years to support the government's plan to make the UK an AI hub, an investment expected to create more than 170 new jobs. Drivers of demand. If tax efficiency is a key driver of investor appetite for VCTs, we might be in for a bumper year for the sector. HMRC's income tax takings have been on a sharp upward trajectory since 2020 to 2021, when income tax thresholds were frozen and fast-rising inflation pushed many people into higher tax bands. Receipts are expected to continue to swell. There was a record annual take of £277.2 billion in 2023 to 2024, and this is forecast to grow to £363.5 billion over the next 5 years. Much of that burden will fall on the ever-growing number of higher and additional rate taxpayers. The combination of inflation and the income tax threshold freeze has contributed to more than double the number of top-rate taxpayers in the past 3 years, while the number of higher-rate taxpayers is expected to rise to 6.31 million this tax year, up from 4.43 million. Meanwhile, nearly 3.6 million taxpayers are expected to incur tax on dividend income this year, netting the Treasury almost £18 billion. Analysis of HMRC figures by a leading investment platform found that nearly a fifth of higher rate taxpayers will pay £5,379 in dividend tax this year on average. Additional rate taxpayers will see an average bill of £32,578. This trend is the state of play before any changes the October budget might bring. What we've been told, as clear as a bell, is that the budget will be painful, and those with the broadest shoulders should bear the heavier burden. Experience strongly suggests that the rising tax take will continue to drive more investment into VCTs. VCTs offer a way to mitigate the impact of tax on your wealth. When you invest, you can receive up to 30% income tax relief. That's a saving of up to £60,000 on your income tax bill, if you use the whole VCT allowance of £200,000 per year, and which should be welcome to anyone facing a higher bill. Moreover, any growth is tax-free, and so are the dividends. Most VCTs tend to pay each year. If a VCT pays a 5% dividend, that means you get 5 pence for every pound. To match that, assuming the dividend allowance has already been used, a higher rate taxpayer would have to receive a taxable dividend of 7.55%, 8.24% for a top rate taxpayer. Dividend payments remain resilient. It also helps that VCT dividend payments have been to date quite generous. We have looked at the cumulative dividends paid by the 10 largest VCT managers over a period of 3, 5 and 10 years, as well as in each of the last 5 years, and calculated the yield. There are some impressive figures, the aforementioned Mobius VCTs for instance, but even if you look at the averages, they compare well to the average yield of the FTSE All-Share and FTSE 100 companies. That's before taking into account that unlike VCT dividends, those paid by listed companies would normally be taxed unless the shares were held in a tax wrapper. See tables and charts in the free ebook, Cumulative Average Dividend Yield, Performance in Context. As well as generous dividend payments, the long-term performance of the generalist VCTs has historically been strong and resilient. However, in the short term, VCTs have endured a challenging environment and most have struggled. The AM VCTs have been hit particularly hard, with NAV total returns down by an average 14% in 2023, even though this was an improvement on the previous year figure, negative 30%. It is fair to note that smaller companies generally have, until recently, also struggled in an environment of higher interest rates and pedestrian economic growth in the UK. Additionally, AIM stocks have suffered from fears that the new Labour government may clamp down on the tax relief for which many AIM companies qualify. Generalist VCTs with high exposure to businesses reliant on accessing additional capital also suffered. An example is Octopus Titan VCTs, which had to cut its net asset value twice in a year on the back of tumbling valuations for several of its investments, most notably online used car supermarket Cazoo and pet insurer ManyPets, both of which were at one point its largest holding. Across the board, there has been a shift in focus from growth at any cost to sustainable growth, which has favoured VCTs targeting companies with more predictable business models, such as B2B software services. This has been the case for Octopus Apollo VCT, for instance. That said, amidst significant variations between individual trusts and management groups, there have been notable success stories. Quantexa, mentioned earlier, is one Albion VCTs. Other examples include MyTutor, an online platform for parents and students to search and connect with undergraduate tutors, backed by the Mobius VCTs, ranked 21st in the 2023 Deloitte's UK Technology Fast 50. Rovco, a global provider of subsea robotic and integrated survey solutions, backed by Foresight Technology VCT, ranked 32nd in the 2023 Deloitte's UK Technology Fast 50. Secret Food Tours, a platform providing foodie tours in over 60 cities, backed by Pembroke VCT, 22nd in the 2024 Sunday Times 100. See tables and charts in the free ebook, Cumulative NAV and Dividends, 3, 5 and 10 years, delivering on growth. The real picture is more nuanced and encouraging than the averages suggest. You can see this by analysing the growth rates of VCT-backed companies. Our starting point was the portfolio companies of 38 VCTs, together accounting for around 83% of the assets of all active VCTs. We have then divided their portfolio companies into 3 categories: revenue decline, modest growth, companies with revenue growth of 0 to 25%, high growth, companies with revenue growth of 25% plus. We've then applied the same categorization to the constituents of the FTSE All-Share, excluding investment trusts and insurance companies. You can see how they compare in the following chart. See tables and charts in the free ebook, Exposure to Growth. VCTS versus UK main market. This chart shows the revenue growth exposure of 38 VCTs as a percentage of their invested assets, compared with the revenue growth exposure of the constituents of the UK main market, all share, excluding investment trusts and insurance companies. What our research shows is that VCTs continue to be packed full of high-growth early-stage businesses. For the VCT managers featured in our research, nearly half, 40.5%, of their investments are in businesses that have grown revenues by more than 25% year-on-year. By contrast, only a minority, 7.1%, of the FTSE all-share constituents, excluding investment trusts and insurance companies, have achieved that. If we were to look at a fourth category, rapid growth VCTs fare even better. 24.5% of the VCT's portfolios are invested in companies growing revenues at more than 50% per annum, compared with just 1.4% by market cap of the main market. The numbers clearly show that VCTs are delivering on their promise of offering investors access to faster-growing companies, albeit with all the associated risks. Of course, rapid growth in revenues does not automatically lead to profitability, but the growth record is no doubt a reason why one of the first acts of the new Chancellor, Rachel Reeves, was to confirm that the tax breaks investors in VCTs enjoy will be extended to 2035, in recognition of the contributions VCTs have made to innovation, employment, and growth. The profile of VCT investors. Contrary to what many think, there is no such a thing as a typical VCT investor. The average age of our clients who invest in VCTs is just under 60. The youngest is 19, the eldest 104. The fastest growing group of investors is those in the 30 to 40 age bracket. 80% are male, 20% female. In the 2023 to 2024 tax year, they invested £35,286 on average across a number of VCTs per tax year. The average amount invested in each VCT was £10,621. We don't record occupation, but many we speak to who invest are professionals such as doctors, lawyers, higher earners in the city, business owners, head teachers and civil servants. They tend to have investments elsewhere, ISAs, pensions, property, to which VCTs add diversification, and they tend to have been affected by tax rises and pension restrictions. By and large, tax is most commonly cited as a reason that prompted them to start investing in VCTs. Diversification, exposure to high growth potential investments, and the opportunity to support UK entrepreneurship were also mentioned. These reasons are all the more pressing now as we face the highest tax burden in 70 years, with the potential for that to increase in the budget and the urgent need to reignite growth in the UK economy. If you have sufficient assets elsewhere and a certain level of financial sophistication, VCTS may well be a worthwhile option for you to consider after using your pension and ISA allowances. As a rule of thumb, VCTs should account for no more than 10% of your total portfolio. When you invest in a VCT, your money will typically be spread over 30 to 100 companies, which provides an important degree of underlying diversification. In addition, it may be prudent to spread your annual investment over several VCTs, preferably with different investment styles, to further diversify your risk. Don't forget you have a 30% cushion in the form of tax relief, should things go wrong. Clearly, for someone who doesn't have sufficient assets or earnings and doesn't fully understand the risks, VCTs are unlikely to be a suitable investment. Young, small companies are more likely to fail than older and larger ones. If something goes badly wrong for a small company, it is much harder for it to recover than it is for a large and well-established company. Small companies are also a lot more illiquid, as are VCTs themselves, meaning it may be difficult to buy and sell the shares. One final thought. The VCT season has only just started this year. While the total funds raised this tax year may or may not surpass last year's high, if the start of Mobius's fundraise is anything to go by, it is worth remembering that the most popular offers tend to sell quickly and capacity is limited, so early investment is worth considering. Alex Davies is the founder and CEO of Wealth Club, the largest broker of VCTs and tax-efficient investments for experienced investors. Our report card, Progress. A year ago, fund manager Ben Conway set out his firm's manifesto for reforming the investment trust sector. Here he takes stock of the advances that have been made since and what remains to be done. Cost disclosure victory. We ended that manifesto with a plea for all stakeholders to engage with industry bodies and boards on the issue of misleading cost disclosure. We have been campaigning for nearly 3 years on this issue, and so it was fantastic to see our efforts, and those of our fellow campaigners, rewarded on Thursday the 19th of September with a pair of excellent announcements from the government and the Financial Conduct Authority. As last year, bear with me on the jargon. Ahead of legislation on the Consumer Composite Investments, CCI regime, the one that will replace PRI APS regulation in the UK, and ahead of an FCA consultation on how the regulator should use its rule-making powers under this regime, which Investment Trust will be a part of, the FCA has granted what is called an interim forbearance to investment companies. Under this forbearance, investment trusts may choose not to follow the requirements of existing PRI APS regulation, nor those to be found in Article 52b and Article 51 of the MiFID Org regulations. What this means in plainer English is that there will be no FCA action should an investment trust or company choose not to issue a key investment document, KID, one of the current regulatory requirements and a bête noire for the industry. Nor will they be required to publish the ongoing cost of holding a share of an investment trust when reporting under the European MiFID template, EMT. In short, and stripping away the jargon, this is a huge victory for the campaign group, who have long argued that investment trusts do not have ongoing costs, meaning costs that are deducted from the value of your investment, which in this case is obviously the share price. What they do have are recurring operating expenses that are deducted from the net asset value of the portfolio. The two concepts, ongoing cost and operating expenses, are not the same, and the result of the old requirements has been to misrepresent the cost of ownership, making it appear higher than it actually is. The double counting of costs has resulted in both a demand strike by investors and capital leaving the sector in droves, which in turn has contributed to discounts widening and a cessation of capital raising. A better system. We have long argued for a better disclosure regime rather than for no disclosure. We are therefore suggesting a point of sale statement of operating expenses. Recurring operating expenses can be tricky to extract from investment trust reports and accounts, even for professional investors. Extracting these figures, presenting them in an easy-to-understand template, and expressing them as a percentage of NAV, as well as in pounds and pence with year-on-year comparisons too, is what shareholders are entitled to see. A disclosure regime that gives them that information in a standardised format will make it much easier for investors to compare different trusts within the same sector, as well as with different vehicles, such as open-ended funds. Understanding that the ratio of these expenses to NAV is similar to, but not the same as, an ongoing cost ratio for an open-ended fund is crucial. Comparisons should not be done without knowledge of the prevailing discounts, or premia, remember those to NAV. Such a disclosure document is the best way, in our view, to help distributors support their customer base and aid investor understanding. It has been pleasing to see Aberdeen lead the way and publish the first SOE for one of the trusts for which they are the AIFM and investment manager, Murray International. It is our hope that other trusts will now follow suit. Sadly, some platforms have expressed dissatisfaction with investment trusts that disclose zero ongoing charges. They say that they cannot discharge their obligations under consumer duty. We say that it is misleading to tell investors that any sum is deducted from the share price, and that to do anything other than disclose zero is misleading. There is still a lot of work to do to educate platforms and any other distributors who struggle with the fact that investment trusts have expenses deducted from their NAVs, not charges deducted from share prices. In any case, thanks to the forbearance on cost disclosure, we now have breathing room to participate in the FCA's imminent consultation on the new CCI regime, which is due to come into force in 2025. It is truly wonderful that the unique characteristics of investment trusts have been recognised and that they will in future enjoy a bespoke legislative and regulatory framework. We must, however, be watchful that being included in the new CCI regime, something that around 330 signatories from the industry argued against in the Treasury consultation, that closed in January does not lead to unintended consequences. We must now seize this opportunity to ensure investment trusts are attractive to as large a cohort of investors as possible. Being classified as a CCI could even help, not hinder, that objective. We are hopeful that the first steps have been taken to elevate the investment trust as the vehicle of choice for all investors looking to access less liquid assets, and in doing so help to finance the build-out of productive infrastructure for the UK economy to the benefit of all. Reforming the IPO process. With barely any capital raised of any nature for the past year, it is too early to say whether the IPO process has been reformed for the better, as we would like to see happen. We have seen a smattering of attempted launches and pre-marketing efforts, and it has been encouraging to see some of those suggesting launching with investors receiving £1 of assets for £1 of investment. I should stress that we have never suggested costs of launching are too high, just that it is not right that investors at IPO pay them all on day one. Promoting alignment of interest. Our strong belief is that the investment advisors or managers' fees should be calculated as a percentage of market capitalisation, not on NAV. This is especially true of alternative asset trusts, where the NAVs are both subjective and volatile, as well as calculated infrequently, some as seldom as twice a year. Sadly, there have been some very recent and significant NAV write-downs which make the case for calculating fees on NAV hard to justify. If the NAV turns out to be wrong, then it is not right that managers or advisors should be rewarded with fees based on the higher inflated number. In some cases, we have also seen companies valuing their assets under the assumption that the investment trust will be able to fund its future capital expenditure. The fact that assets can be valued in several different ways should already ring alarm bells for shareholders worried about alignment of interest. When these assets are held in an investment trust structure where equity capital raises are not foregone conclusions, it is even more of a red flag. Once it becomes clear the trust cannot raise additional capital in support of the assets, NAV write-downs will follow if the previous valuation was based on the premise of future funding that fails to materialise. In addition, some NAVs are highly dependent on a set of assumptions which can differ widely depending on what third party is used to formulate them. Alternative assets are often valued using discounted cash flow models that must make revenue forecasts far into the future. Two organisations looking at the same data can come up with different forecasts. In the case of one trust recently, Gresham House Energy Storage, the switch from one provider to another caused a material decrease in the reported net asset value. Towards better capital allocation, with discounts staying wide throughout 2024, it has been pleasing to see a material pickup in share buybacks. 2024 looks set to be a record year, with £11.7 billion of capital returned, according to the AIC, in the year to end August, of which buybacks total £4.6 billion. We have always been careful to say that buybacks are a capital allocation decision and are not about narrowing the discount. This message is slowly getting across. It is infuriating to hear boards say things like, there is no evidence to suggest buybacks narrow discounts. That is beside the point. Discounts, at the risk of stating the obvious, are a function of supply and demand for investment trust shares. They will narrow if demand relative to supply increases. Buying shares back is and should be about NAV per share accretion, and can be the best risk-adjusted investment a trust can make if its discount is wide. We are very unsympathetic to a board which avoids buybacks on the view that a discount is temporary or cyclical, or that the buyback will diminish liquidity, staying relevant and communicating better. Of the £11.7 billion of capital returned so far in 2024, over £5.5 billion has come from liquidations, with a further £1.5 billion or so coming from realisations, redemptions or tender offers. While it is sad to see the sector shrinking, it is healthy to see the forces of natural selection being brought to bear. Trusts that lack relevance or fail to make best use of the structure and are languishing on long-term wide discounts most definitely should be returning capital to shareholders, a path back to health. There are several necessary but not sufficient conditions that must be met before we can think about the sector trading back to par. Cost disclosure reform was never going to be a silver bullet, but it certainly was necessary, and has been, in our view, the single largest obstacle to attracting more capital. But we still think that we also need to make a whole host of other reforms and changes, including those we wrote about a year ago. Clear progress has been made, but there is still a long way to go. Campaigning for the better part of 3 years on the cost disclosure issue has given us a fascinating insight into how engaged boards of investment trusts really are. Our experience to date has been mixed. Some boards have been hugely engaged and cooperative. Others are best described as either having their heads buried in the sand or willing to let others do the work. The important point is that there is often a significant correlation between a board's attitude on these sorts of issues and the quality of its day-to-day corporate governance. Eventually, poor or lackluster corporate governance gets found out. One other encouraging feature of the past few years has been increased engagement with boards from our fellow shareholders. Board members can no longer take their positions for granted. All this leaves us feeling much cheerier about the future for investment companies. We believe the sector is now on a path back to health. That said, this is no time for complacency, and it is beholden on all stakeholders to do their bit to ensure the investment trust sector can grow again and attract a much broader constituency of investors, as it deserves to do. Ben Conway is Chief Investment Officer and Head of Fund Management at Hawksmoor Investment Management, and one of the primary movers behind the campaign for a reform of the cost disclosure rules. The challenge for alternatives. Sachin Saggar, an analyst at the broker Stifel, addresses the challenges that face alternative asset trusts. The performance of the listed alternatives sector before 2022 was well supported by low interest rates and strong inflows into many open-ended funds that ultimately invested in the sector. The additional risk premium that could be earned by investing in the sector compared to other traditional sectors such as fixed income was particularly attractive for those that sought income. These macro tailwinds have now reversed, which has led to a derating across the sector. The average discount to NAV for listed alternatives, excluding 3i, is 20%, which is only slightly narrower than the peak of 25% in 2023. Many of the issues seen in 2023, the sector have been focused on newer trusts, with those that have had longer track records largely escaping the worst of the derating and remaining in better shape. At first sight, it appears that the sector has begun to show signs of recovery. However, the true picture is not so reassuring. A number of trusts that were on particularly wide discounts, such as Hypnosis Songs and Foresight Forestry, have been taken over, and others are now in the process of being wound down and liquidated. Their removal from the sector makes it difficult to decipher if discounts have actually narrowed. Why have newer trusts struggled? Listed alternatives grew rapidly in the low interest rate era as the favourable macro tailwinds enabled a surge in IPOs and left many trusts trading at large premiums to NAV. However, the The subsequent reversal in interest rates has highlighted a number of issues that need to be addressed. As with any product that has benefited from rapid growth, a period of consolidation follows and provides an opportunity to reflect on what has worked well and what has not. In my view, listed alternative trusts have a number of design flaws that increase the probability of them running into issues. As a generic statement, premiums to NAVs are significantly impacted by the external macro environment. What this means is that typically capital can only be raised when share prices are at a premium to NAV, and this occurs only when macro tailwinds are supportive. Unfortunately, this is also the time when asset pricing tends to be frothy. The situation is further exacerbated by managers being unsure how long the window to raise capital will persist. Hence, there is a tendency to take what you can while you can. It was a common experience up until 2022 for capital raises to be increased beyond their initial targets. So not only was capital being raised when asset pricing was frothy, but managers were raising more capital than they had investment opportunities for, creating the potential for cash drag. The pressure to invest this capital quickly during a frothy asset pricing environment inevitably leads to the risk of performance issues later on. The flip side to this boom time scenario is that managers have expectations that capital will be readily available in the future and so are happy to use credit facilities to bridge the gap between funding rounds. However, if the window for future equity raises does not reopen, trusts are then at risk of becoming over-leveraged and having to deal with the consequences. Today, with asset pricing more attractive for buyers, we are seeing trusts across the sector selling assets to validate their NAVs and bring gearing to more acceptable levels. The sector is largely behaving in a homogeneous way. Given that capital raising is more likely to occur when asset pricing is frothy, and asset sales when pricing is low and visibility is poor, the consequences are predictable. Buying in high markets and selling in low markets will lead to poor return outcomes. Given this inherent problem of a skew towards negative outcomes, my view is that we need to refine the funding cycle for listed alternative vehicles. The underlying principle is that capital raising should be smoother through different cycles and that it should, wherever possible, be raised in advance of clearly identified transactions. This would reduce gearing levels and limit instances of over-raising of capital in the wrong environment. For this to occur, I think there needs to be some wiggle room on the ability to raise capital at a discount to NAV, something that is currently regarded as unacceptable, given the dilution of existing shareholders that results. We recently conducted a survey among professional investors and found that a majority, around 60%, were open to this approach, provided that the fees charged by managers were based on the lower of market capitalization or net asset value. In general, investors understand that the NAV of an alternative asset is subject to some uncertainty, and so raising capital at a small discount to NAV is not necessarily dilutive. Of course, dilution is an issue that divides opinions, but those that are critical of allowing this to happen have offered no plausible alternative solution to address the issues that have come to light over the past 18 months. The role of valuations. While we believe that the listed alternatives sector needs to be reformed, we also identified significant concern amongst investors, 57% in our survey, about the damage that some bad apples have inflicted on the sector. Hypnosis. Songs and Digital 9. Infrastructure are two examples of trusts that raised a large amount of capital on what has since been shown to be incorrect NAVs. There are other examples elsewhere in the sector where we believe that the reported NAVs are aggressive. These issues need to be addressed, particularly for funds that use a discounted cash flow valuation approach when calculating their NAVs. The issues at both Hypnosis Songs and Digital 9 infrastructure could have been avoided if they had provided more context to the EV/EBITDA multiples they used. An EV/EBITDA multiple is a blunt metric, but at a high level can give confidence that NAVs are broadly in the right range. However, it is important for shareholders and analysts to be given more detail about the underlying assumptions that support the NAV and how these have evolved from one valuation point to the next. Recent experience suggests that investors should be viewing NAVs with a healthy dose of skepticism. It is incumbent on boards and managers to provide sufficient transparency that investors can have confidence that valuations are sensible. The time when trusts could release a NAV with little commentary and expect investors to make simplistic decisions based on discounts has passed. Marooned funds. A number of trusts in the alternatives sector continue to trade at discounts to NAV of 25% or more, and also have a market cap of less than £250 million. There are worrying signs that investors in these trusts have given up. They can see no pathway for these trusts to recover and as a result continue to drip feed stock into the market. Unfortunately, we think the majority of these funds will fail to survive, and those that do will be the exception. From a sector perspective, it would be helpful if boards would recognise and understand whether a particular fund has a viable future before the next continuation vote. An accelerated tidy-up of the sector will allow capital to be recycled to the survivors and discounts to narrow. It is true that some of these trusts may have strong management teams and have not necessarily executed their mandate poorly, but in a period when investors are demanding greater liquidity and scale, creating demand for the shares that face these headwinds will be near impossible. Cost disclosure reform. Poorly designed cost disclosure rules have also contributed to capital leaving the investment trust sector. This is particularly the case for listed alternatives. It is welcome news that this is now in the process of being reformed, with trusts and wealth managers now freed of the need to report double-counted fees under inherited EU regulations. However, we are not of the view that these changes will themselves lead to capital rushing back into the sector. Once a decision to disinvest has been made, reversing capital flow is unfortunately much more difficult. The reform of these rules does mean that a headwind to the sector has been removed, although we do not yet know what the new product regulations promised by the Treasury and FCA for 2025 will involve. However, at least the historic problem is not going to get any worse, and perhaps with other macro factors becoming more supportive, discounts to NAV can narrow. The outlook for alternatives. There is still plenty of consolidation that needs to occur in the sector. What has not changed, however, is that a listed investment trust is a much better way to hold illiquid assets than most other options. The issues which have come to light are ones that many investors clearly did not expect. But what we have since learnt gives everyone a chance to reflect and take a more thoughtful approach to how these issues can be addressed. It is important that the next wave of IPOs, when it comes, does so with a recognition that the structural headwinds of the last wave can be avoided. We think it is healthy to debate these topics, but ultimately it is up to investors to decide whether in aggregate the listed alternatives sector is meeting their needs. Sachin Saggar has been an analyst at Stifel since 2019. No going back. Simon Elliott reflects on a year of change in the investment trust world. Darwinism at work. A Darwinian wind is blowing through the investment trust sector, with corporate activity prevalent and a wave of consolidations following in its wake. One veteran trust director recently likened the sector to a school dance, with hesitant participants eyeing each other nervously before plucking up the courage to ask for a dance. In the 2 years I've been with JP Morgan Asset Management, we have been involved in 6 consolidations. Across the wider investment trust sector, 10 consolidations have been announced so far in 2024, and it seems reasonable to assume that more will follow. As far as I am aware, this level of activity is unprecedented in the 156-year history of investment trusts, and raises several questions, not least, why is this happening? Is it a positive development for shareholders? And will we see more of it? To a large extent, the consolidation in the trust sector reflects that seen in the wealth management industry. Wealth managers, or private client brokers, have been long-term supporters and investors in trusts. However, as that industry has evolved, with the emergence of ever larger firms, so too has their requirement for larger trusts to meet their liquidity needs. One leading wealth manager told me recently that they would not consider adding an investment trust to their recommendation list if it had a market capitalisation of less than £1 billion. At present, only 44 trusts meet this threshold. To be clear, this does not mean that the remaining 255 or so trusts are not fit for purpose. There will always be a place for more specialist mandates that, by their nature, means that their size has to be limited. A good example would be trusts that specialise in small-cap companies. However, even the most enthusiastic advocate of the benefits of the trust structure would acknowledge that it has been increasingly difficult to justify investment trusts with market capitalisations below £200 million, particularly those with limited prospects for growth. Pressures for scale. There are numerous benefits from consolidating investment trusts, including the positive impact on the ongoing vehicle's liquidity in the secondary market. Put simply, it is easier to trade in size in larger trusts, which for professional investors, such as wealth managers, is an increasingly important consideration. Even for smaller shareholders, larger trusts are more attractive from a trading point of view. The bid-offer spread, i.e., the difference between what the market is prepared to sell a share for compared with the price for buying a share is de minimis for larger trusts, while it can be substantial for smaller, less liquid trusts. Another important advantage of consolidation is that it invariably leads to a reduction in expenses. For a number of years now, there has been a trend across the trust sector for increasingly competitive fee structures, not least the introduction of tiered fees. These allow the benefits of scale to be shared with ongoing investors. A good example of this in our stable is JP Morgan Global Growth and Income. Following 3 consolidations, including one with the Scottish Investment Trust, and a period of strong outperformance, the trust now has assets of £2.7 billion and an ongoing charge of just 0.48%. This trust benefits from a tiered fee structure that sees a charge of just 0.3% on net assets over £1.5 billion. One of the criticisms historically levelled at investment trust boards is that turkeys don't tend to vote for Christmas, with the charge being that resistant directors provide an obstacle to corporate activity such as consolidation, given it runs the risk of them losing their directorship. Recent experience would suggest that boards are increasingly mindful of the need to be of a size sufficient to appeal to investors and are prepared to consider their options. One of the characteristics of this year's announcements is that a number of the trusts involved were of a size that did not necessarily require consolidation. However, bulking up was seen as an advantage at a time when investors are demanding ever larger trusts. Consolidations, together with takeovers and managed wind-downs, have already led to a considerable contraction in the sector, particularly at a time when the IPO window is currently shut. At the end of 2021, there were 336 investment companies, and this number has already fallen to 300. It seems reasonable to assume that there is more activity to come despite positive developments such as changes to the cost disclosure regime and a boost from lower interest rates. Constraining factors, however, despite the advantages emerging from consolidation, there are reasons why the number of consolidations is likely to remain modest. Consolidations are relatively complicated and expensive transactions to execute. Even the most straightforward of deals can see professional fees for both parties involved equate to over £1 million. In many instances, the impact on ongoing shareholders has been alleviated to some extent by fee holidays. For instance, in the transactions that JP Morgan Asset Management has been involved with, a significant contribution has been made in each case. However, given the level of costs involved, not all potential deals make sense, and a struggling subscale trust may be better off simply looking to adopt a managed wind-down strategy. In addition, consolidation makes most sense when the strategies of the trusts are broadly in line, or their respective portfolios share some commonality. It is more difficult to justify consolidating trusts with distinctly different approaches and asset classes, although this could be addressed by adjusting the size of any accompanying liquidity event. One notable characteristic of a number of recent consolidations is a cash option for shareholders in the trust that is being consolidated. It is not uncommon to see shareholders being offered the option of receiving cash equivalent to between 15% and 25% of net assets at around NAV as part of the proposals, even when the mandates are relatively similar. While this adds additional expense to the process as it requires a prospectus to be produced, it is often seen as a necessity, particularly when there is a clear change in mandate or the consolidating vehicle is trading on a discount to NAV. Certainly, trusts that can command a premium rating or even a relatively narrow discount have a clear advantage when acting as a consolidator. Approval from the shareholders of both parties involved is obviously a requirement of any consolidation, and is not necessarily a formality. Historically, the investment trust sector has not been known for hostile takeovers, although there have been some isolated attempts over the years. If they are minded to thwart a bidder, the boards of targeted trusts always have the option to pursue a scorched earth policy by offering a full liquidity event, i.e., cash exit if necessary, with a rollover into an alternative vehicle as well. The deals that have been seen in recent times are invariably the result of a friendly approach, often between trusts in the same stable, or following a period of poor performance and subsequent strategic review. Where next? It is hard to gauge whether the current wave of consolidations will peter out in time. There is an argument that the most obvious deals will get done first, leaving the more difficult ones to fail for reasons of cost or practicalities. Boards involved in consolidation certainly have to be clear on how it benefits ongoing shareholders, and there will always be those wary of an ill-timed partnership with a trust that has just enjoyed a period of high returns. However, there is a stronger argument that if trusts wish to remain relevant at a time when investors require larger, more cost-efficient vehicles, then identifying a partner to dance with should be an important consideration. For that reason, and others, I suspect that the process still has further to run. Simon Elliott is a client director of JP Morgan Asset Management and the former head of investment trust research at Winterflood Securities. Professional perspectives. Market risks are evolving. Hugh, Gimber, global market strategist at JP Morgan Asset Management, takes a look at the changing face of market risks around the world. As 2025 approaches, the balance of risks facing the global economy has shifted. Inflationary pressures have receded globally, and the concern is increasingly that economies are cooling too much. However, risks are playing out differently across the major regions, with political uncertainty also playing a role, especially in the US. What's next for the US? Both investors and the Federal Reserve, Fed, spent much of 2024 focused on persistent US inflation against a backdrop of a strong economy and labour market. Heading into 2025, a US recession is now rising up the list of investors' concerns. Historically, the precondition to a deep recession is excessive activity in some sector of the economy. In other words, a boom precedes a bust. Crucially, in the current cycle, we haven't seen the troubling levels of booming activity that have been present before other recessions. The US household sector is in better shape than it has been for much of the last 2 decades, and corporates have also been paying down debt since the pandemic. While the US economy is on a cooling trajectory, the health of the private sector provides some comfort that any downturn is likely to be shallow. Cooling inflation is also allowing the Fed to take its foot off the brake. Indeed, financial conditions have already eased, with 30-year mortgage rates and credit spreads both moving lower. See tables and charts in the free ebook, US Goods and Services Inflation. Government spending, however, is one area where there is more evidence of a boom. This is where the US election comes into play, given the implications for taxes, tariffs, and immigration. The US government is already running a substantial deficit with debt relative to the size of the economy at its highest level since the Second World War, and both are projected to grow. Despite this, both the Democrats and Republicans are talking about looser fiscal policy under the next administration. If the next president gains sufficient control of Congress to enact their fiscal policy plans, investors could become increasingly wary about the prospect of higher inflation once more. Immigration is the other key election issue that could directly feed into inflation via the labour force. Interestingly, in the last couple of years, roughly half of the growth in the labour force has come from foreign-born workers. Limiting that supply might make the unemployment numbers look better by reducing the number of people looking for work, but this would likely come with higher wage growth, once again bringing investors' minds back to the potential for upward pressure on prices. The UK's new chapter. Across the Atlantic, the UK is on a cyclical upswing, aided by easing inflation. Combined with a sense of post-election stability, consumer sentiment has been improving. The Bank of England looks set to continue cutting interest rates, though likely more slowly than the Fed, as it needs to keep a closer eye on inflation. The labour market is the key point of difference. In the US, labour force participation has recovered strongly post a pandemic-related dip, helping to cool wage pressures. In the UK, participation is still well below pre-pandemic levels, in part due to an increased number of workers claiming ill health. With fewer workers to fill open vacancies, workers are continuing to capitalise on their improved bargaining power to negotiate higher wages. See tables and charts in the free ebook. Labour force participation rates. Europe feels China's pain. The outlook on the continent is more mixed. Despite an improvement in real incomes as inflation has eased, European consumers remain cautious. With confidence still fragile, consumers have been using stronger incomes to save more, rather than spend. Another big issue for Europe is that global manufacturing remains incredibly weak, which has been a real headwind for Germany in particular. China's role in the weakness in global trade and goods prices is increasingly clear. Against a backdrop of weak domestic demand, China is sending excess supply into the global market at discounted prices, creating challenges for European competitors. The auto sector is a prime example. It's a highly important industry for Germany, and Chinese brands have been gaining significant market share, particularly in electric vehicles. China's consumers are yet unmoved by economic sweeteners. Europe is not the only region where consumers are feeling gloomy. In China, a pandemic rebound never really materialized, and with the labour market still soft, consumer confidence remains close to rock bottom levels. The root of the problem may still be the property market. 2/3 of Chinese household wealth is in property, and prices are still declining. In many big cities, property prices have fallen double digits, up to 25% in some areas. The government is trying to address the issue with a new stimulus package. While many of the announced measures have been seen in isolation over the last 12 to 18 months, the coordinated nature of the autumn announcements is the clearest signal yet that Beijing stands ready to support the economy. The challenge is that the new stimulus measures are largely focused on making debt more enticing to consumers. In my view, debt can be a little like cake. Once you've eaten too much of it, it doesn't matter how good it tastes because you just don't want any more. If the government can find a way to clear the excess supply in the property market, Chinese consumers might have more ability to help the economy recover. See tables and charts in the free ebook, Chinese Consumer Confidence, Taking Stock. As the balance of risks for the global economy shifts, so must equity investors. In recent years, the US market, driven by a handful of mega-cap technology stocks, has dominated global equity market performance. Narrow market leadership has been somewhat justified by incredibly strong earnings delivery. Yet looking forward, there is now evidence of earnings broadening out across a wider range of sectors. The logic of recent market dynamics appears somewhat flawed. A small group of companies have surged higher on a wave of AI-related enthusiasm, while many others have stood still. If we really are about to embark on the next digital revolution, the productivity gains from new technology should be flowing through to other sectors of the market and boosting the earnings expectations of many non-tech stocks trading at much lower valuations. If instead AI proves to be more hype than reality, the gap between the megacaps and the rest should still close, but with the tech stocks catching down, rather than the others catching up. Either way, the case for the US market to become less dependent on a handful of names is clear. See tables and charts in the free ebook. Forward PE ratio of the S&P 500 top 10 versus the rest. The UK and European equity markets continue to lag the US market in both performance and valuations, but the technology sector is not the only culprit. It's true that technology stocks have had an outsized impact on US equity market performance, and that the European and UK markets have comparatively fewer technology companies. They also have more banks and energy companies, which tend to have lower valuations. However, in both the UK and Europe, almost every sector is trading at a larger than average discount to its US counterpart, and herein lies the opportunity. Investors can use a global mindset to look for companies with perfectly good fundamentals, but that are trading at a discount simply because of where they happen to be listed. Emerging market stocks have bounced strongly in the fourth quarter on hopes that recent stimulus announcements will prove effective. However, to sustain that momentum will require more than a short-term boost in sentiment. A pickup in domestic demand that drives company fundamentals and earnings upgrades is critical to the longer-term performance of Chinese stocks. In other words, medium-term performance needs to be driven by earnings, not just valuations bouncing off a low base. A balance of risks. For equity investors thinking about how to adjust their portfolios in 2025, it all comes down to the balance of risks shifting. We don't think that the US economy is about to slide into a deep recession, or that the best-performing US technology stocks are untethered from reality. However, we do recognise that the US market has generally been outperforming other equity markets for years and allocations may have swollen. An investor who allocated 50% of a portfolio to US stocks in 2010 and 50% to non-US developed equity markets and didn't make any changes would now have a 75% allocation to the US. With attractive valuations in other parts of the world and some risks including the outcome of the US election, some portfolio rebalancing wouldn't go amiss. Hugh Gimber is responsible for generating research-driven analysis on the global economy and markets, and communicating this to JP Morgan's clients and the media across the UK and Europe. Resilient but volatile. Paul Niven, the manager of F&C Investment Trust, explains how the UK's oldest investment trust sees the outlook for global markets. How would you characterise the way that the markets have developed over the past 12 months? It has been a good period for financial markets and a strong period for equities in particular. The S&P 500 index is up by over 30% in the 12 months to the beginning of October. The Nasdaq, being more technology-focused, is up around 35%. The Magnificent Seven, around 60%, and Nvidia, the maker of AI chips, up 180%. This narrow cohort of leading disruptive technology stocks have produced some quite spectacular returns. It's been another period where the US market, largely driven by the dominance of those large global leaders in technology, has led the way, exceeding the gains in Europe, the UK, Japan, and emerging markets. In contrast, the European economy has once again disappointed. Some other key themes of the last year include weakness in the US dollar, driven in part by the result of differences in the interest rate cycle. Sterling has certainly been relatively strong against the dollar, and that to some extent has reduced returns for sterling-based investors. Bond markets have performed well too. Spreads have remained tight in global credit, and there's been a general downward move in government bond yields. After a period of zero interest rates in recent years, we experienced quite a marked increase in government bond yields as central banks raised interest rates, but since last year we've seen yields peaking and drifting lower. 10-year yields in the US are down from about 4.3% to the 3.7 to 3.8% range, and gilts from 4.4% to around 4.0%. The lower yields are a function of the interest rate cuts coming through in the US and Europe. The Bank of England is moving into rate-cutting mode too. At the same time, there has been an increase in volatility in markets. In the last few months, we have seen the re-emergence of concerns about slowing growth, specifically relating to a possible recession in the US economy. The surge in share prices of Nvidia and other names associated with AI has taken the equity market to new record highs, while also raising concerns over valuation levels being excessive. However, despite the uptick in volatility, markets have been very resilient. What thoughts do you have about the seemingly endless debate about the kind of landing that the US economy is likely to face? Soft, hard, no landing? We're in a period when interest rates are coming down, having been raised materially and held high for an extended period. Typically, when central banks are cutting rates, it is a positive environment for equity returns over the next 12 months, assuming, and this is important, that we see a soft landing in the US economy. If rates are being cut aggressively because growth is slowing materially and we're heading into recession, it's obviously not a great environment for equities. But if we get a combination of rates coming down while growth remains reasonably robust, albeit slowing from historic levels, it is a positive outlook for equities. If one looks at data since the 1950s, typically rate cuts combined with an economic soft landing result in equity market gains in the region of 20% over the next 12 months. The past is not, however, a perfect guide to the future. One noteworthy point is that equity markets have performed well in the run-up to rate cuts, which is somewhat unusual. It may be that a lot of the gains that one would normally expect in equity markets from here have already been experienced. There are some signs of modest weakness in the US labour market, and some indicators such as the yield curve and the rate of change in unemployment, which suggest that a harder landing may be more likely. On balance, I think the odds are that we will have a soft landing and a recession is avoided, which is a reasonably constructive environment for equities when rates are coming down. The other point, though, is that the market is already pricing in expectations of further significant interest rate cuts. The US Federal Reserve cut rates by 50 basis points in September, which was slightly more than expected, but the market anticipates further cuts of up to 200 basis points in the US by the end of next year. That is relatively aggressive in terms of expectations, especially in an environment where there isn't a marked slowdown in economic growth. Do you think that inflation has indeed been licked, and we're going back to a 2% target inflation world? I think we're getting closer to that point. In the UK, we are not far off 2% already. The US is still running slightly above target. Even if we're not yet at or around central bank targets in terms of inflation, we are probably going to reach that level, given the slack in the economy, over the coming year. Economic data regarding inflation in general is heading in the right direction, and again supports cuts in interest rates. Do you have a strong view whether AI is a bubble or telling us that something really important is happening? It is difficult to make an argument that large tech offers significant value at these levels. A lot of excitement is already reflected in share prices in terms of future growth expectations. However, comparisons that continue to be made with the internet bubble in the late 1990s are, in my view, misplaced in the sense that we have real businesses which are extremely profitable and throwing off a huge amount of free cash flow, leading the way. The question is, how much should you pay for these businesses, however fast-growing they may be? I think that valuations look stretched on any historic norm, but if these companies can meet growth expectations, then future returns are not going to be materially impeded. That said, we've come from an environment where it's been difficult to bet against these companies in recent years, given how dominant they have become in terms of their market position, how they've been able to maintain and increase profit margins, and how they've been able to move into new and profitable areas outside their core business model. Microsoft is clearly one example of that. Amazon is another, moving away from retail into web services. Furthermore, there will be significant opportunities for enablers of wider AI adoption, and the scale of investment in these capabilities provides these tech giants with a competitive edge. How have you reacted to this period of dominant tech performance? Looking ahead, I expect US equity market performance to broaden out away from the recent market leaders. In fact, this is already happening as those leading names begin to lag the market a little. In F&C Investment Trust, we have been balancing out the exposure between growth and value because growth stocks do now look expensive and expectations there are high. The balance is a complex equation, however. An interest rate cutting environment at a time when both economic and earnings growth may be declining tends to be an environment where growth stocks do relatively well. If growth becomes a little bit more scarce, value stocks, along with small cap, may fare better. Ultimately, in such an uncertain environment, I think that a more balanced approach across sectors and styles is the right way to be at present. Turning to currencies, there's been a potentially significant change in Japanese monetary policy that is beginning to have an impact on the yen. Is that a significant factor for you? I think analysing equity markets is hard enough already. Movements in the US dollar and the Japanese yen are important to us, but currencies are impacted by a range of risks, many of which you are not, generally, rewarded for taking. The yen has for a long time been a funding currency for what's known as the carry trade. In other words, investors borrow yen, paying what has been historically low interest rates, and then convert the yen to a higher yielding currency for investment. Now we're entering an environment where rates in other developed markets are heading down, while those in Japan are heading up, albeit marginally, and the market is expecting more increases to come. That divergence in terms of monetary policy is one of the key factors behind the recent pickup in volatility in markets. For example, the Nikkei 225, Japan's leading equity index, dropped more than 10% in just one day earlier in the summer. Frankly, I don't have a strong view from here. A substantial rally in the yen leading to a big unwind of global carry trades will take people out of risk assets such as equities and would obviously be a negative for our portfolio. The bigger issue, though, for us is what happens to sterling against the dollar. F&C Investment Trust only has a very small portion of its assets invested in the UK. Most of our assets are overseas, and the majority of those assets are invested in dollars. We've had quite a rally in sterling as the dollar has weakened, and I think there is scope for sterling to continue appreciating modestly from here. What are you doing about that? While we have sometimes taken currency positions to hedge against sterling strength, we're not doing so currently for two reasons. The first is the general unpredictability of currency movements. One has to be very confident of future moves before hedging currency exposure. The second is that I don't think further appreciation in sterling, while a slight negative in terms of overseas returns, is going to be a major drag as we stand today. The reason for expecting a bit more relative sterling strength against the dollar is that we expect less aggressive cutting from the Bank of England than from the Fed, given our view that the UK economy for the first time in a while looks relatively robust. As a global trust, F&C is essentially competing against global index trackers, as well as other global funds. How do you define your basic proposition to investors against that background today? You're right that there are a whole range of competitors which people compare us to. I think anyone in the active management business has to be very mindful of the competition that low-cost passive products provide. Clearly, our proposition is essentially a one-stop shop, or single portfolio solution, for investors looking for a global exposure to growth assets, so we cover listed as well as private equity, and we look to deliver long-term growth in both capital and income. We are also diversified. That has been a hallmark and key feature of F&C throughout its history. It goes back to the very origins of the trust in 1868, and its aim of providing a solution for the investor of moderate means. In today's terms, that is the private or retail investor. My view is that retail investors should be looking for broad diversification. Now, whether they seek to achieve that diversification by bundling together different products that they select themselves, or by buying a single product which becomes the cornerstone of their portfolio, is up to them. We look to provide that cornerstone for investors. We are an active manager, so we provide value-adding decision-making across all different components of the portfolio, including geographies, styles, and sectors. We are also cost-effective, with an ongoing charge of just 49 basis points, 0.49%, which is very competitive against our peers. Our performance credentials are also strong. At the end of August, our 10-year return to shareholders is over 12% per annum, which has been consistent long-term performance ahead of the benchmark, as well as the majority of our closed and open-ended peers. The final point I would make is that we're not a high-yield or high-income trust, but we do have a very long history of not only paying a dividend every single year since 1868, but also delivered 53 years of consecutive increases in dividends. The fact we have been around for over 150 years should tell prospective investors that we have a robust corporate structure that stood the test of time. The independence of the board ensures that we always do the right thing for shareholders. You have an allocation in private assets, although your benchmark is still a listed equity benchmark. How do you decide how much to invest in private assets, and what is your strategy as far as private assets are concerned? Even though we are a closed-ended fund, we need to be mindful of effective use of capital and potential liquidity requirements, and that helps determine the appropriate amount we invest in private equity. Listed equities can be highly volatile, and in periods of stress share prices can fall very sharply in value. When this occurs, all things being equal, that pushes up the proportion in private equity exposure. Hence we have to be mindful of our overall weighting to listed and unlisted assets. Why do we invest in private equity? There are numerous opportunities in private markets, and our experience through time is that private equity can deliver excess returns compared to public market equivalents. We want to have a sufficient allocation to private equity so that it's accretive to overall returns, but not problematic or disruptive in the event of a big down move in listed markets, or at a time when we want to be buying back shares, since obviously buybacks can only be funded out of cash or liquid assets. We have concluded that a range of 5 to 15% is the most appropriate allocation to private equity. In the last 20 years or so, we've consistently had that amount of exposure, and we're currently around 11 to 12%. In general terms, it's worked well for us, though it has to be said less well in the last 12 to 18 months, as listed markets have delivered strong returns, and private equity has lagged. We've got different components within our private equity allocation. We invest in primaries, secondaries, and also in co-investments. If we are investing into single-name co-investments, we source those opportunities within Columbia Threadneedle, but we also use Pantheon to provide a bespoke portfolio of leading managers in early-stage venture and growth investments. If you want to participate in venture capital and early growth, one really needs to be aligned with the best performers in that space, as the returns are very dispersed and average returns are not necessarily that attractive. One needs to be where there is evidence of consistency and persistence of return, and Pantheon provide us with that access and exposure. Looking at the performance of the trust over the last 12 months, would it be wrong to summarise it as NAV good, share price disappointing? Well, the share price return over the last 12 months has been over 20% as we speak today. That is disappointing relative to our navigation. But I don't think that return is bad at all, so I can't let you get away with disappointing. What I would say is that we have seen a widening in our discount, and that has been disappointing over the past year. We traded at a premium and issued shares back in 2018 and 2019, and as recently as the first quarter, 2023, we also traded above NAV. As we talk today, our discount is around the 9% level, having widened from a 5.3% discount at the start of the year. That has been detrimental to shareholder returns. Our aspiration is to trade close to a NAV, so we have stepped up buybacks. Year to date, we've bought back about 19 million shares, which is a material amount, about £190 million worth. We also have been undertaking more marketing to encourage wider and deeper share ownership from new and current investors. We've developed an extensive advertising campaign, as well as attended events with shareholders, wealth managers, prospective shareholders of all kinds. How do you explain the fact that your discount is currently wider than some of your peers in the global sector? I don't mean to sound glib, but the fact is simply that sometimes supply just outweighs demand. It's not occurred for performance reasons because our performance has been good in absolute and relative terms. I think it has been a broader issue. It could be people acting ahead of potential taxation changes, for example, or a function of child trust fund holdings maturing. It is hard to isolate one reason for the widening in our discount. If one looks at our performance while we have delivered better returns, we are trading on a slightly wider discount than most of our peers. I prefer to interpret the current situation as anomalous and offering value for investors, a great buying opportunity. In terms of the portfolio, what changes have you been making? There's not been huge changes in terms of the geographic positioning. The majority of our exposure remains in North America. We have leveled up the exposure between growth and value. We sold a lot of growth stocks from mid-2020 through to the end of 2022, but then we leveled that up somewhat in the latest period. We lightened up on emerging markets, where there had been ongoing disappointment in China. We have added a new global focus strategy run by one of our colleagues in Columbia Threadneedle, and we continue to make selective private equity investments. How do you decide how to allocate between the different strategies you include in the portfolio? I've been manager of the trust for just over 10 years and working for the manager of F&C for more than 20 years. The name of that management house has changed more than once in the last few years, but F&C's philosophy and approach, targeting both public and private equities, has been consistent over that time. Columbia Threadneedle, which has the management contract for the trust, has more than $600 billion globally under management and a huge spread of resources. But if I think I can do better for a specific strategy, I am free to use a third-party manager to invest that component of the portfolio, which I do for certain aspects of our US equity exposure, for instance. Using selected in-house strategies from Columbia Threadneedle, supplemented with what we view as best-in-class third-party exposure, enables us to deliver a more cost-effective solution than you would get from a mandate which solely invests in third-party managers. As the asset manager, we get paid on the market capitalization of the trust and not the net or gross assets, so that enables me to be objective about choice between internal and external managers. We don't get paid any more or less on different components in the portfolio. What is exercising you at the moment? Where do you see the major risks? There are always numerous things to worry about, but overall I am relatively optimistic with respect to the outlook for financial markets. The reason, as I said earlier, is that we are in a rate-cutting cycle, and I think the growth outlook is reasonably good. But any number of things can go wrong. Clearly, the macro perspective may well not be as positive as I currently envisage. It is entirely possible that the market is too optimistic in its current view on the path of interest rates. Maybe inflation's a bit stickier than we currently assume, and maybe interest rates don't come down as much. Whilst a soft landing is my central case, one shouldn't discount the more negative outcomes. The current consensus on the earnings outlook is relatively optimistic. Analysts are, however, often too optimistic, and they are currently expecting around 15% earnings growth in the US next year. If earnings turn out to be significantly worse than expected, that creates a headwind for equities. The final point is something that is obviously looming large, which is politics and geopolitics. The US election in November is potentially going to create more volatility for equities and currencies, and geopolitics in the Middle East and Ukraine continue to present a risk. Does that suggest that people should have more bonds and gold alongside a core holding in F&C? Well, considering where government bonds are trading at the moment, there is not great value to be found. 10-year US Treasury yields are currently at 3.75% as the market has already priced in 2.5% of further rate cuts. If you look at what that would imply for future yields, given a normal term premium on 10-year yields, I would argue that they do not look that attractive unless we fall into a recession. Gold is pushing on to record highs and may have some further upside as rates decline, but I prefer equities over gold from a strategic perspective. In the last 3 years, we've seen 2 of the veteran global investment trusts disappear. We lost the Scottish, and now we're losing Wheaton. Tracker funds continue to grow bigger, so even the venerable F&C has to stay on its toes and keep justifying its existence. Would that be a fair comment? Yes. It's perhaps a little bit of a cliche, but the reason that we have survived and thrived for over 150 years is that successive boards have put shareholders first. They have always needed to adapt and move with the times, changing the investment proposition as appropriate to ensure that we're fit for purpose in terms of what shareholders deserve. Today, our value proposition is delivering higher capital and income returns than numerous comparators, while doing that in a cost-effective manner. Delivering performance is ultimately the raison d'etre of the trust, so your point is well made. We definitely are in no way complacent. Paul Niven has been managing the F&C Investment Trust since July 2014. Discount upside remains. Manager of AVI Global Trust AGT Joe Bauernfreund says there is still plenty of room for discounts to narrow across the investment trust sector, and in the other global markets it targets for bargains. When we spoke last year for the handbook, you were very excited about the discount opportunities that were appearing across the globe. How has that situation played out since 12 months ago? I think it's played out very well, and mostly in the way that we anticipated, although we were surprised by the continued strength in those Magnificent Seven stocks. There's been an abundance of opportunities in areas of the market that have been overlooked for many years, and opportunities for us to exploit undervaluations through shareholder activism and benefit from specific corporate events. It has really been across the board, not only in the investment trust space, but in Japan and also amongst family-controlled holding companies. Your own share price started off very strongly this year, and then it has retreated somewhat. What do you think is going on there? Is that just normal volatility, or some other factor? It is just normal volatility. It reflects what I was saying in the previous question, that parts of the market have been very strong and have led the broader market indices up. But beneath the surface, that hasn't been the case. When you look at the market cap-weighted indices on the S&P index, or the MSCI World, relative to an equal-weighted index, you've seen a big disparity in performance, and our performance reflects that. Our gearing has been fairly consistent over the year in the range of 5 to 10%, so no big changes there, and no big changes to the broad underlying allocations to countries and sectors. So it's really been a market factor. Let's take the three main legs of your portfolio in turn. Let's start with the listed investment trusts you own. What changes have you made in the portfolio with the bigger holdings you have? I guess the big change in recent months has been the exit out of Hypnosis Song, which at the halfway stage was our largest holding, and where we were the largest shareholder, and played an active part in the campaign that led to a takeover of that company, that brought back 8% in cash. The areas that primarily interest us are those where investment trusts have unlisted assets, and so the valuation is less certain. That also includes the real estate sector, where we've seen a fair bit of activity, including the takeover of Balanced Commercial Property Trust, BCT, in which we were a shareholder, and PRS REIT, PRSR, where there's activism going on. We've had a couple of others as well in the portfolio. We've also boosted our holding in Chrysalis, KHRI, and are now the largest shareholder there as well. We see some potentially quite exciting developments at the portfolio level there, as well as on the corporate governance front, with their commitment to return cash to shareholders, or buy back shares once they get to a certain threshold of cash on their balance sheet. We've seen some improvements in capital allocation policies in listed private equity names, with the commitments from Pantheon and Partners Group Private Equity, formerly known as Princess Private Equity, to allocate a portion of free cash flow to share buybacks. So yes, there is lots of opportunity, there's a little bit more interest in the sector than there was perhaps a year ago. There's more capital around and more willingness on the part of investors to be proactive, which is helpful to us. The consolidation in the real estate sector, for example, has been a big positive. We seem to be saying goodbye to most of the diversified commercial property trusts, which many would say have been a bit complacent, but they have still gone out at a discount to NAV. Does that raise a general question about whether their NAVs are really correct? You're right that they are going out at the small discount, 7 to 8% in the case of BCPT. I think it reflects the fact that the NAV is for a broad diversified portfolio, and within that you've got assets that could be realised for a little bit more than the net asset value, and assets that could probably be sold for a little bit less than the net asset value. If somebody's taking a wholesale approach to buying the entire portfolio, they probably want a discount in order to reflect that uncertainty and that risk that they're taking on board. From a shareholder perspective, the alternative would be to sell those assets at or above NAV over the next 2 years. But then you will have 2 years of risk, and your capital is tied up in an ever-shrinking and ever-diminishing quality portfolio, so it's a balance. I'm not sure it necessarily suggests that the NAVs were wrong, but it's a commercial outcome. Some of the deals in the commercial property sector, for example the recent Segro Tritax Eurobox deal, have been in the form of all-share mergers. Are you generally for or against all-share mergers? Or do you prefer to get some cash? The Eurobox deal is underwhelming. The shareholders are getting shares in Segro, and clearly they could buy shares in Segro themselves. I think they'd rather take cash and decide what to do with it. But clearly they can sell their shares too, so it's not a great problem. Cash is our preferred outcome in these situations. Is there any sort of general read across one can take from the fact that, in the case of Song and other recent corporate activity, we have seen non-UK players coming in to take these assets out? Does that say anything about the UK equity market? These are non-UK investors, but mostly they have funds that are focused on the UK, so I am not necessarily sure it says that much about the UK. Clearly the UK stands out as being good value, and there's a lot of opportunities. There is, as you say, more interest from foreign investors in our market, and that extends beyond the investment trust space. There's a general consensus that the UK market is cheap. Yes. So all of that is quite encouraging. Do you see more opportunities for activism still in the UK listed investment trust arena? Very much so. Do you agree that when it comes to corporate governance, some boards have not been as pro-shareholder as you would like? Correct. You are absolutely right. I think there are cases where boards have demonstrated that they're acting in the interest of all shareholders. But as you suggest, there are situations where boards seem more focused on their own job than they are on shareholders. In terms of the way you construct your portfolio, how do you balance out the large chunky positions you have against smaller tail positions? The starting point from our side is that we want to have a very concentrated portfolio, no more than 30 names. That suggests that every holding is going to be around about 3%, but the reality is not all situations are liquid enough for us to be able to acquire a 30-minute holding. so the sizing very much reflects the liquidity in the share. BCPT was around a 1.25% holding for us, relatively small, as you suggest. That is a function of two issues. One is, are we able to acquire a sizable stake at the right kind of price? And the other, against that, is that we're always considering if we are wrong or if we want to exit or need to raise cash. Are we able to do so? It is really about finding a balance at some level. We do cross a tipping point where we have a very large stake, as in Hypnosis, as in Chrysalis, because although that stake is relatively illiquid and we certainly couldn't exit it in a short period of time, the size of the stakes gives us seats at the table, and that puts us in a stronger position to effect an ultimate change of control, or an event that crystallizes value for us. That's really how we think about it. In the case of Chrysalis, what were the factors that drove your interest? Was it changes to the fee structure, the new independent management structure, or the quality of the assets that was most important? It's a combination of those factors for us. I think there's a recognition that the market for potential exits from the assets they own has turned a corner, and we are approaching a number of sizable exits. The performance of those underlying businesses suggests that any exits could be positive for the NAV. There has been a lot of disappointment, you've had some governance concerns, and with very disappointed shareholders, you obviously get a lot of skepticism, and that translates into a very wide discount, but that is the kind of opportunity we like. We've done extensive work on a number of the larger underlying portfolio companies. We're reasonably confident that there will be corporate transactions in coming months, and that will lead to a return of capital to Chrysalis. They're committed to buying back shares, so we've seen an improvement on the governance side of things as well. As for listed private equity trusts, you've reduced your holdings in Pantheon International, PIN, and increased that in Partners Group, formerly Princess. What was the logic behind those two moves? We began to become more interested in the listed private equity space 2.5 years ago. We had a basket of different holdings when, towards the end of 2021 and throughout much of 2022, markets sold off, and that was reflected in listed share prices and discounts. The basket shrunk in size as we built large positions in things like Partners Private Equity and Pantheon, while we exited from other ones more recently. So we've been switching that around a bit, and we were buying Pantheon on a discount of around 45%, and that's narrower today than it was. They've implemented very strong corporate governance measures in terms of buyback and a commitment to spend cash on buying back shares, rather than making new investments, all of which is really reflective and symptomatic of improved corporate governance in the sector. Can you see discounts on listed private equity going narrower if they stick to the approach you've talked about? We still like the sector, we still have conviction in the NAVs supported by what we see in the secondary market. The discounts are still wide, they could go narrower. You can construct an argument that they should trade at around a 20% discount. That would be reasonable to us. We don't expect to sell them at a premium. Before we leave the investment trust sector, what has adding MIGO opportunities to your stable done for the business? What was the logic behind that deal? The board of MIGO were looking for a new home for the managers, Nick Greenwood and Charlotte Cuthbertson. They are well known to us, and this is a very good home for them, in the sense that they are long-standing and well-regarded investors in the investment trust space. Having another investment trust in our stable and adding to the investment trust research resource in AV, that was a good opportunity. I'd say it's starting to bear fruit already in terms of cross-collaboration as the two teams are integrated. PRS REIT, for example, where we have been active in putting 2 new non-executives on the board, is not held in AGT, but it's in some smaller accounts and in MIGO as well. Turning to your Japanese holdings next, a year ago you correctly thought there was going to be a change in monetary policy, but you weren't sure when. Well, the trend towards improved corporate governance has also continued, so it is working out well. My perspective on Japan is largely driven by the bottom-up situation. It is very much focused on individual companies and activism for corporate governance reform. On all those fronts, we see positive trends, and they've been reinforced over the course of the last 12 months, and are stronger than ever, I would say, in terms of the commitment by companies to do more for shareholders. The monetary policy shift is a relief for us, because the moves in the yen over the last 3 to 4 years have been painful. It's clear from the Bank of Japan's actions that interest rates have started to increase and will probably increase a little bit more. We're not talking about massive increases, we're at 15 basis points. I don't see them necessarily going above 1% in the next 12 months. It is the direction of travel, and direction of travel relative to what's going on in the US, where we're likely to see a number of interest rate reductions over the coming months. That is important. We are seeing the first glimpse of the impact of that in global capital flows and risk appetites. We're seeing some repatriation of capital from outside Japan into Japan, and that is having an impact on equity markets. From a fundamental perspective, our kind of companies are very domestically focused. The weak yen hasn't really impacted their profits to a great extent, and so a strong yen is unlikely to have a major impact on their profits. It is much more about the fact that inflation in Japan is coming back. There is a more efficient bond market, one that is less distorted by yield curve control, and wages are going up, which means that consumers have more money in their pockets, and hopefully economic growth in Japan can grow. So Japan remains a key area of focus and a land of abundant opportunity for us, in terms of what we're looking for in fundamental valuations and the opportunity for engagement. The team here is growing, so we're likely to continue to find lots of opportunities. Will there be much of a shift in your portfolio? I would think more of the same. A year ago, though, we had exposure to a number of regional banks in Japan, and that was a play both on fundamental valuations and shareholder activism, but also on improving interest rates and monetary policy. It played out pretty well, and we've been exiting those and allocating that capital, still within Japan, but to more mainstream AVI situations. You referred to foreign investors being interested in the UK market. We have the same phenomenon in Japan. Japan is a market that has had many similarities with the UK. Nobody cared that it was cheap. Nobody was buying it. It was a small, insignificant market, and investors have lost money there for years, so nobody was looking at it. Increasingly, we've seen all the big global private equity houses take a presence in Tokyo. They've been pretty active. You have a potential hostile takeover bid for the 7-Eleven group in Japan, led by a Canadian group. We will see whether that goes through. All the private equity houses are trying to jump on that bandwagon and get involved in that transaction. That is encouraging because it shows that although we've been through a decade and more, where fundamental valuation metrics didn't matter and it was all about capital going into the highest growth, most exciting businesses, we've now seen something of a return to fundamental value, and that is a better environment for us. We see that in the UK, we see that in Japan, and we see that in the investment trust space. How is the other theme in your portfolio, the holding companies you own, working out? Discounts amongst holding companies, whether they're in Europe, in North America, or in Asia, are at the wider end of their historic ranges. That is interesting in itself, but it's not necessarily interesting enough. Our approach over the last couple of years has been to look for companies where management and the family have worked to the benefit of all minority shareholders, not just the family, and there's been no abusive control or power enforced against us. We're interested in those that have got good quality businesses that we can be confident are going to continue to grow in value. We're obviously interested in discounts being wide. There are lots of opportunities that tick those boxes, but the key really for us is a fourth factor, and that is where we think something is going to happen in the reasonably near term. What I mean by that is situations where management and/or other family shareholders are bothered by the discount, so have initiated and implemented strategic reviews to address it. Those then lead to some kind of corporate transaction, which in turn can deliver idiosyncratic returns, regardless of what markets do. That has been increasingly the focus for us. So last year, big names under that banner would have been Schibsted, the Norwegian family-controlled media company that's active in online classifieds businesses across Europe, and FEMSA, the Mexican company that owns low-cost convenience stores throughout Latin America, both of which had strategic reviews this year. Our largest holding is News Corp, Rupert Murdoch's family holding company. They are the controlling shareholder in an Australian business called REA Group, which wants to make a bid for Rightmove here in the UK. News Corp may raise eyebrows for some, but we think the family is very focused on the strategic review and has been pretty vocal about the need to address the structural discount at which it trades. We are also interested in the situation at Christian Dior, the family-controlled holding company, listed in Paris, which owns the Arnault family's approximately 40% stake in LVMH. LVMH is the only asset within Christian Dior and the family own 98% of it, but we don't expect it to be there forever. The family tried to privatize it some years ago. The free float, the 2% or so that exists today, represents holdout shareholders who refuse to sell. At some point they will be squeezed out and the family will control 100% of it. Christian Dior trades at a 20% discount today to the value of its stake in LVMH, so that's an anomaly which we think is worth having because at some stage we ought to see that 20% gap closed. And then you've got the question of what's going on at LVMH itself. From a stock market perspective, they've suffered a bit of a de-rating. But we think the shares are good value today. LVMH is in the process of going through a generational transition. Bernard Arnault's 5 children all work in the business. I suppose only one will ultimately take over, but he's still very much involved, certainly for the next few years, and it's just a fantastically run business with 70-odd different luxury brands. Where else in the portfolio have you made significant changes? We've been increasing our stake in Bolloré Group, the French holding company. Again, it's one of these very archaic, very convoluted ownership structures, but it's a pretty straightforward situation. Vincent Bolloré and his family control this company. For the first time in their history, they're sitting on a huge amount of cash, having sold some private unlisted assets in Africa, logistics and ports businesses, and alongside that big pile of cash, they've also got a 29% stake in Vivendi and a stake in Universal Music Group, which we're pretty positive on as well. Vivendi itself is going through a structural reorganisation in order to address the discount at which it trades, and that will see it split into 4 different companies, and ought to see a narrowing of its discount, which will feed up to Bolloré. We suspect that once Bolloré has implemented the split, it makes it more likely that he can cherry-pick the one business that he wants to own fully. So that's one dynamic, but the fact that he's got cash means that share buybacks are also very much on the cards. They've started their buying back. The shares are close to a 50% discount. It's a fantastic way for the family to increase their ownership of the group without putting their hands in their pockets, and we, as shareholders alongside them, will benefit from that accretion. We've also got a position in SoftBank Group, which has been in the news recently. SoftBank Group has got a big stake in Arm, which was very strong after its IPO, but has come under some pressure in recent weeks, along with the rest of the tech sector. The story with SoftBank is very much focused on the discount, and consequently we've created a hedged position whereby we're exposed to the discount narrowing or widening rather than to the valuation of ARM and some of the other assets it owns. They're trading on a rare 60% discount to NAV. Elliott management recently announced a large stake and have been pushing the company to do a large share buyback. So far the discount hasn't really narrowed. This is very much a play on the fact that the interests of the founder, Masayoshi Son, who owns around 30% of the company. He is aligned with us, in the sense that buying back shares and narrowing the discount increases his ownership of the company without him having to dip his hands in his pocket. Turning to the outlook for the trust itself, you again have highlighted the double discount. That on the assets you own, which is wide by your standards, and that of your own shares, which are also trading at a 10% discount. Could you be doing more to change that? I think it's fair to say that we'd like to see our discount narrower than where it is today. We don't have an explicit discount target level, and it's the board that are directing the share buybacks. It has been in the 8 to 10% range over the last year. We'd be very happy to see it at much narrower levels. We think the long-term performance, relative to the rest of the peer group, and the fact we're doing something very different to the rest of the peer group warrants us being on a narrower discount. I am sure we will continue to buy back shares, although over the last few months we've probably done a little bit less than we've done in recent years. Even though you say you don't take notice of a benchmark, you have still changed your benchmark. It was MSCI World X the US. Now it is MSCI All Country World Index, which includes the US. Why bother if it's not that relevant? The thinking was that, notwithstanding saying that it's not relevant, investors had noticed that our exposure to the US, which for many years had been very low, if not zero, had been creeping up. It stands today in the mid-20% level, so very much below the benchmark, but still very much above zero. They felt that the World Index was more reflective of the mandate that investors had in mind when they pick a global trust. Although our portfolio is very different, both geographically and in terms of underlying exposure, we recognise that over a multi-year period, we should be aiming to deliver a better return than the World Index in order to justify our existence. You have delivered double-digit annualised returns over many years, but can you maintain that record given the many uncertainties of the global macro outlook? The macro looks very uncertain most of the time, and you can always find things to worry about. But from our perspective, we're still finding a lot of good quality businesses that have good growth potential and are trading at very low valuations. So we see the potential for double-digit annualised compound returns to continue, given some normalisation in valuations. It's certainly not a point in time where I would feel we want to have lots of cash and be worrying about valuations. That's not to say that the broad market outlook at the moment necessarily looks that rosy. There are concerns around the valuation of some of the tech names, and at the first sign of trouble, you can see those fall sharply. When valuations are high, it doesn't take much to spook investors. But from our perspective of activism and a focus on events, starting valuations today look pretty compelling. Joe Bauernfreund has been manager of AVI Global, AGT, since 2015. Asset value investors also manage AVI Japan Opportunities Trust, AJOT, and MIGO Opportunities, MIGO. Investor Forum. We asked some of the most experienced professional investment trust investors we know to give their answers to some topical questions. Who's who? Alan Brierley is the Director of Investment Company Research at Investec and has covered the sector since the early 1990s. Richard Curling is an Investment Director at Jupiter Fund Management and manages the Jupiter Fund of Investment Trusts and Jupiter Monthly Alternative Income Fund. Nick Greenwood is the manager of the WSAVI Worldwide Opportunities Fund and MIGO Opportunities Trust, both of which he has managed since launch in 2003 and 2004, respectively. Peter Hewitt has been managing CT Global Managed Portfolio, a fund of investment trusts, since 2008. Alistair Laying is CEO of CG Asset Management and a co-manager of Capital Gearing Trust since 2011. Anthony Leatham has been head of investment trust research at broking firm Peel Hunt since 2015. Which trusts have been the most creditable performers over the past 12 months? Alan Brierley. We don't tend to obsess about short-term performance, but I would highlight the achievements of JP Morgan Global Growth and Income, which has delivered strong absolute and relative returns over the past year. More importantly, it has comfortably outperformed what is a challenging benchmark over the past 5 years. Richard Curling. The past year has seen strong returns across the investment trust sector in spite of discounts remaining quite wide. The Magnificent Seven, big US technology, has been the star performer in global markets, and so the two technology trusts deserve a mention for their high absolute returns, although they did not outperform significantly. The two niche areas which performed very well and are worth a mention are the two shipping companies, Tufton and Taylor Maritime, and the two Japanese activist funds, AVI Japan and Nippon Active Value. The winner after an exceptional year, though, is probably 3i Group, which isn't even officially an investment trust. Nick Greenwood. Cordiant Digital Infrastructure. This operator of data centres and telecom towers mainly in Eastern Europe stuck to its knitting. Management are experienced infrastructure operators, unlike a number of the new breed of trusts launched in recent years, where the teams had a financial rather than industrial background. The shares have risen nearly 50% over past 12 months, a classic example of how inefficient the market in investment trusts can be. Peter Hewitt. For the year to end. September once again, the two technology trusts, Allianz Technology and Polar Capital Technology, have generated very strong performance. Also good to see for the first time in some time many UK small and mid-cap trusts producing good gains, examples being Aberforth Smaller Companies, Henderson Smaller Companies, and Mercantile. Alistair Laying, Aberforth Smaller Companies. Trust. The last decade has been a relatively difficult period for active managers, UK equities, value equities, and small capitalisation equities. Thus it is surprising that over the last year an actively managed investment trust that focuses on UK smaller capitalisation value equities has delivered share price returns in excess of 30% and NAVI total returns mid-20s. This trust serves as a good example of a manager that pursues a distinctive investment style and is well placed to benefit when the environment changes. Anthony Leatham. We have seen a wide range of NAV-TR, total return outcomes over the past 12 months, with the top performers delivering over 80% NAV-TR and the worst performers dropping over 50% over the same period. At the risk of mixing metaphors, investors have been rewarded by strategies that have kept it simple and stuck to their knitting. One such strategy is Ashoka India Equity, AIE. With its focus on mid and small cap Indian equities backed by a proprietary and disciplined investment approach, the 12-month net asset value total return of around 27%, and the 3 and 5 year annualised net asset value total return of 15% and 21% respectively, have beaten both the benchmark indices and peers, whilst maintaining a rating at or above par. And which have been the most disappointing performers? Alan Brierley, Digital 9 Infrastructure, and this follows on from last year when we said it came a dishonourable second to Home REIT in this category. A shocking experience for investors. Richard Curling. One of the biggest disappointing sectors has been energy storage, batteries, which in spite of being essential for the green revolution have been very poor both in terms of share price and business. Nick Greenwood. Ecofin US Renewables proved to be accident-prone. Initially it looked as though the market had overreacted to the wiping out of an electrical substation by a Texan tornado. Power generation came in significantly below budget across the portfolio, including a major site which was put out of action by rats eating the cables. After a strategic review, the portfolio was put up for sale. However, this process was undermined by the Inflation Reduction Act, IRA, which incentivised investors to build new renewable assets rather than acquire second-hand ones. Peter Hewitt. Digital 9 Infrastructure, where management were way too optimistic and debt was too high. The battery energy storage trusts had a torrid time as revenues generated were significantly lower than anticipated, and finally a trust that just keeps on appearing in worst performer lists, Schroeder Capital Global Innovation. It has not been Schroeder's finest moment. Nearly 5 years after they were appointed, the net assets are down at least 2/3. Alistair Laying, Edinburgh Worldwide. When the 2021 everything bubble burst, technology-focused growth equities took a hammering. Mega capitalisation technology stocks have subsequently hit new highs, but the same cannot be said for smaller capitalisation loss-making stocks. Edinburgh Worldwide was the darling of the sector, but it remains more than 60% below its all-time high. Anthony Leatham. Alternatives have been hit hard this year, both from a top-down perspective with the headwinds of rising risk-free rates and from a bottom-up perspective with various blow-ups. Some asset classes have been badly impacted, including battery storage and certain subsectors in property and renewables. The repeat offender in terms of investor disappointment has been Digital 9, Infrastructure DGI 9, where a series of missteps have resulted in the NAV falling to about 46p and a share price trading on a 65% discount. There are a number of other examples that we can point to, but the mismatch between expectation and reality is very stark in this case. Which trust would you nominate as your trust of the year? And which as the turkey of the year? Richard Curling. Rockwood Strategic has continued to produce excellent performance from a concentrated list of small-cap UK companies using a private equity-type approach. Turkey of the year must surely go to Digital 9 Infrastructure, which has suffered a long period of bad luck and poor judgment compounded by too much debt. Nick Greenwood. Trust of the year would be Rockwood Strategic. The manager took the view that institutional investors were never coming back to the UK microcap niche. Therefore, the best strategy was to roll their sleeves up and get involved in the affairs of the company, often putting in new management who turned around the company prior to a trade sale at a significant profit. Turkey of the Year was Digital 9 Infrastructure, which highlighted what can go wrong when a strategy struggles after accruing high levels of leverage. Peter Hewitt. I think JP Morgan UK smaller companies' growth and income has done very well. An excellent manager in Georgina Britton, and a seamless merger with the JP Morgan Mid-Cap Trust. With no hiccup in performance, the resultant trust is now nearly 500 metres in size and trades on a narrower discount. For Turkey of the Year, it is difficult to look past Digital 9, though Turkey of the Decade would definitely be Schroders Capital Global Innovation, the old Woodford vehicle. Alistair Laying. Trust of the Year, Crystal Amber Ltd. This small capitalisation special situation trust had such a poor run of performance that shareholders decided to discontinue the company in 2021. Since that date, the fund has performed spectacularly well, returning capital to investors and also delivering NAV total returns of more than 80% over the last year. Sometimes, good things come to those who wait. Turkey of the Year, Digital 9. Infrastructure. Most investments that fail were based on a fundamentally flawed investment thesis. Not so with Digital 9 Infrastructure, that correctly identified in 2021 that a boom in digital infrastructure was around the corner and raised more than $1 billion of capital to invest into subsea fibre, data centres and digital infrastructure ahead of a wave of demand from the generative AI revolution. Sadly, the deployment of the capital was so poor that the fund lost the majority of its value over the last 12 months, even though its assets were in one of the most highly sought-after areas of the whole global infrastructure market. This is a reminder that even a fabulous thesis is not enough. Successful execution is essential. Anthony Leatham, JP Morgan Global Growth and Income, has stood out for us. The performance has been resilient through a challenging time in markets, and having reinvented itself in July 2016, the trust has become the consolidator-in-chief in the sector with a series of successfully executed merger transactions. Whilst the dividend out of capital approach may not be to everyone's taste, the approximately 4.1% yield is competitive and has helped the trust to trade at or around par for a number of years and fueled the growth in assets to over £2.7 billion. Discounts have not narrowed as much as some hoped. Why is that? Where are they heading? Alan Brierley. This is the most challenging environment I've seen in more than 30 years covering the industry. A perfect storm has hit. We have a challenging macro environment, ever-increasing geopolitical risks, and a flawed cost disclosure regime. Discounts are cyclical. They will narrow, but investors may need to be patient. Richard Curling. There have been a number of headwinds for investment trusts, including the cost disclosure issue as well as uncompetitive overall costs, but perhaps the most important is their illiquidity, in a world where liquidity is ever more important, and there are still too many small trusts, and so more consolidation in the sector would be a good thing. Over time, I would expect discounts to narrow because of natural mean reversion, arbitrageurs entering the market, and more proactive boards. Nick Greenwood. Until recently, the trust sector faced a perfect storm of rising rates, oversupply, consolidation of wealth managers, and inappropriate legislation. This hostile environment led to extreme discounts. This was especially true of relatively recently launched high-yielding alternative funds. These were created to solve the problem of yield starvation at a time when deposit rates were effectively zero. Now that reasonable income can be generated from conventional sources, demand for these vehicles has evaporated. A number of these headwinds are abating, most notably the FCA's about turn on cost disclosure. This is a material change and was not seen coming even by the activists who have been fighting on the sector's behalf. In the short term, there may not be much share price movement as investors have fallen out of the habit of buying trusts. The sector needs to get into marketing mode. The oversupply issue is resolving itself. There are plenty of wind-ups, buybacks and mergers steadily removing supply. Finally, declining interest rates have made dividends more valuable. We should see a steady narrowing of discounts. Given these have become extreme during the perfect storm, there is plenty of scope for a nice run. Peter Hewitt. Still, adverse investor sentiment has kept demand for investment company shares muted while interest rates have only just started to fall. Gradual tightening of discounts is likely over the next year as interest rates fall and equity markets respond. Cost disclosure reform helps. It will take time, though, to see demand for investment trust shares recover. Alistair Laying. During the global financial crisis, discounts blew out to similar levels as today. It took roughly 5 years for these issues to resolve, and almost 10 years before, a fully blown bubble pushed many trusts to premiere. It has only been 2 years since Trustmageddon caused real damage to investment trusts broadly and alternative trusts in particular. Thus it is likely to take another couple of years for ratings to recover. Anthony Leatham. The shape of the investment trust universe has changed over the years, and going into this more recent bout of discount volatility, The sector had much more exposure to alternatives than ever before. This has meant that premiums turned to deep discounts, and the typically V-shaped recovery in ratings has been hampered by the higher-for-longer approach to interest rates. Conventional equity trusts have behaved largely as one might expect. If interest rates continue to fall, then we can see further narrowing, almost mechanically adjusting for the excess yield spread offered by infrastructure and renewables trusts over government bonds. Where do you think that the market has got ratings most wrong? Alan Brierley, listed private equity. Many of the constituents have materially outperformed listed equities over the long term, have high-quality portfolios that are performing well, yet trade on 30% plus discounts. Ground zero for the obsession about costs rather than value. Richard Curling. I think many of the alternative income stocks, e.g. infrastructure and renewables, are trading too cheaply given their wide discounts and high yields. I think this is mainly due to technical factors rather than fundamentals. Nick Greenwood, battery storage. The market failed to spot how volatile the income generated would be. This was particularly important given the leverage involved. The assets would be better suited to being part of a diverse power generation portfolio. Peter Hewitt, private equity trusts remain a bargain. Asset values should improve over the next year and cost disclosure reform is a genuine win for the subsector. Alistair Lang, infrastructure investment trusts have collectively sold billions of pounds worth of projects at or above their valuations, but their shares continue to trade at significant discounts to their net assets. For investors, this presents a real opportunity. Anthony Leatham. In our view, one of the main areas of overreaction has to be private equity. The doomsday scenario painted by volatile equity markets, particularly in the high-growth, tech-driven markets and sectors coupled with the rising cost of debt, burst the private equity bubble, and, in particular, the venture component. This was then compounded by the lack of transactional activity in the market, a dearth of M&A and IPOs, which accentuated investor concerns about private company valuations. Whilst the reaction to a risk-off environment is understandable, the lack of response to a recovery in markets is confounding. With the Dow Jones Global Technology Index up 35% over the last 12 months, and the private equity peer group X3I producing average NAV total returns up by mid-single digits, one is left wondering why the private equity peer group average X3I discount is over 30% for both direct and fund-of-funds strategies. There has been a fair deal of consolidation since a year ago. Are we nearly done now? Alan Brierley. No. For more than a decade, we've said the industry needs to address these zombie companies, those that lack critical mass, have poor liquidity, indifferent track records, and weak corporate governance. The crisis has been a catalyst for this process to gather momentum, but there is still much work to be done. Richard Curling. I do hope not. The investment trust sector faces serious challenges and must offer relevant and competitive products. This would be aided by consolidation into fewer, bigger, more liquid trusts. Nick Greenwood. Discounts remain wide, and whilst improving, there is still oversupply. We should expect consolidation at a similar rate to what we have seen in recent months. Peter Hewitt. As long as average sector discounts remain in double digits, consolidation will continue. Boards are being more proactive and shareholders more receptive. As an illustration, look at the number of deals in the property subsector. Alistair Lang. I hope not. Trusts grew quite indiscriminately during 2018-2021, and there is more pruning, return of capital and general self-help that is required in order for the sector to recover. This is all part of a normal and healthy cycle, not a sign of failure. Anthony Leatham. Not just yet. As well as being another record-breaking year for buybacks, we have seen a significant number of transactions that result in mergers, takeovers, take-privates or managed wind-downs. In spite of the pickup in activity, we are still looking at a sector which has over 50 trusts, with market caps lower than £100 million, and if we raise the bar to £200 million, we are looking at over 100 trusts, or 37% of the universe by number. Scale matters more today than ever, and trusts will need to consider how best to future-proof themselves, whilst making full use of the close-end structure. What has been your biggest regret in trust selection analysis this year? What were you most pleased by? Richard Curling. I have been disappointed that many of the renewables and infrastructure companies have not performed better given their high yields, big discounts and non-cyclical businesses. Share prices seem removed from fundamentals. I've been particularly pleased with the performance of our two shipping investments, Tufton and Taylor Maritime. Nick Greenwood. Our most disappointing selection was Aquila European Renewables, which suffered a run of negative surprises including falling out with reindeer herdsmen, a tax charge on their Norwegian assets, and a loss on carbon credits. And what should have been a low-risk, medium-return investment suffered an unpleasant loss. Conversely, Amadeo Air 4 was the most pleasing. We took a view that production problems at both Airbus and Boeing would lead to capacity constraints for the airlines, leading to a firm market for second-hand aircraft. Peter Hewitt. The overall performance of many alternatives has been poor. Discounts have remained stubbornly wide, in part due to interest rates and generally lackluster net asset performance. Looking ahead, most dividends have been paid and yields are attractive, so as interest rates come down, this should benefit the sector. Cost disclosure reform would also be a boost. TR Property is recovering strongly and has a great manager. It could go a lot further. There are signs of life in the biotech sector, with Biotech Growth Trust posting a strong recovery, and quietly Scottish Mortgage appears past the worst and has begun to perform. Anthony Leatham, not ringing the bell loudly enough at the bottom of the rate cycle and providing investors with an early warning system to help avoid some of the losses. We have been correct with some of our underperform recommendations, where the deep dive analysis has paid off. But it is a hollow victory when a trust sells off and our high conviction call is proven right. What has been particularly pleasing has been the ability to leverage decades of experience and study various cycles to highlight the glaring discount opportunities in the depths of the sell-off. History doesn't repeat itself, but it often rhymes. What changes would you most like to see in the investment trust universe? Alan Brierley, resolution of the cost disclosure issue. The industry was too slow to recognise the damage that this has caused. Richard Curling. I would like to see more consolidation in the sector, and I would like to see some of the laggard boards be more proactive in focusing more on shareholder value. Nick Greenwood. It would be nice if investment trusts could be allowed to compete on a level playing field. They are a peculiarly British invention and don't really exist elsewhere in the world, so frequently get caught in the crossfire of standardisation. Standardisation is also a problem at some of our fund groups and our regulators, who would seem to prefer the world to be focused on long-only open-ended funds. Peter Hewitt. Cost disclosure reform becoming law so that investment companies are on a level playing field. It won't change discounts and sentiment overnight, but in the long term it is very positive. Also continued moves up in retail investors on share registers via the platforms. This is a good thing, as these are the shareholders for whom investment companies are most suited. Alistair Laying. Governance. Oversight of alternative investment trusts is extremely complex, and recent travails have made it quite clear that many boards lack the requisite expertise to constrain managers during the boom years. This issue may have been exacerbated by the selection criteria for directors, which had placed undue prominence on factors other than expertise. Governance is a function, and directors should be selected based on their capacity to fulfill that function. Full stop. Anthony Leatham. The confusing issue of cost disclosure has been an unhelpful distraction. Recent announcements regarding legislative reforms to UK retail disclosure requirements and an interim exemption for investment trusts from the costs disclosure regime have been well received. But we are concerned that this will take time to change investor behaviours. The sooner we can level the playing field and revitalise the fee-sensitive investor demand, the better. How impressed are you by board's response to the challenges of the past year? Alan Brierley. There has been a significant improvement over the past 12-18 months, and we highlight capital allocations, buybacks and corporate actions. This followed a period when an extended bull market and the most benign of macro environments had bred pockets of complacency, and this was exposed when the storm hit. Richard Curling. Some boards have responded more quickly than others, but in general I think they have been too slow, and I sense several have only reacted to the lead of the frontrunner in the sector. Nick Greenwood. Board's performance has been varied. A slight concern is that with increased scrutiny there is the risk that they may become overly cautious. Peter Hewitt. Some have been better than others. The original Hypnosis board was a negative example, as more recently was the PRS REIT board. However, there have been a lot of positive examples of boards and management companies taking the initiative. The spectre of activist shareholders has certainly contributed to better governance. Alistair Laying. Boards were very slow to respond to the change in environment in 2022. Initially, they were very defensive and resistant to managing discounts or returning capital to investors. Over the last 12 months, directors have moved to a more realistic position and in certain cases taken quite impressive action. However, there is still much more that needs to be achieved. Anthony Leatham. On the whole, I've been impressed. Boards have stepped up to address various challenges facing their companies, ranging from poor performance, discount control, and capital allocation policies through to activist campaigns, whilst also trying to please multiple shareholders with potentially differing views and priorities. There is always more that can be done to improve the oversight, but with the natural turnover in board personnel and the ongoing move towards greater diversity, alongside a more vocal and engaged shareholder base, we can see standards continuing to improve. Which boards deserve the most credit and which have been lagging in effective governance? Alan Brierley. A year ago, we highlighted the impact of Rob Naylor, the chair of Roundhill Music Royalty. This year he teamed up with Christopher Mills at Hypnosis Song, and they were able to achieve an outstanding outcome for shareholders. Richard Curling. The boards that deserve the most credit are those that have broken the mould with a renewed focus on shareholder value, e.g. Pantheon International, or where they have accepted that there is no future for their trust, e.g. RM Infrastructure, and commenced a wind down. Special mention should also go to the new board of Hypnosis for negotiating such a good result for shareholders from a weak hand, Nick Greenwood. I think that the repopulated boards of the two music rights trusts did a good job in difficult circumstances. Conversely, shareholders' interests have been damaged by the Keystone Board's decision in recent years to move the management contract first to Invesco and then Baillie Gifford. In both cases, the new manager was at the end of a period of stellar performance, soon to be followed by a period in the doldrums. Peter Hewitt. The boards of JP Morgan UK smaller companies and JP Morgan mid-cap and those of the two Henderson European trusts deserve credit for organising sensible in-house mergers. Likewise, the boards of Alliance and Witan and the boards of Aurora and Artemis Alpha for their combinations. There have been many others. Alistair Lang. Amazingly, the least and most impressive governance have both come from the same company, Smithson Investment Trust. In February, the board decided it would not allow a scheduled AGM continuation vote despite the fact the trust was trading at a 10% discount. After this truly staggering example of corporate governance gone wrong, shareholders vocally protested. The board responded impressively by not only allowing the continuation vote to go ahead, but also embarking on a meaningful share buyback program. It is unfortunate that it took a crisis to move directors to the position they should already have adopted. But it is important to recognise their responsiveness to shareholders. Are you optimistic or pessimistic about the outlook for investors in trusts? Alan Brierley. Optimistic over the long term. The closed-end industry has a good track record of Darwinism. The strongest survive and thrive, and the weakest depart. We expect the closed-end industry that emerges from this crisis will be materially different from the one that entered it. Richard Curling. I think investment trusts have a great future if they focus on delivering relevant and competitive propositions and use their closed-end structure to the benefit of shareholders. The future is probably brighter for trusts that hold illiquid assets that cannot be accessed by investors in any other way. Nick Greenwood. Optimistic. There is money to be made during the next couple of years. Big discounts, declining interest rates and heightened corporate activity should combine to generate decent returns. Peter Hewitt. Optimistic. Governance is travelling in the right direction, although the pressure must be maintained. The share price performance of many trusts will also benefit from narrower discounts. Alistair Lang. Optimistic, always. It has been a tough couple of years, however, there are some signs that headwinds might be turning into tailwinds. Anthony Leatham. Ever the optimists, we can see a situation where discounts on the high-quality, large liquid trusts start to narrow meaningfully. Depending on the direction that the next budget takes, the yield and differentiated dividend growth offered by investment trusts could once again become valuable to investors. Finally, if our view on consolidation plays out, we could be looking at a sector with closer to 200 trusts and potentially a stronger footing for recovery. What are you most excited about in your current portfolio research universe? Alan Brierley. Long-term investors are currently able to acquire core, strategic investments at very attractive discounts. We have no idea when they will narrow. But over 3 to 5 years we would expect an improvement in ratings to enhance alpha generated by the underlying managers. Richard Curling. I'm excited about the prospect of the supercharged performance that can come from the combination of a good asset performance and a narrowing discount. Nick Greenwood. Baker Steel Resources, which is a deeply unfashionable investor and developers of mining deposits. The projects are vast relative to the trust's 50 minnows market cap. It would only need a couple of successes to trigger a useful profit. Peter Hewitt. I see 3 key themes in particular. One is UK equity trusts, which are either specialists in or have a significant weighting to medium and smaller companies. Valuations are attractive and discounts too wide. As a group they have been out of favour and unloved for years. Lower interest rates and inflation and modest growth create an environment for better performance. The second is private equity trusts, which have wide discounts and strong growth prospects. The third is investment companies with strong secular growth prospects, which principally means exposure to technology, biotechnology or healthcare. These are the areas where many times the original investment can be made. Anthony Leatham. With around 85 trusts on a discount to NAV of greater than 20%, the dislocation is extreme. Whilst we acknowledge that there are going to be value traps in amongst the deeply discounted trusts, the gap between asset value and share prices is out of touch with the broader listed equity markets and the changing macro environment. In particular, the negativity towards private equity is overdone, and we could see a situation where a basket of private equity trusts could do very well over the next 12 months, including names such as Harbourvest Global Private Equity, HVPE, Augmentum Fintech, AUGM, Chrysalis Investments, CHRY, as well as hybrid public-private portfolios including Caledonia Investments, CLDN. Smaller Companies Forum. This year we also invited fund managers from the smaller companies sector in different regions to discuss the current merits of investing in small cap funds. Who's who? Nish Patel is the portfolio manager of Columbia Threadneedle's Global Smaller Companies Trust. Mine Tesgul is the portfolio manager of the European Assets Trust at Columbia Threadneedle Investments. Jonathan Brown and Robin West are managers of Invesco Perpetual UK Smaller Companies Investment Trust. George Ensor has been the fund manager of River UK Microcap Trust since 2018. What metrics make you think that smaller companies are attractive at present? Nish Patel, looking at price to earnings. PE ratios. Smaller companies are fairly valued relative to their own history, but are very undervalued relative to larger companies, and this is true across most regions. On free cash flow yield, smaller companies across most regions are undervalued both compared to their own history and relative to larger companies. Mine Tesgul. We use a range of metrics to assess the attractiveness of individual stocks, and their importance will vary depending on the business model and sector. We are, for example, particularly interested in cash flow metrics, though these are less useful in the financial sector where price to book is more helpful. Given the varying information available for data providers, we find it best to assess the valuation of the portfolio in the market by assessing the price-to-earnings ratio. On a PE basis, small cap valuations are attractive, compared to history and also compared to large cap. Jonathan Brown and Robin West. We look at a range of metrics but currently find trailing PE especially interesting. Historically, when small companies have traded at such low valuations, subsequent returns have been particularly attractive. Valuations are still below their long-run average. When markets recover, we would expect small companies to trade at a premium to their long-run average, reflecting the anticipated recovery in earnings. George Ensor. The UK small cap market, which covers the bottom 10% of main and AIM-listed companies, is currently trading on a PE of about 10x earnings. That is attractive in both relative and absolute terms. There is also a large valuation gap between the cheapest and most expensive stock in any sector, which is a great opportunity for active investors with a strong valuation discipline. How does your universe compare on those metrics to other markets and regions? Nish Patel. It is clear on free cash flow yield that smaller companies within the UK and continental Europe are more undervalued than in the US. This rhymes with what we are seeing from a bottom-up perspective, as we are finding more investment ideas in the UK and Europe and fewer in the US. Mine Tesgul. Using cash flow metrics, smaller companies in continental Europe are more undervalued than those in the US. This correlates with our analysis from a bottom-up perspective. We find more good investment ideas in Europe and fewer in the US. Jonathan Brown and Robin West. UK equities remain cheap relative to their history and relative to other global markets, especially the US. Earnings downgrades have moderated somewhat. It feels like the recovery that some were hoping for in the second half of this year has been pushed into 2025. With a stable UK government talking about driving growth, the UK for the first time in a decade looks a relative beacon of stability. The UK was one of the largest underweights for fund managers, but is now a small overweight. Its economy is forecast to be one of the faster-growing developed economies in 2024 and 2025, with growth of 1.1% and 1.4%, ahead of the Eurozone and Japan, although still behind the historic trend. George Ensor. UK equities, even on a sector-neutral basis, are trading on a 10 to 20% discount to European and US equities. Globally, smaller companies have underperformed in most markets, as is typical in a rate-tightening cycle, and most small-cap markets have seen a pickup in performance over the last 12 months as we've moved past peak interest rate and inflation expectations. How does your portfolio score on those metrics? Nish Patel. Our portfolio has better quality metrics on a median stock basis than the small-cap market. We measure quality by looking at gross margin, operating margin, return on equity and leverage. At the same time, the trust's median valuation is lower than the benchmark on the basis of PE ratio and dividend yield. Mine Tesgul. Our portfolio with its quality orientation appears more expensive than the overall index in PE terms. The PE is 5 points above the benchmark index. However, this is justified as the portfolio holdings are less cyclical and likely to produce more resilient and reliable earnings and cash returns than the universe. George Ensor. Our portfolio's valuation is in line with the benchmark on most metrics, including price to book, price to sales, and price to earnings. We are cheaper on EV over EBITDA and more expensive on price to cash flow. However, the portfolio has seen significantly stronger growth in revenues and profits. How concentrated is your portfolio, and what is its active share and beta sensitivity to market movements? Nish Patel. The portfolio has 210 holdings, of which the largest single stock, Eagle Materials, represents 2.2%. The active share is 91% and the beta is 0.95. Mine Tesgul. We hold 63 stocks, have an active share of 93.5% and a beta of 1.1. Jonathan Brown and Robin West. The portfolio currently has 63 holdings, which is down from 72 a year ago. Its active share is currently 80% and its predicted beta is 0.88. George Ensor. We have 37 individual stock positions, out of potentially 600 shares that meet our market cap requirements, with approximately 50% of the portfolio in our 10 largest positions. Our active share is around 99%. The beta is approximately 1.05. What will be the catalyst for bringing stronger returns from smaller companies? Nish Patel. Smaller companies have underperformed significantly and are now at cyclical lows on a relative valuation basis, while a number of megacaps are now of a size that will make it difficult for them to sustain the same level of growth. They are certainly not valued for a slowdown in growth, so if that happens, there may well be a switch in allocation away from these larger businesses. Additionally, M&A and share repurchase activity has picked up amongst smaller companies, which highlights the valuation opportunity in this space and will help drive share prices towards intrinsic values. Smaller companies are more sensitive to interest rates and credit conditions than larger companies, so in periods of interest rate cuts, this asset class tends to outperform. Mchattie. European equities have underperformed those in the US and are now cheaper, and while Europe has political and economic challenges, so does the US. We believe that passing the peak in interest rates will help our portfolio, boosting long-term growth assets and strong business models. It could well be that we see a reversal of the difficult trends seen in 2022, when the invasion of Ukraine prompted higher oil prices, higher inflation, and a sell-off in growth and quality stocks. Jonathan Brown and Robin West. We have seen increased takeover activity within the small company sector with private equity and corporates attracted by low valuations in the UK. IPU has been a beneficiary of this with bids for Alpha Financial Markets Consulting, Keyword Studios, and a recent approach for Learning Technologies. Other stocks that have received approaches include XP Power, Crest Nicholson, and Serco. The attributes we look for in companies, strong margins and returns, cash generation with attractive growth prospects, are the same attributes that potential purchasers look for. We would expect to see continued corporate activity in the UK small and mid-cap sector whilst valuations remain low. Small companies have returned to their historic track record of outperforming their larger brethren over the last couple of quarters. We are hopeful this will continue and that the outflows we have seen from UK funds, both large and small, will turn to inflows, with investors attracted by the positive returns that UK equities are starting to generate. George Ensor. An improvement in flows into UK equities and risk sentiment, strength in sterling and continued weakness in oil and gas prices would also be supportive. Please describe your investment style in a couple of sentences. Nish Patel. The Trust takes a long-term conservative approach to investing in good quality, growing businesses when they become available at an attractive valuation. We aim to offer the faster growth potential inherent in smaller companies with lower levels of risk. Risk is reduced by focusing on quality businesses that can withstand the typical challenges that smaller companies face, and by demanding a margin of safety when we invest in these companies. Mchattie. Our style is quality-oriented. We believe that buying strong business models with durable businesses will bring long-term success, so we look for companies that do something exceptional for their clients, which will be rewarded by repeat sales, by loyalty, and by higher prices and returns. Jonathan Brown and Robin West. We look to create a portfolio of quality, small-cap companies that are trading at attractive valuations and have the potential to grow over time. The quality factors we look for include companies with pricing power, well-tested management teams, and resilient balance sheets. We have a focus on risk-adjusted returns with the goal of creating a portfolio that offers investors sleep-at-night exposure to an asset class that is often associated with volatility. George Ensor. We are company lifecycle investors, meaning we diversify portfolios across the three phases in which companies can generate shareholder value: growth, maturity, quality, and recovery. Analyzing and valuing companies this way makes it easier to understand opportunities and risk returns, and through diversification across the three phases, delivers better risk-adjusted returns through the cycle. What differentiates your trust and makes it more attractive than your peers? Nish Patel. With almost £900 million of assets, the trust is of sufficient scale to be relevant and cost-effective for our clients, but at the same time still small enough for us to be genuine small-cap investors. The trust is managed by a very experienced team that know the companies in the universe very well, and that have successfully navigated numerous market events. The trust offers exposure to smaller companies in both developed markets and faster-growing emerging markets. It has grown its dividend for 54 years consecutively and is active in managing its discount. Mchattie. Our disciplined focus on quality, coupled with an unmatched resource-achieving research intensity, helps us stand out from the crowd. There are 4 small-cap specialists in London working with one of the largest and strongest European equity teams, which provides good scope for informed and better stock selection. And we have a long track record in smaller companies, now united with the long-term structure of European Assets Trust. In addition, the client gets the benefit of a generous and unique distribution policy within the small-cap fund universe. We aim to distribute 6% of the year-end's net asset value in 4 quarterly payments. Jonathan Brown and Robin West. Firstly, we have a strong record of outperformance. Total NAV return has been 107% versus Deutsche Numis smaller companies, plus AIM Exarch investment companies, index is 58%, and the FTSE All-Share Index is 81% over a 10-year period. Secondly, we pay a 4% annual dividend yield. The board rebases the final dividend each year to provide a 4% yield based on the year-end share price. The yield is indicative only and is not guaranteed. Thirdly, the shares are trading at a 13.9% discount to NAV, as at 8th October 2024. George Ensor. We aim to allocate our capital to mispriced companies with a market cap of less than £100 million, which is our universe for new ideas. This area of the market is often overlooked by investors, given the lack of analyst coverage and the shortage of liquidity. In addition, the Trust has a unique approach to capacity management by which we return capital to shareholders on an ad hoc basis when our net asset value exceeds £100 million. That means we remain small by design and can maximise returns from the premiums that microcaps have historically enjoyed. Since inception in December 2014, we have returned £77 million of capital through our redemption programme, which is more than the £70 million of total capital we have raised and more than the current net asset value of £73 million, as at 20 September 2024. The internal rate of return that shareholders have achieved from inception is 13% per annum. That is materially higher than the compound 5.3% total return annualized return that the NUMI's smaller companies plus AIM, ex-Investment Trusts, index has delivered over the same time period. The comparable figure for the FTSE All-Share Index is 6.1% per annum. What is the profile of your share register and who is your target market? Nish Patel. The Trust has mostly retail investors on its register. The Columbia Threadneedle Savings Schemes own 55% of the outstanding shares. Mine Tezgul. Over 70% of the share register is currently held by private investors, via third-party investment platforms as well as the Columbia Threadneedle Savings Schemes. A further 12% is held by wealth managers. Private investors are the target market, and we acknowledge their need for growth from the European small-cap asset class as well as yield. Combining these two characteristics should appeal to those who rely on investments to provide both income and growth. Jonathan Brown and Robin West. The current shareholder base is split between 38% retail and 62% institutional investors. The top 10 shareholders are a mix of investment managers, asset managers, institutional clients and individuals. In total, they account for 65% of the total shareholder base. The target market currently in focus is predominantly the retail market, although that is not to say that we aren't marketing to the larger investment management groups. George Ensor. Our target clients are wealth managers and private investors. The register is predominantly made up of private client wealth managers, approximately 50%, private investors, around 30%, and some institutional funds. How have you changed the shape of your portfolio over the past 12 months? What are a couple of the most significant winners and losers? Nish Patel. Over the last 12 months we have found more ideas in the industrial and real estate sectors. Both have been out of favour, and valuations look attractive. Industrials have been hurt by sluggish organic growth as a result of having to reduce overstocked inventory during the pandemic. Real estate has been challenged by higher interest rates and lower demand in the office sector with the rise of working from home. We think that this has created opportunities, and in some cases share prices have overreacted on the downside. Our holdings in US construction materials companies, Eagle Materials and Martin Marietta Materials have performed well over the last 12 months. Pricing has been very strong because of a tight supply situation and good demand from infrastructure projects. We also had 7 takeover bids in the last financial year. French spirits producer Rémy Cointreau had a disappointing year because of weaker demand in the US and imposition of tariffs by China on imports. Mine Tezgul. The overall structure has changed little, but we introduced some new and successful companies to the fund. Ellis is a global laundry and clothing provider, originally French and with a dominant market share there. Ellis has a commanding network, capital intensive, but its scope provides a barrier to entry. We have also bought Fineco Bank, the leading online investment and savings platform in Italy, which has scale and cost advantages and is leading the digitalization of the market. Positions sold or reduced included Azimut, a smaller and lower quality business than Fineco Bank, and Carnoff, which saw a bid approach boost the share price. Jonathan Brown and Robin West. In terms of portfolio construction, we have tilted the portfolio towards more cyclically exposed businesses, which could offer more upside should the positive momentum we have seen in the economy and markets in the near term continue throughout 2024. The portfolio has a barbell approach, which we believe offers comfort to investors that the Trust remains a balanced, risk-adjusted offering in the sector. We have also consolidated the tail of the portfolio to ensure only their highest conviction ideas remain, believing that a concentrated portfolio could be beneficial in a rising market. Positive relative performers include JTC, which had strong trading, and accretive M&A AJ Bell had strong trading and better equity markets. Keywords had a takeover approach from EQT, a private equity group, at a 69% premium. Avon Technologies experienced a turnaround under new management, Volution Group had strong trading. In terms of negative relative performers, CVS Group is currently under a Competitions Authority investigation which has caused a D-rating. Focusrite had soft trading more persistent than expected. Auction Technology had minor earnings downgrades and the stock D-rated. Churchill China had softer trading offset by margin improvement. George Ensor. M&A has been a driver of both portfolio activity and performance, with Instam, City Pub Group, Chantergold and Smoove all being acquired, requiring about 12.5% of the portfolio to be reinvested. One area of focus has been early-stage enterprise software businesses which have been derated over the last few years. We initiated a position in Windward, and our existing position in Active Ops has performed well. Our best performer in the period was Reynolds, a recovery stock which is a global chain manufacturing business and has achieved a big step up in operating margins after a change in management and is now executing a buy and build strategy. Concierge business 10 Lifestyle, glasses manufacturer Inspecs and corporate learning and development provider Mind Gym have been the most significant underperformers. Each has struggled to deliver on our growth expectations. What is the approach to gearing, and how does current gearing compare to other periods? Nish Patel. We have structural gearing in place of 5%, which is in most part funded by low-cost long-term debt. Tactical gearing of up to 10% can be taken when multiple attractive investment opportunities are available. Mintezgul. The company has the ability to borrow up to an amount of 20% of the value of its investment portfolio. European assets. Trust does not use long-term structural leverage and tends to use a short-term revolving credit facility. Since the second half of 2023, the level of gearing employed has increased to take advantage of market opportunities. As at 30th of June 2024, the level of gearing employed was 6.0%, 30th June 2023, 1.4%. Jonathan Brown and Robin West. The board has a gearing policy that allows the managers to take up to 30% of net asset value, or £25 million of net gearing, whichever is lower. The current facility is an overdraft with a capacity of up to £20 million. The managers will review several metrics before deciding whether to deploy gearing, including stock valuations, company earnings and market momentum, as well as comparisons to bond spreads and other economic indicators. The trust is currently 10% geared, reflecting the manager's confidence in the prospects for UK smaller companies and IPU's portfolio. Our analysis did not support the use of gearing for more than 5 years until the second half of 2023, when the managers began using gearing. George Ensor. We don't use gearing, and we are cautious about investing in companies that rely on leverage. 75% of the NAV is represented by companies that have net cash on their balance sheets. How do you assess your rating, and is the board taking steps to narrow the discount? Nish Patel. The board has a goal to maintain a discount of 5% or better in normal market conditions. In order to meet that goal, the trust is repurchasing its own shares and has ramped up its marketing efforts to attract new buyers. Mintezgul. European assets. Trust has historically enjoyed the tightest discount of its sector, particularly due to its high dividend policy. However, this has widened in recent years and currently sits at minus 12.8% as at 15th October 2024. The poor NAV performance has been addressed through a multi-strand approach including portfolio construction improvements, internal manager change, and a fee reduction. The board, in conjunction with Columbia Threadneedle's investment risk and oversight function and the investment team, made the decision to appoint the most senior talent at the firm as lead and deputy portfolio managers, head of European small cap and head of international equities, respectively. Jonathan Brown and Robin West. Performance has had periods where it has been more challenging, but over the longer term it has been strong. 2020 was a good year for performance. Whist 2021 was weaker. We then had a good 2022 followed by a more challenging 2023. The discount has been a challenge over the years. The enhanced dividend policy put in place back in 2015 had the effect of narrowing the discount. But since Brexit and with the challenges of COVID, the wider discount has been stuck in a range of roughly 5% to 16%. The board believes the enhanced dividend policy should increase the trust's attraction relative to peers and be a supporting factor in keeping the discount narrow. As such, there have been no share buybacks in the past few years. Should interest rates begin to fall, the board believes the higher yield of the trust relative to peers could lead to a potential re-rating. George Ensor. The investment trust sector generally has been consolidating and discounts widening given the pressure on costs and demand for greater liquidity. We do not believe that we can access UK microcaps in a materially larger way than we do. So whilst the discount is frustrating and, in our view, too wide, we continue to emphasise the excellent cash-on-cash returns after all fees that investors have achieved. Please make the case for investing in your trust at this point. Nish Patel. The Global Smaller Companies Trust offers pure exposure to the best smaller company opportunities across both the developed markets and emerging markets, but with lower levels of risk and volatility. It is managed by a very experienced team that has delivered strong long-term returns. Several factors, including low relative valuations, a potential slowdown in growth for larger companies, M&A and share repurchases, plus interest rate cuts, make this an opportune time to invest. Mind Tesgul. Smaller companies in Europe have been unloved, leading to underperformance relative to large cap companies, so they are now attractively valued. This has been exacerbated by higher interest rates, which has in turn damaged the valuations of strong long-term business models. This trend may well reverse as interest rates have peaked. Finally, the focus on the mega caps, the Magnificent 7 in the US or the Granola 11 in Europe, has distorted markets, so greater diversification leading to better small cap performance is likely to drive a rebound of small caps. Jonathan Brown and Robin West. The outlook for the UK economy looks reasonably good. Economic indicators suggest a reasonable, if unspectacular, rate of growth over the coming year. Full employment, strong consumer balance sheets and wages growing ahead of the cost of living should ensure a healthy consumer sector. The outlook for the industrial sector is more difficult. Discussions with businesses suggest that the destocking phase that has impacted growth over the last year is abating. However, the demand backdrop remains tough for manufacturing businesses. We are hopeful that construction-related activity will continue its recent improvement. Lower interest rates have led to a pickup in demand for new housing, and should also support increased transactions within the commercial real estate sector. There is a heightened level of uncertainty created by the UK budget at the end of the month, and the US election in November. However, these are temporary issues. We believe that an attractively valued market and ongoing takeover activity is a favourable backdrop. Additionally, if interest rates continue to fall, we should see more money being allocated towards equities. George Ensor. There are 600 UK-listed companies with a market capitalisation of less than £100 million, and they represent 6% of the NUMI Smaller Companies Index, which covers the bottom 10% of UK-listed stocks. There is a wealth of opportunity in both small, fast-growing companies and out-of-favour recovery opportunities. We believe we have the ideal structure and approach to exploit huge inefficiencies in this part of the market. However, our performance is clearly geared to changes in risk sentiment, the liquidity premium, and access to growth capital. When the UK small cap premium is positive, meaning small caps are outperforming, we have consistently and meaningfully outperformed the benchmark and other active UK small cap strategies. Having recently been through the second largest period of small cap underperformance in the UK since 1990, we believe that we are at the beginning of a new small cap cycle, which will be supported by positive real wages, improving economic growth, low leverage, the government aside, falling interest rates, and once-in-a-cycle low valuations. River UK Microcap Trust shares are also currently trading on a 16% discount to a NAV. And what are the major risks to that outlook? Nish Patel. A deep recession and tightening of credit availability would, as always, hurt smaller companies. However, we believe our portfolio is well placed in those circumstances given that we invest in higher quality, cash-generative businesses with strong balance sheets. Min Tesgul. Higher interest rates and a recession would damage performance, but so would they for all equities. The greatest risk is that we suffer stock-specific issues, and the best uses of our ample resources and expertise should minimise that risk. Jonathan Brown and Robin West. We need to be vigilant to potential policy changes under the new Labour government. The risks are that the UK budget proves to be less business-friendly than expected, and the macro environment weakens against expectations. In order to ride out these potential issues, we intend to keep the portfolio balanced as described above. We want to be ready to react to opportunities that may present themselves on disappointment or macro concern. George Ensor. Employment is a critical risk. We have seen the level of vacancies reduce and employment is easing from record levels. A rapid deterioration in UK labour markets is probably the most significant risk we can see. UK domestic earners, a more significant part of the universe than in large caps, are sensitive to global commodity prices and movements in the sterling exchange rate. The UK budget at the end of October will be important in understanding the government's priorities. Hunting value in Asia? Nitin Bajaj, portfolio manager of Fidelity Asian Values, explains why a value style and a small and mid-cap focus have worked well together in Asian markets. What drives your approach to managing Fidelity Asian Values? My investment strategy is built on diligence, discipline, and patience. I look for good businesses run by competent management teams, available at a price that provides a reasonable margin of safety. I focus on managing absolute risk and losing little money during market drawdowns, which should help compound returns at higher rates over the long term. My process therefore tends to avoid thematic investments, startups, highly geared companies, cyclical businesses earning peak margins and stocks on high multiples to earnings. As a result, Fidelity Asian Values has a contrarian value tilt and is primarily invested in mispriced small and medium-sized companies that are poised to become the winners of tomorrow before they gain widespread recognition. By investing in good businesses, run by good people at an attractive price, the trust looks to create value for its holders over the long term. How did you arrive at this investment philosophy? I have been an active investor since 2003 when I first joined Fidelity in our London office. However, I first got involved in the stock market as a teenager, when I invested money I received as a birthday gift in the Indian stock market. My father was a professor of history, but his real passion was technical analysis and trading stocks, so I grew up surrounded by a lot of discussion about the stock market. I really discovered fundamental investing during my MBA studies when I read One Up on Wall Street and Beating the Street by Peter Lynch, one of the most successful and well-known investors of all time. I was lucky that Lynch's mantra of know what you own and know why you own it clicked so well with me. Early on in my investing journey, I just followed what I found to be logical. Over time, as I learnt more and read more, I found the approaches of both Joel Greenblatt and Warren Buffett very appealing. The opportunity to have worked with and observe Anthony Bolton in real time has also been a big influence. Anthony's stamina, the lack of emotional involvement in decision-making, his judgment of cycles and ability to focus on what really matters has helped shape my process. At the same time, I believe that you cannot really copy anyone, and you must focus on developing your own process and keep improving it. I have a better chance at being the best version of myself than a suboptimal version of someone else. At what stage did you first zero in on small cap value as your preferred approach? The small cap stocks I look for are typically up-and-coming young companies that are set to become tomorrow's large caps. This part of the market first caught my attention when I was managing a pilot portfolio as the assistant portfolio manager of Fidelity Global Special Situations Fund from 2006 to 2008. The appeal of small-cap stocks became more pronounced as I started to manage Fidelity India Special Situations Fund from 2009 to 2012, and there was no single trigger. I just happened to find a lot of good quality and under-researched stocks in the small-cap universe in India. I was given the freedom to express my views even though the funds I was managing were benchmarked against India's large-cap index. These small-cap holdings made a substantial contribution to the outcomes I achieved over this time. In 2013, I relocated to Singapore and had the choice of managing either a large-cap Asian portfolio or managing a small-cap focused Asian portfolio using my own value contrarian approach. I actively chose the latter. It was a natural decision as I enjoyed exploring the wide universe of listed small-cap companies for opportunities and felt I could get a real edge with these small companies which I could not with larger companies. The small-cap effect is well documented across various markets, although its extent seems to differ between regions. To what degree does it exist in Asia, and are there any particular factors that might influence it in Asia that don't exist elsewhere? When we look at total returns across style and market cap bands in Asia ex-Japan over a long period of time, it confirms that the small cap effect does exist. What is most remarkably evident in the following chart is that over the long term, small cap value has outperformed its large cap peers, as well as the small cap growth category by a considerable margin. See tables and charts in the free ebook. Total returns by style in Asia ex-Japan. Why does a small cap effect exist? It is hard to make a definitive statement, but my hypothesis is that 3 reasons drive it. The first is that there is an active risk liquidity premium. Small cap stocks are illiquid and do not feature in prominent benchmarks. Most investors therefore will not want to get involved in them. As a result, disciplined small cap investors can discover stocks trading at a more favourable valuation for the quality of the businesses. Secondly, I feel it requires considerably more in-depth research on a consistent basis. We research roughly 10 companies for every company we invest in. You need a dedicated research team to be able to exploit the small cap opportunity. This is expensive, but you get compensated for the effort. Finally, I feel there is a psychological factor as well. As you can see from the chart, the best performing style over the long term is small cap value and not small cap growth. Being contrarian is psychologically tough. The latest fact sheet shows that 13% of the portfolio is in stocks valued at more than 10 billion, so you don't just invest in small cap stocks. Could you explain the rationale behind this approach? I've always constructed the portfolio with about 20% invested in larger stocks. Each of these large cap holdings must also meet my investment criteria of good business, good people, and offer a margin of safety that I am comfortable with. In my experience, these stocks have not diluted returns in the past, rather cushioned them against volatility and fund flows, particularly for the open-ended variant of the trust. They also provide more flexibility for my investment process. Net gearing is currently near the highest level it has been under your tenure. What is the expected range, and how do you view and manage gearing? Gearing is a portfolio construction decision, and the Trust's board has given me guardrails within which I operate, so it is a portfolio management decision. I don't have a specific target for the level of gearing, and it really is a function of the opportunities that we can find. Just to highlight the extremity of the situation of China versus India, the following chart is self-explanatory. A book value chart would tell the same story. It really is quite remarkable. See tables and charts in the free ebook, Forward Price to Earnings. The current level of gearing is an outcome of extreme scenarios being discounted by stocks in China and to some extent also in Indonesia. Given the number of opportunities available in China currently, we could actually gear up even more. However, it would take our allocation to China to more than 40% of the assets, a level I use as a limit for a single country exposure. Portfolio turnover in 2022 and 2023 was around the 50% level. Is this typical, and how does this figure tend to vary from one year to the next? This is typical. Historically, our turnover has ranged between 40% and 60% over a long period of time, and it does not vary too much. Investing in high-quality, small, mid-cap names that are unloved and out of favour at the time of investment means that I must be patient for the stock to be widely recognised and the thesis to play out. I am happy to hold on to such positions for as long as the thesis remains valid. The evidence shows that portfolios with a relatively low turnover and high active share tend to outperform their high turnover counterparts on average, particularly in smaller companies where liquidity is lower and transaction costs higher. How do you view macro and geopolitical events such as elections or trade wars and the effects this will have on your portfolio? Macro and geopolitical events are not central to my decision making, but I realise I cannot ignore them entirely as companies exist within business cycles, and they are impacted by geopolitical events. We try to factor both of these into our decision making, predominantly at the single stock level and at the portfolio risk level, but they are not the main drivers of decision making. Stock picking is the mainstay of the investment process and has been its strength, and I feel we are better placed if we stick to our knitting. Why should investors consider adding Fidelity Asian values to their portfolios? The following chart and table illustrates the trust's NAV performance during my tenure as manager. See tables and charts in the free ebook. Nitin Bajaj's management tenure from 31st March 2015 to 31st July 2024. This table summarises the trust's NAV performance during my tenure as manager. My investment process aims to own good businesses run by honest and capable managements we trust, and only own them when there is ample margin of safety in a particular opportunity. I tend to identify fundamentally sound businesses at a time when they are considerably unloved and overlooked, which implies that the market has already assigned all worst-case scenarios to these stocks. As a result, for Fidelity Asian Values capital preservation is the first step in generating alpha over the long term. I believe that such fundamentally sound businesses are well placed for a meaningful valuation re-rating when investors begin to focus on reality rather than on chasing themes or following sentiment. Consequently, the trust owns businesses which are better quality than the market, as is evidenced by the differences in the return on equity for the trust when measured against the Asia ex-Japan Small Cap Index and available at much more attractive valuation levels. Isn't this what we all want to do? Own good businesses, but not pay too much for them? Nitin Bajaj has been manager of Fidelity Asian Values, FAV, since 2015. Loving capital discipline. Sue Noffke, the head of UK equities at Schroders, explains the positive impact that buying back shares can have on all types of listed company, including investment trusts. Anyone who follows the UK investment trust industry will be familiar with the concept of the share buyback as a mechanism for managing the discount between a trust's share price and its net asset value, NAV. They are a commonly used tool, increasingly so in the current environment in which, for a variety of reasons, many of which will no doubt be explained elsewhere in this book, discounts have notably widened. The case for buybacks. Not everyone is a fan of buybacks, but the economic argument in their favour is simple and strong. From the perspective of demand, a buyback program introduces an additional buyer of the trust's shares which can put upward pressure on the share price. As a secondary impact, the presence of the buyback can also signal confidence in the trust's underlying assets and strategy, which may attract more investor interest over time, further increasing demand. Meanwhile, from the perspective of supply, a share buyback reduces the number of shares in circulation for the trust in question, thereby enhancing earnings and dividends on a per-share basis. Remaining shareholders are therefore rewarded by owning a larger proportion of the trust as a whole. Furthermore, buybacks only make sense when a trust's shares are trading at a discount. By definition, this means the investment trust is effectively buying itself back at the price implied by its share price, which is lower than its NAV. This also has a beneficial impact for shareholders, because NAV per share is enhanced. The greater the level of discount, the more value that accrues to shareholders. On a daily basis, most investment trust buybacks are modest in scale, but if conducted consistently and with discipline, they can have a very material impact for shareholders over time. Taking the maths to an extreme, if an investment trust retires half of its equity over a period, all other things being equal, its earnings and dividends will double on a per-share basis. All other things never are equal, of course, but it is difficult to argue against this powerful logic. A potential strategy for any company. Investment trusts are listed businesses and undertake share buybacks within the framework of UK company law, specifically the Companies Act 2006. This permits companies to repurchase their shares, provided they have the necessary shareholder approval and can meet solvency requirements. The same legal principles apply to all UK-listed businesses, and while companies operating in industries outside of the investment trust sector may not need to worry about managing their discount to NAV, management teams are often highly sensitive to their market rating and can utilize buybacks to return surplus capital, improve financial metrics, and signal market confidence. In an environment where most market commentators acknowledge the significant undervaluation of the UK stock market, both in the context of history and when compared to other regions, we should not be surprised to see share buybacks becoming more popular with UK company management teams. Across its recently completed financial year, some 29, more than 60% of the portfolio holdings in Schroder Income Growth Fund, an investment trust I have had the privilege of managing since 2011, conducted share buybacks. This compares with 38% of the fund's holdings in the previous year. This is a significant increase which encompasses a broader range of companies across a wide range of sectors and all sizes. I believe this is a very positive development for shareholders in trusts and for the UK stock market more broadly for three key reasons. Firstly, we have a strong preference for businesses with healthy cash flows and solid balance sheets. Businesses with these qualities have the resources to deploy towards share buybacks when the time is right. Footnote 1. Secondly, this is a clear indication that the management teams responsible for the companies in which we have invested have the inclination to reward their shareholders. And thirdly, the increasing prevalence of share buybacks in the UK is a sign that businesses recognise that their shares are undervalued and are increasingly looking to do something about it. As is the case for investment trusts, the more undervalued a company's shares are, the more value can be created by retiring equity. Clearing the hurdle. Indeed, it could be argued that management teams should view the returns they can achieve on a share buyback as a hurdle, which any other potential use of surplus capital must clear in order to proceed. If the projected returns on, for example, an investment in new facilities or a potential acquisition are not as attractive as the hurdle rate of return delivered by a buyback, then that particular use of capital should perhaps not be pursued. This would demonstrate good capital discipline. Ultimately, businesses that have shown such capital discipline in the past have been rewarded for it. One that we have held in the past in the Schroder Income Growth Fund portfolio is the retailer Next. Its management team has consistently demonstrated capital discipline in recent years by using surplus cash flow for a combination of share buybacks when the shares have been lowly valued, or special dividends when the shares have been more fairly valued. Between 2000 and 2023, overall group sales growth was relatively modest, 5.7% per annum. However, over the same period, EPS and DPS grew annually by 12.5% and 10.4% respectively. Good control of costs played a role here too, as did a degree of operating leverage, but a significant part of this per-share growth stemmed from the consistent deployment of share buybacks. Share price performance was even more impressive, plus 15.3% annualized total return, with the valuation of the shares rising as the market increasingly came to appreciate the company's impressive capital discipline. Footnote 2. Next isn't currently held in the Schroder Income Growth Fund portfolio, but we are confident that the successes of the past can be emulated by the many undervalued UK companies that are currently demonstrating a similar degree of capital discipline. Among them is Shell. As well as delivering a dividend yield of 5.5% to shareholders annually, Shell is currently implementing a 3.5 BN buyback program, having already returned 13.5 BN through buybacks over the last 12 months. Footnote 3, shares outstanding have already reduced by 20% since 2019, which is already making a material difference to the company's per-share financial metrics. Another example is the mid-cap construction business Balfour Beatty. Among its many attractive characteristics is management's consistent capital allocation policy, which has delivered 755 million in shareholder returns over the last 4 years through dividends and share buybacks. This represents almost a third of its current market capitalization. It has retired more than a quarter of its shares in issue during this period, and, notably, its share price has more than doubled. Footnote 4. Other examples of portfolio companies that are currently buying back shares include Unilever, NatWest, Kinetic, Hollywood Bowl, and Lloyds. Indeed, with well over half of the current portfolio's constituents having bought back shares in the last 12 months, this represents a profound shift in capital allocation decision-making that spans a wide range of sectors and all parts of the market cap spectrum. All, however, are united by their management team's belief that buying back shares is a disciplined and value-enhancing use of surplus cash flow. A potential game-changer. To conclude, it certainly doesn't surprise me to see so many buybacks in the UK currently. It is well observed that the UK stock market is currently undervalued. Indeed, it may represent one of the cheapest asset classes available to investors anywhere in the world. This is not new news, however, and readers may be becoming bored of being told it. What is new is that the current trend towards share buybacks is potentially powerful enough to ultimately make a difference to this undervaluation. As we have seen from the case study of Next, and many other businesses around the world that have consistently bought back their shares to the benefit of their remaining shareholders, eventually the market responds. Perhaps it is already happening. It is interesting to note that the share prices of all the portfolio holdings mentioned above as examples of businesses that are buying back shares are, at the time of writing, up by more than 25% year to date. Footnote 5. Company management teams aren't the only marginal buyers of UK equities, however. Overseas corporates are also responding to the undervaluation of UK PLCs by stepping in and bidding for domestic companies at a record rate. Although this is immediately positive for the shareholders of the companies that are being acquired, it does raise broader longer-term issues about the health of the UK stock market and the wider financial ecosystem. Hence, we are seeing more public discussions around structural reforms which could revitalise prospects for the UK equity market. These have concerned potential changes to listing rules to create a more attractive environment for UK PLCs. There is also focus on whether more UK pension fund capital could be allocated to UK assets. If implemented effectively, both of these policy initiatives could also be positive for UK equities. Some of this improving narrative may be behind the moderation of UK equity outflows and the improved performance of UK equities over the last 12 months. We are hopeful that this will continue and would point to the increasing prevalence of share buybacks, the continued interest of overseas corporates, and the prospect of more supportive policy initiatives as reasons to be increasingly positive about the outlook. Sue Noffke is also the portfolio manager of the Schroeder Income Growth Investment Trust, SCF, a position she has held since 2011. Footnote 1. It is important to note that, as active and engaged shareholders, we would not be supportive of a share buyback unless the company in question possessed this financial strength. Without it, or in situations where a company is contemplating borrowing money to retire equity, a buyback can introduce more financial risk to the investment case, which generally speaking is not a good idea. Typically, a buyback should only be considered as a use for surplus cash flow. The clue is in the name. Footnote 2. Bloomberg from 1st January 2000 to 31st December 2023. Past performance is not a guide to future performance and may not be repeated. Footnote 3. Company records, as at 1st and August 2024. Footnote 4. Company records charge Bloomberg to 30th September 2024. Past performance is not a guide to future performance and may not be repeated. Footnote 5. Bloomberg to 16th October 2024 in capital return terms. Past performance is not a guide to future performance and may not be repeated. Time for a growth rebound? Baillie Gifford investment trusts have a distinctive growth style and as a result have been on a rollercoaster ride in performance terms over the last 2.5 years since interest rates started to rise. Now that they are set to come down, is this the moment for growth to make a return to its impressive glory days of the past? Stephen Paice, lead manager of Baillie Gifford European Growth Trust since the firm won the mandate in November 2019, certainly thinks so. Here's how he assesses the outlook. At the start of 2024, you said that you were in a bullish mood, and that the outlook for your style of investing was better than for several years. Why did you say that? 2023 marked the nadir for much of the cyclical weakness in the aftermath of COVID that we have seen in the likes of industrials, semiconductors, and life sciences businesses. Our view was that demand would return in these areas as inventories were built back up. We also believed that the interest rate environment, which has been punishing for valuation multiples, would cease to be a problem. A return to growth and attractive valuations will usually make you bullish. Has the trust's performance since the start of 2024 borne out that renewed confidence? And if not, why not? We have seen growth begin to return in these areas, although progress has been slow and we have produced a positive NAV return. However, the dominant mood in the European market seems to be one of uncertainty, and that has led to increasing concentration in the relative safety of Europe's largest companies. Our slower-growing version of the Magnificent Seven. Meanwhile, sentiment has remained stubbornly negative for small and mid-cap companies in which we have a large amount of capital invested. On which valuation metrics do you justify saying the companies you own are significantly cheaper than those in the Europe ex-UK benchmark index? Our investment horizon is 5 to 10 years, although we've held some companies for decades, and our approach to valuation reflects that. On a near-term price-to-earnings multiple, it might look like we are paying a premium, however, relative to prospects for earnings growth over the next 5 years, this is the cheapest the fund has been in almost 20 years. What do you see are the likely catalysts that will help accelerate the change in sentiment towards your shares? We don't need rates to fall or valuations to re-rate, it's all about fundamentals. Growth in earnings and free cash flow. If we keep exceeding market levels of growth, we'll either start to outperform, or valuations will get even cheaper. The fact that we are seeing so many inflection points gives us optimism that it'll be the former. You have had some disappointments in the portfolio in 2022 and 2023 where companies have not fulfilled the growth potential to the extent you anticipated. Can you give some examples on what you've learnt from them? Investment is full of mistakes and disappointments. Over the past few years, these have been painful, but the key thing is to ensure their net present value positive and the lessons result in outperformance over time. On reflection, we had too much invested in immature business models such as food delivery platforms, and we should have been more ruthless where exuberance had gone too far. We're always seeking to improve as investors and evolve our process. One such evolution has been our use of price-implied expectations models to better understand what a company is required to produce to justify its current share price. This gives us a much clearer picture of our variant perception and has been a useful tool so far. Can you give some detail about the largest new positions you have taken to replace those stocks which have gone out of the portfolio? We have been quite active this year and have taken holdings in companies with a variety of different growth drivers which we're excited about. One such company is Camurus, a profitable biotech company involved in reformulating the delivery of existing medicines into long-acting injectables, which has experienced a lot of success in addressing opioid addiction. Another would be Dino Polska, a grocery chain in rural Poland. This is a rollout story with a lot of white space for Dino to move into, giving a long runway of growth at high returns on capital. A third example would be Instalco, a serial acquirer of technical installation businesses across Scandinavia. Its operational track record is very impressive, but the valuation hasn't reflected this, giving us the opportunity to buy a company which can grow for many years at a very attractive price. Which stocks in the portfolio do you think have the highest potential for growth over the next 5 years? We think there's high growth potential throughout the portfolio. If you were to ask me to pick two, though, we'd suggest Topicus and Soitec. Topicus is consolidating the vertical market software industry and is growing at a rapid rate, something it can do for a long time given the fragmentation of its industry. Soitec manufactures performance-engineered substrates for the semiconductor industry. It has experienced a prolonged period of cyclical weakness, but we can see signs that demand is picking back up, while the long-term excitement relates to its expanding use cases, which include automotive and industrial semiconductors. How have your private company holdings performed? Our private company performance has been mixed. On the one hand, we've had a valuation uplift from Bending Spoons, pleasing progress from Sender, which has acquired C.H. Robinson's European road freight forwarding business, and Flix has attracted more capital at a good valuation. On the other hand, McMackler and Northvolt have faced challenges which hopefully can be overcome. We can be patient when looking for new ideas in the private markets, but generally remain optimistic about the increasing opportunity set in Europe. You have maintained or increased your levels of gearing over the past 2 years. What drives your approach to gearing, and how high could it go given your high degree of confidence? Levels of gearing have been driven by the performance of the portfolio over the past 2 years, rather than by any active decisions. When performance is good, gearing has gone down, and vice versa. More generally, though, we would seek to increase gearing when valuations are attractive. This is a capital allocation decision we regularly speak to the board about. In extreme circumstances, we could take it to 20%. Despite a wider discount, the board has not authorised significant amounts of share buybacks in 2023 or so far this year. Why is that, and will that policy be maintained going forward? Our focus as managers is on growing the company's net asset value, and if we do so, the discount should take care of itself. The board has been more active this year with buybacks though, given the relatively wide discount. The portfolio has a disproportionate allocation to small and medium companies compared to the benchmark, and again is the outlier in the sector on this measure. Is that mainly the result of stock selection or a conscious decision that the environment is likely to favour small and mid-cap stocks at this point of the cycle? It's an output of bottom-up stock picking. This is where we find the best companies, although history also shows that the majority of big stock market winners in Europe come from small and mid-caps. These companies typically offer higher growth and more profit margin expansion. If you can buy them when they are collectively out of favour, it can be even better. Do you have a target for the performance of this trust looking ahead over 5 years? We don't have a specific target. We want to achieve strong NAV outperformance and hope that will help to close the discount. Every company we invest in has a reasonable chance of at least doubling over a 5-year period, which equates to at least a 15% annual rate of return. Do you think it's realistic to think about the trust returning to trading at a premium as it did briefly after the pandemic? As stated earlier, it's all about performance. If we can generate the kind of performance track record which saw us appointed as managers in 2019, we think the trust can command a premium in time. What are the major risks to the positive future you have expressed? We think the risks are skewed to the upside, but prolonged weakness in global economic growth and intensification of geopolitical issues present risks to all investors. Finally, why should potential shareholders look at this trust in preference to others in the European peer group? Can they always expect it to trade in a volatile manner? We are offering something quite different through exposure to dynamic growth companies in both public and private markets. These companies are exposed to many attractive secular trends, but are also now benefiting from cyclical tailwinds. Performance has been very volatile, but part of this relates to interest rates moving faster and higher than in any period since the 1970s. We are very optimistic about the future. Hopefully at some point we will look back at the 14% or 15% discount and talk about what a bargain it was. Stephen Paice is the head of European equities at Baillie Gifford. Selective on bonds. Ray Davies, manager of the Invesco Bond Income Plus Investment Trust, reviews the latest movements in the sovereign bond and credit markets for us, as he did last year. The first interest rate cuts from central banks have only just arrived, presumably a little later than you expected. At the start of the year, market pricing pointed to a widespread anticipation of earlier and more frequent rate cuts in 2024. By the end of 2023, we found ourselves holding more rate risk than the previous year, not just in the trust but across other products. This wasn't so much about being certain of when the cuts would happen, but rather a strong belief that we were nearing the peak of the rate cycle. The yields were simply too attractive to pass up, and we were eager to integrate them into our portfolio. How far do you think US and UK rates could fall from their summer 2024 levels? There's definitely room for rate cuts now. With inflation retreating to more manageable levels, central banks should be feeling a lot more at ease. This sets the stage for potential cuts, though the extent will heavily depend on upcoming data. A key factor to watch is the labour market, both in the US and Europe. If we start seeing signs of weakness there, we could witness more aggressive cuts than currently anticipated. It's not uncommon for central banks to overshoot in both directions. US government bond yields backed up again in October. Does that concern you? Our view is still, it's a nice time to be buying bonds because there is a lot more income, a lot more yield today than there has been. The inflation picture is still heading in the right direction, which is a positive for bonds. Obviously, we need to be very aware of the fact that if the central banks do turn on the monetary taps again, then we've got to think about what could happen with inflation in the medium to long term. But for now, it's still looking relatively buoyant in terms of the economy. We haven't really seen the recession that people have been so concerned about. There is a lot of demand for credit at the moment, and not quite enough supply, so there's a strong technical picture. That said, we have a more cautiously positioned portfolio than many, given the potential risks that lie ahead. I've still got relatively high exposure to investment-grade bonds, just under a third of the portfolio. Within the riskier high-yield market, we are staying away from some of the more leveraged, weaker credits. Our CCC exposure is very low, and single B exposure low as well. To give you an idea of the strength of demand in the high-yield market, we have just seen an issue by the company that owns the Autoglass brand, which is very stable, and a lovely business for bondholders. It just offered the biggest dividend to shareholders, funded by the high-yield market, that I have ever seen on a 4.625% coupon, and it has traded up since then. The flip side of that, of course, is that the opportunities for us are less abundant than they were 1 year ago. Since the sell-off in 2022, we have seen the yield on the European high-yield bond index come in from 8% to 6.8% a year ago, and today it is at 6.3%. How do you assess your performance over the last 12 months? In the year to the end of August, the net asset value of BIPs rose 13.6%. That's in line with the return of the ICE BOFA European Currency High Yield Index in GBP hedged, which is a comparator we use. Throughout this period, we've enhanced the credit quality of the portfolio, with about a quarter now invested in investment-grade securities. With that in mind, the portfolio has done well on a risk-adjusted basis. However, it's worth noting that if we had taken more credit risk, our returns could have been even higher. What is the outlook for shareholder returns in this context? Will the balance between capital gains and income generation change? What is the potential path of dividends? The portfolio is generating ample income for BPS to sustain the dividend at 11.5p per share, a level that is regularly reviewed by the board. Currently, this equates to a dividend yield of 6.6%, while the portfolio's income yield is even higher at around 7%. Additionally, with the average bond price in the portfolio at 92.5, there's significant potential for capital appreciation to further enhance returns. You have been generally more cautious than others in the debt sector. Why is that? And what, if anything, will push you towards higher risk? Balancing risk and reward is always key. As yields have increased, we've been happy to earn income from safer investment-grade bonds without taking on extra credit risk. We've been cautious about the riskiest high-yield bonds, as many companies still face higher borrowing costs when they refinance their debt. When looking at individual companies and bonds, we're willing to take on credit risk if we believe the compensation is adequate. This year, we've added bonds with large and attractive coupons to our portfolio. What would make us take on more risk more broadly? Simply put, higher potential returns. If credit spreads generally widen from here, we'll consider adding more risk. Describe what has been happening to your gearing and how you see that might develop. In response to the higher yield environment of 2022 and 2023, we strategically increased our gearing. However, as spreads have tightened, we've scaled back and are now near the lower end of our typical range, with gearing at about 12%. We understand that leverage carries risks, so we only employ it when we feel the rewards justify it. To consider increasing it again, we'd likely need to see wider spreads. How concerned are you by the risk of slower global economic growth? What is happening to default rates in high yield? Growth has outperformed many expectations so far, helping corporate earnings. In turn, this has kept default rates surprisingly low, despite the significant rise in borrowing costs since 2021. Expectations for default rates remain well contained, and demand for high-yield bonds has been robust, easing concerns about a looming maturity wall. However, we remain cautious. There's still potential for economic weakness, and the rewards for taking on that risk aren't particularly enticing. The effects of the substantial monetary tightening we have experienced can take time to manifest. Unusual factors such as US fiscal policy and the savings buffer from the COVID period have been propping up growth. While we don't foresee a major slowdown, there's a risk of more weakness than current prices reflect. Why are spreads in corporate bonds where they are? Does it speak to complacency? We are certainly seeing bonds come to the market with yields that look unattractive to us, but demand is generally holding up well. So, you could deduce that some market participants have a more positive outlook than us. What we are really interested in is buying bonds that will provide good income to the trust, and avoiding bonds where there might be real credit stress. You are one of the very few trusts to have been able to raise new equity this year and still trade around par. How are you hoping to capitalise on that? It's been fantastic to issue shares and see strong demand for BAPs. I believe a couple of factors are working in our favour. Firstly, we're investing in an asset class with excellent price transparency, which gives investors greater confidence in the net asset value. Secondly, our long-standing presence in the market hopefully provides reassurance to investors. Our approach is straightforward. We buy a diversified group of bonds that we think are creditworthy and paying an acceptable coupon. We base our bond selection on fundamental credit research, and we manage the portfolio actively. The income from these coupons allows the trust to pay dividends, and we aim to continue this as long as people want to invest. Are you concerned about the impending first budget from Rachel Reeves and what impact it might have on the gilts market? In general, the US Treasury market is the biggest influence on the gilts market, and that remains the case today. But there has also been some additional weakness because of the uncertainty ahead of the budget. At the back of the market's mind is what happened 2 years ago with Liz Truss, but I think Rachel Reeves is very aware of the need not to repeat that. The government has also made it very clear that they want to rein in spending. Davies has been the lead portfolio manager for Invesco Bond Income Plus since 2014. Marketing Investment Trusts, fund marketing expert Lucy Walker, the chair of Aurora Investment Trust, explains what investment trusts can do to recruit more shareholders, a crucial imperative when discounts have become so wide. When I took on the role of chair at Aurora Investment Trust in 2022, investment trusts were facing many challenges, and these have only accelerated since. Traditional methods of engaging with investors are no longer enough. Through founding my fintech business AM Insights in 2020, I was lucky to have experience in digital and marketing that I could employ to consider how investment trusts could best adapt. The challenges facing investment trusts, numerous challenges have faced investment trusts in recent years, but two are critical from a marketing perspective. 1. A shifting investor base. Wealth managers were historically the traditional buyer of investment trusts, yet the sector has been undergoing significant consolidation, leaving fewer, larger players. This not only reduces the number of potential investment trust buyers, but also raises the minimum size requirements. What used to be a £100 million market cap threshold became £250 million, and today is £500 million, or even £1 billion for the largest wealth managers. This puts a significant proportion of the sector in jeopardy and helps explain the M&A activity we have seen recently. What that means is that investment trusts today must reach a broader audience, including retail investors who may not be as familiar with the investment trust model. 2. Lack of differentiation. The UK has more than 10,000 investment products available for sale, so differentiation is absolutely key. Investment trusts must make use of their unique features, such as concentrated portfolios, illiquid assets, and the strategic use of leverage and revenue reserves. Those not doing so will find investors questioning why they are not in an open-ended structure. Yet differentiation alone is not enough. Those differences must be effectively communicated, and marketing strategies have to highlight what makes them unique and why it matters. It is no surprise that much of the M&A we have seen has focused on trusts which are not sufficiently differentiated to others in the market. What can investment trusts do? With these challenges in mind, here are 6 key strategies that can help investment trusts not just survive, but thrive. 1. Differentiation and unique selling points, USPs. Why should an investor consider your trust? Whether they are dividend seekers, growth investors, or looking for long-term stability, investment trusts must clearly articulate what sets them apart. This isn't just about investment philosophy, it is also about how the trust fits into an investor's broader portfolio. Messaging that resonates with your target audience, especially retail investors, is crucial. At Aurora, we've identified 3 core USPs: patience, the trust has exceptionally low portfolio turnover; focus, the portfolio is very concentrated and the manager has an unusually high ratio of analysts to portfolio holdings; alignment, the trust has a distinctive fee structure where the manager earns no annual management fee, only a performance fee. To build credibility, USPs need to be backed by evidence. Investors don't just want broad claims, they need to understand why these aspects matter and how they translate into better returns or stability for their portfolios. The right data points provide the necessary proof to strengthen your marketing efforts. 2. Website and advertising. In today's world, relying on fact sheets and investment platforms isn't enough. A strong digital presence is a non-negotiable requirement, and direct-to-consumer marketing must also be part of the equation. Running a technology business, it won't surprise you that I advocate that trusts must have an effective and user-friendly website. It's your digital shopfront and most likely one of the first interactions a potential investor will have with you. At Aurora, we completely overhauled our website to ensure it is not only visually appealing, but also highly functional and accessible across all types of device. A simple customer journey with good UX, user experience, forgive the jargon, is critical. It must be easy for potential investors to find what they're looking for, whether that's the fact sheet, performance data, or information about the investment manager. In terms of advertising, automated display ads, also known as programmatic ads, can drive awareness and exposure among retail investor audiences. These ads, which often appear as banners on websites, can be targeted at specific demographics, interests, and behaviors, making them an efficient way to reach potential investors. Ideally, to ensure the best possible results, you should test and optimize the ad formats, the creative elements, images, and the messaging. Targeted digital advertising such as pay-per-click, PPC campaigns on Google, or content partnerships with financial news websites can also be effective. 3. Content and public relations. Intentional and strategic content is crucial to ensure you don't just inform but also engage and attract both new and existing investors. It's important to be deliberate about what topics to cover, in what medium and how frequently. Blogs, white papers, and educational resources are all effective options that can add value to your audience while reinforcing your trust's USPs. For larger, well-resourced trusts, educational content can demystify investment trusts and build trust with a broader audience. While this may be more challenging for smaller trusts or those managed by boutique firms, the principle remains the same. Marketing messages should address outcomes that matter to retail investors, such as the potential for inflation-protected returns. PR plays a complementary role in amplifying your message to a wider audience. Industry press coverage targets professional investors, while national publications can reach retail investors. Securing news coverage and profile pieces can significantly build credibility and broaden a trust's reach. 4. Social media. Organic social media, meaning free rather than paid by advertising, should be another crucial part of your content strategy. LinkedIn in particular offers a great avenue to expand a trust's reach. Many trusts haven't taken the simple step of claiming their LinkedIn page, yet just by adding a logo you can boost brand awareness. By consistently sharing relevant content, engaging in industry conversations, and interacting with followers, investment trusts can build a community of informed investors. LinkedIn has been a powerful tool for me personally. By posting consistently over the years, I've grown an engaged following of more than 7,000 people, which directly leads to new business inquiries. A number of trusts are doing the same. Scottish Mortgage is an example with more than 5,000 followers. The absolute numbers are not what matters, however. It is engagement and brand awareness that count. Everyone, and every trust, has to start somewhere. 5. Podcasts and webinars. Whilst marketing strategies such as revamping your website or running advertising campaigns are costly, podcasts and webinars are more cost-effective ways to capture attention and demonstrate expertise. They allow managers and board members to engage with multiple investors simultaneously, building credibility without the need for one-on-one meetings. They also provide value to both retail and professional investors. I've seen the power of these approaches myself, having been featured on a number of podcasts, including the Handbook Editor's Weekly Moneymakers. I took the step of launching my own podcast, Fund Selectors, which has been very well received. It is a lot of work, yet trusts don't need to run their own to see the benefits. It took me a number of years to launch mine because being featured on existing podcasts is incredibly effective. Trusts, especially smaller ones, should aim to focus on getting key people featured to reach a wider audience. Sharing this content via social media further amplifies these channels, making them even more effective ways of extending your reach and growing your online following. 6. Partnering with platforms. Investment platforms like AJ Bell and Hargreaves Lansdown are essential partners for reaching self-directed investors. These platforms are trusted by retail investors and offer a significant opportunity to increase your trust's visibility. This can involve anything from presenting at their events and webinars to advertising on their websites. These engagements not only drive exposure but also help to build trust with potential investors who may be exploring their options. Events, both online and physical, are valuable opportunities to connect directly with investors, positioning your trust as a credible choice. Conclusion. Taking on the role of chair at Aurora Investment Trust gave me the opportunity to address the challenges facing the investment trust sector with fresh eyes. From day one, it was clear relying on traditional methods wasn't going to cut it. We needed to adapt and embrace new ways of reaching our audience. The strategies we've implemented, whether refining our USPs, overhauling our website, or finding new ways to engage with investors, are all about staying relevant. These efforts have been heavily informed by my experience with AM Insights, where everything we do is based on tech and digital. For investment trusts to succeed, boards must be crystal clear about what makes them stand out, ensuring messaging resonates with both retail and professional investors, and being open to new ways of engaging their audience. As the Chinese proverb says, the best time to plant a tree was 20 years ago, the next best time is today. Now is the time for boards to take a step back and reassess their positioning and marketing strategies. Are your unique selling points clearly defined and communicated? What does your digital presence look like, and how could it be improved? Are you effectively engaging with both retail and professional investors? By addressing these questions today, you can help your trust thrive tomorrow. Lucy Walker, a former professional fund manager, has been a director of Aurora since December 2019 and chair of the board since 2022. She launched AM Insights, aminsights.com, in 2020. View from the garden. Simon Edelston, the recently retired manager of Midwind Investment Trust, takes a fresh look at the global equity sector. My first city job was at Grenfell and Colegrave Stockbrokers in 1984. They had a very basic early computer, and we used that to value investment trust debentures. I then did some investment trust broking and deals at BZW. Then I helped Niels Tauber manage the quoted part of RIT Capital in the early 2000s, and we managed Electric and General later in the decade. Most recently at Artemis, I managed the Midwind Trust with Alex Illingworth until retiring last year. I've spent the last year in the garden looking at investment trusts from the other side of the fence, so to speak. How does it look from the perspective of a private investor? My main interest is the Global Equity Trusts Group, where investment trusts started with the Foreign and Colonial Trust in 1868. Over the 156 years, these trusts have offered British savers a way to invest around the world. The structures facilitated holding overseas equities and bonds, allowed some gearing, and were overseen by a board of directors who, at their best, would encourage the fund managers during gloomy times and calm down the fund managers when they became overexcited. Why have discounts widened? Not much has changed. The performance of the surviving large global equity funds has continued to be excellent over the last 5 years. The weighted average net asset performance of the group is 71% to the end of September 2024, and the performance of the MSCI All World Index only 64%. However, as discounts have widened, the full increase in net asset value has not come through to share prices. These have only risen by 60% on a weighted basis. Furthermore, the short-term performance of the group has not been so strong. Over 1 year, net asset values have risen by 17%, while the index has risen by 20%. That is still a happy outcome for most investors, but it is understandable if some investors argue that a tracker fund has done a better job. By their nature, tracker funds do not carry the same risk of seeing their discount to asset value widen. What have boards done? The boards of the global investment trusts have been stalwart in trying to reduce discounts over the last year, but this may have seemed like a thankless task. The Midwind board has long maintained a 2% discount limit, but holding the line here has led them to buy in a fair amount of their shares over the last year, as investors have got to know the new manager. Ahead of its merger with Alliance Trust, Witan held over a third of its shares in Treasury, and Keystone Positive Change, which has changed its manager twice in recent years and adopted a new mandate in 2021, has similarly found it hard to manage its discount, leading the board to propose winding up the trust. While high discounts seem a permanent risk today, it is not that long ago that many trusts were trading at a premium and issuing new shares. Alex Illingworth and I took on the management of Midwind from Bailey Gifford in 2014. We continued the board's 2% discount control policy, and in the early months bought nearly a third of the shares into Treasury. However, over the next few years we were gradually able to build a larger investor base and reissue not just the Treasury shares, but also issue further new shares, more than doubling the share count over the next 8 years. This was helped by the consistent policies of the board, a clear message about how we manage the investments, and a steadily rising global equity market. Which global trusts offer what? Looking at the global equity trusts today, it seems likely that some will be able to reduce their discounts, as long as their managers pick some decent stocks. The F&C Trust performance record has been consistently good, and the current near 10% discount does not seem merited. Although Lindsell Train have a style which has not worked well recently, their longer-term record is exceptional, and the time will come again. On the other hand, both Alliance Trust and Witan have had persistent discounts in the past, and it is hard to see how the combination will make those issues any smaller. The other global equity trusts have peculiarities which might not suit all British savers. Scottish Mortgage retains an excellent long-term record, but the volatility in recent years has worried many. High volatility is, in my view, a serious issue for trusts, as your investors may not stick with you through the dark times to enjoy the rewards over the long term. In my view, boards should discourage investment approaches which are likely to increase volatility, such as very large individual stock positions, very large unlisted equity holdings, or excess use of gearing. The AVI Global Trust and the Brunner Trust have also produced very good performance. The former is a deep value investor, an investment approach which has worked well in recent years, but which worked less well for a number of years in the mid-2010s. The managers explain clearly how they go about selecting stocks, and some savers may wish to allocate a portion of their savings to this approach, especially if they believe that the larger growth stocks in the index, Microsoft, Nvidia, et al., are highly valued at present. The lesser-known Brunner Trust has seen its performance record improve sharply since Julian Bishop took over the management. It aims to outperform an unusual, old-fashioned benchmark of 70% global equities and 30% UK equities. Regardless, the managers have delivered a net asset value return of over 30% in 3 years, well ahead of the global trust peer group. This is, however, reflected in the trust now trading at a very low discount to net assets. The future. The last year has seen many British savers choose tracker funds over traditional investment vehicles. The bulk of the money which has flowed into index funds seems to have come out of unit trusts, which generally have not performed as well as the investment trust peer group in recent years. This probably accounts for some of the widening of discounts, though another issue has been the misleading way in which trusts were asked to declare their charges, an issue which seems finally to have been resolved. There will always be and should always be competition between products which offer a core long-term savings fund. Investment trusts have coped with the arrival of unit trusts in the 1970s, index funds more recently, and will need to compete with active exchange-traded funds, ETFs, in future. However, their structure, options, availability through being listed and their competitive charges should continue to attract savers as long as the managers do a good job. The group should look back to the last 150 years of success for British savers and look forward to the next 150 years with confidence. Simon Edelson was manager of Midwind from 2014 to 2023 and contributes periodically to the Financial Times. Trust Profiles, Allianz Technology Trust, by Stuart Watson. Allianz Technology Trust, ATT, has been managed by Allianz Global Investors, Allianz GI, since 2007, with Mike Seidenberg taking on the lead manager role in 2022, although he has been working on the trust since 2009. From April 2007 to June 2024, ATT's annualized NAV return was around 17%, usefully ahead of the 15.5% a year produced by its benchmark and much further ahead of global stock indices. The three largest UK-listed technology trusts were all launched within a few years of each other in the mid-1990s. Herald, HRI, managed since it joined the market in 1994 by Katie Potts, was the first, and it specialises in small caps and has a significant UK weighting. Allianz Technology, ATT, was launched in 1995, and Polar Capital Technology, PCT, came along in 1996. Both the Allianz and Polar funds are focused on larger technology stocks and consequently are heavily weighted towards the US market. ATT was originally known as Finsbury Technology and run by Finsbury Asset Management, with Michael Bourne as its lead manager. When Bourne stepped aside at the start of 2007, the trust decided to appoint a new management firm in the form of RCM, a subsidiary of Allianz GI. Walter Price became its lead manager, and he led the trust until his retirement in 2022. Mike Seidenberg has been ATT's lead manager for the last couple of years, although he began working on the trust alongside Price back in 2009. PCT was originally managed by Henderson before its managers struck out on their own and launched Polar Capital in 2001. PCT has been run by Ben Rogoff since 2006 and was profiled in last year's handbook. That means all these technology trusts have long-standing management teams who have been closely involved in looking after their portfolios for at least 15 years, during which time they have experienced numerous sector cycles and market backdrops. The managers' views on current valuations seem similar in that while they recognise that tech stocks are valued higher than average by historical standards, they do not seem to think they are excessive, especially when compared to the nosebleed levels we saw in the late 1990s. There continues to be plenty of enthusiasm for the sector's prospects over the long term, with themes like AI, cybersecurity, and the cloud providing multiple drivers for earnings growth, and many firms having robust balance sheets and generating ample cash flows. Increased regulation is seen as a potential near-term threat, particularly for the very biggest tech stocks. Over the long term, regulation may be less of an issue, with Microsoft being a case in point. It had antitrust issues in the past, but that hasn't prevented it from becoming a multi-trillion-dollar business. In short, despite the technology sector enjoying stellar returns over the last 2 decades, there are plenty of reasons to think that it might continue to outperform, although perhaps not to the same extent it has in the past, now that technology stocks make up a much larger proportion of the market and the global economy. The history of ATT. Finsbury Technology was launched in December 1995 and run by Finsbury Asset Management. It was a small fund at that time, with around 27 Metler shares issued at 100p. Ria Brothers had taken over Finsbury Asset Management earlier in 1995, and then Ria, in turn, was acquired by Close Brothers in the summer of 1999. Michael Bourne was the trust's first lead manager, and he looked after the portfolio from its launch until early 2007. Although it is ancient history now and well before the current management team of ATT took charge, I think it is worth revisiting the excesses of the late 1990s and the slump that followed, as it provides useful context to measure the recent enthusiasm for tech stocks. ATT's share price rose more than 7 times in its first 4 years, peaking at 728p in March 2000. 3 years later, nearly all those gains had been wiped out, with the share price falling back down to 113p, a drawdown from the previous peak of a colossal 85%. It was not until 2016 that the share price peak hit in March 2000 was surpassed. As 2006 drew to a close, Close Brothers decided to reorganise its business, and Bourne decided to leave for pastures new. The Trust's directors put the investment mandate out for tender, and Allianz GI, under its RCM brand, was appointed as its new management firm. The Trust was known as RCM Technology for several years before adopting its current name of Allianz Technology, later on in 2014. The vastly experienced Walter Price became ATT's lead manager in 2007. He had been with RCM since 1974 and managed technology portfolios since 1985. He recruited Mike Seidenberg to his team in 2009. Seidenberg later became the Trust's co-manager and lead manager in 2022, when Price, then in his early 70s, decided to retire. Seidenberg is the lead portfolio manager and a senior member of a team of 5, each of whom has at least 17 years of industry experience. They are all based in San Francisco, giving them easy access to Silicon Valley and the head offices of many of the largest technology companies. In the post-COVID world dominated by online video meetings, that is arguably less of an advantage than it was previously, but it is a notable differentiator from the likes of PCT and Herald. Seidenberg is in his mid-50s, so you would expect him to be managing ATT for some time to come. He spent the first 10 years of his career working in the software business and at Oracle Corporation, before working at a number of hedge funds in the 2000s. And then teaming up with Price at Allianz GI in 2009. Allianz GI's US fund management operations were merged with those of Voya Investment Management in 2022, with Allianz GI taking a stake in Voya in return. San Francisco office personnel and managed strategies transitioned as part of this deal, but there was no change in strategy which took place. As of June 2024, Voya had assets under management of $336 billion, with the global technology team that looks after ATT accounting for around $7 billion of that. ATT represents around a quarter of the team's $7 billion. When Allianz GI took over running the trust in 2007, the share price was a split-adjusted 22p and net assets were around 60 mils. As I write this, the share price is around 325p and net assets are around 1.4. Returns over this period have been in the region of 17% a year, beating the trust's benchmark, the Dow Jones World Technology Index, by 1.5 percentage points a year. Key statistics for Allianz Technology Trust. Listed December 1995 at 10p after adjusting for a 10-for-1 share split in May 2021. Domicile UK management firm. Allianz GI since 2007. Investment manager Voya Investment Management since 2022. Manager Mike Seidenberg since 2009, lead since 2022. Ticker ATT. AIC sector Technology and Technology Innovation, 4 trusts. Benchmark, Dow Jones World Technology Index, NAV update frequency, daily. Market cap, 1.25 biennial as at September 2024. Costs, ongoing charges of 0.7%. Management fee, 0.8% of market cap up to $400 million, then 0.6% up to $1 billion, and 0.5% above $1 billion. Performance fee, yes, 10% of outperformance with payment capped at 1.75% a year, and any excess carried forward, with standard high watermark and catch-up provisions. Discount control policy considers buybacks when its discount is consistently greater than 7%. Continuation vote, every 5 years with the next one due at the 2026 AGM. A number of holdings, 43 as at June 2024. Top 10 holdings, 55% as at June 2024. Gearing, typically ungeared with a small net cash position. Year-end, 31st December, results released March, finals, and August interims. Dividend, no dividends paid to date. Financial history. ATT's financial history is relatively straightforward. It has not merged with or taken over any other trust and has paid no dividends since its IPO in 1995. It did issue some subscription shares on a 1-for-5 basis in 2007, shortly after Allianz GI took over, most of which were converted into ordinary shares in 2012. ATT hasn't used any gearing in recent years, taking the view that tech stocks are volatile enough on their own. Table 1 shows ATT's net assets, NAV per share, share price, discount, and share count since Allianz GI took over in 2007. The trust's financial year-end switched from November to December in 2017, so that period comprises 13 months. All the figures have been adjusted for the aforementioned 10-for-1 share split in 2021. See tables and charts in the free ebook. Table 1, ATT Financial History. It is remarkable to see that net assets were still less than 100 mil as recently as 2012. The level of net assets is many multiples of that today, of course. For over 2 decades, the share count did not change much from the split-adjusted 267 million issued at the 1995 IPO. There was some regular issuance around the turn of the century and some scattered buybacks during the 2000s. The exercise of the subscription shares saw the share count rise in 2012. From 2018 to early 2021, ATT regularly traded at a premium, and this resulted in a few years of significant regular share issuance, with the share count jumping by 65% from 260 million to 429 million. With respect to the current stance on discount control, the directors consider buybacks during periods where the discount is consistently over 7%, and it is felt appropriate to do so given the prevailing market backdrop. That policy has led to the share count decreasing by just over 10% over the last 3 years. It has been rare to see the discount widen beyond 10% for any extended period, so the stated discount control policy seems to have worked as intended, although the discount has briefly stretched out as far as 15% at times. The Trust's website deserves an honourable mention as it provides downloadable accounts going back to 2003 and AGM presentation slides since 2008. ATT has its own podcast and provides regular video updates as well, so there is plenty for current and prospective shareholders to get their teeth into. Returns versus benchmark and peers. ATT uses the Dow Jones World Technology Index as its benchmark for the calculation of its performance fee. PCT uses the same comparator. This index contains around 1,000 companies, although it does have a couple of notable omissions from what most people would consider as technology stocks in the form of Tesla and Amazon. The index is also a little more international in flavour than the Trust, with a mere 80% US weighting, whereas ATT's portfolio often has 90% or more in US-listed stocks. With the multinational nature of most technology companies, this weighting is much more neutral in terms of global generation of revenues. The team also feel that currently the US is where much of the global innovation and listing occurs for tech companies, and see this as an advantage of their location. Table 2 shows how ATT has performed against its reference index since Allianz GI took over. See tables and charts in the free ebook. Table 2, ATT performance versus benchmark. In rough terms, ATT has returned 17% a year since Allianz GI has been in charge, while its benchmark sits at around 15.5% a year. That is a pretty decent margin of outperformance against a very tough comparator. Global market returns have been around 10% over the same time, similar to the long-term average, but miles behind the returns from tech stocks. ATT's returns over the last decade are broadly comparable to its benchmark, and, looking at individual years, it is relatively rare to see a difference of more than 10 percentage points. 2013 and 2022 are notable exceptions, both in a good way. That may be because although ATT's portfolio is a lot more concentrated than its benchmark, it still has significant positions in the very largest tech stocks. With many specialist equity trusts, you tend to see outperformance in bull markets and returns lagging in bear markets, but that has not historically been the case with ATT. PCT is ATT's most obvious rival, and there is frequently little to choose between the two in terms of performance. As I write this, ATT has the slight edge since 2007 with a return of 17.3% a year in share price terms, with PCT just behind at 16.4%. I would say that ATT is probably a little more aggressive in terms of its selection of mid-cap tech stocks and the number of positions it holds, but the two trusts often move in tandem for long periods, and picking slightly different start and end points when measuring their performance can often switch the order in which they rank. Herald's UK focus and preference for much smaller companies have seen it return around 10.5% a year since 2007. That is a very respectable performance, but its approach is quite different from ATT and PCT, as it holds a much larger portfolio of around 300 positions, and is considerably more biased towards UK-listed stocks. Scottish Mortgage is another handy reference point for ATT, although it was still in the process of switching to its current disruptive growth strategy back in 2007. It has returned 14% a year since 2007, although its returns from 2007 to 2021 were quite similar to both ATT and PCT, so it's lost some ground in the last few years. The AIC's technology and technology innovation sector contains 2 other trusts. However, both are very small and have limited history, so for the time being at least they aren't particularly useful reference points for assessing ATT's performance. Investment policies. ATT's official objective is to invest principally in the equity securities of quoted technology companies on a worldwide basis, with the aim of achieving long-term capital growth in excess of the Dow Jones World Technology Index. It adds that particular emphasis is placed on companies that are addressing major growth trends with innovation that replaces existing technology or radically changes products and services, or the way in which they are supplied to customers. ATT defines technology stocks as companies that sell technology solutions, or where technology is an intrinsic part of their business, but it acknowledges the exact definition of a technology stock can be hard to pin down. It also highlights that disruptive innovation brings change and displaces incumbent market leaders. The challenge is to understand not only current technologies but also future trends and the likely effects. Around 95% of its portfolio falls into the following 8 categories, although many holdings straddle more than one: AI, machine learning, cybersecurity, the Internet of Things, robotics, metaverse, Web 3.0, blockchain, digital assets, mobility, e.g. electric vehicles, digital media, digital consumer e-commerce. There is also a small weighting towards fintech and renewables energy transition. One area that is excluded is biotechnology, which Seidenberg regards as a self-contained specialist area outside his or his team's realm of expertise. No country or regional weightings are targeted, instead using the bottom-up approach of focusing on the most attractive companies on a fundamental basis. As there are a few giants in the technology sector, single-stock concentration is limited to 15% at the time of any purchase, with regular reviews between the manager and board when any positions exceed 10%. Nvidia 12% at the time of writing was the only position at double-digit levels. ATT says that in normal conditions, gearing will not exceed 10% of net assets, but that it can increase to 20%. However, it currently does not have any borrowing facilities in place and does not use derivatives either. The trust says it can hold up to 15% in cash in normal conditions, with the ability to increase to 30% if deemed necessary. In the last 5 years, net cash appears to have ranged between 0% and 5% most of the time, briefly rising to 10% on a few occasions. Portfolio. ATT predominantly invests in large and mid-caps. Over 70% of the portfolio is invested in companies with a market cap of over 100 billion, with nearly all the remainder valued at between 10 billion and 100 billion. Only 1% of its portfolio is valued at below 10 billion, and ATT usually sets a floor of around 2 billion when considering new positions. Similar to the US market and the global technology sector, ATT's portfolio has become quite a bit more concentrated over the last few years. At the end of 2021, it held 64 stocks, with 39% in its top 10. By June 2024, those figures were 43 and 55%. The top 10 includes Nvidia, Microsoft, Meta Platforms, Apple, Amazon.com, and Alphabet, so Tesla is the only member of the so-called Magnificent Seven that is no longer in its portfolio, having been a profitable holding in the past. ATT tends to be underweight this group as a whole, so that it has the ability to take more meaningful positions in smaller and medium-sized tech stocks. Broadcom, ASML and TSMC also feature prominently among ATT's larger holdings, with an increased weighting towards semiconductor stocks being another recent phenomenon. Notorious for its cyclicality in the past, Seidenberg highlights that the sector now benefits from increased demand, improved supply chains, and strong investor sentiment related to AI and other chip applications. In addition, the industry is in better shape cycle over cycle, with less excess capacity leading to better pricing. Outside of the very largest tech megacaps, position sizes vary from around 3% at the top end down to around 0.5% at the bottom. Portfolio turnover is on the high side, which is common for specialized equity trusts, with between 70% and 100% being fairly typical. As for the current health of the technology sector, in the half-year results released in August 2024, ATT reckoned that recent earnings have been constructive, but with several cross-currents, the most notable being the timing of benefits from the likes of AI and other emerging technologies. In respect of returns, it also pointed out the wider-than-typical performance differential between key subsectors, e.g. those most seen as beneficiaries of AI on one side with everything else on the other. The managers expect this trend to reverse, noting that the technology cycle for software and IT services is often stronger in the second half of the year. Unfortunately, the trust did have a position in CrowdStrike, responsible for the widespread global IT outage in July 2024, and highlighting that even when you thoroughly research each position, you can still get caught out. The holding was initially trimmed for risk mitigation purposes immediately following the incident, given the likely hit to its near-term business prospects, and the team's fundamental research resulted in them adding back to a higher weight than before the incident, thanks to conviction in the long-term thesis. Seidenberg closed his latest half-year review with this useful reminder. Technology remains a key enabler across almost every industry, and we will continue to seek stocks which solve difficult problems and can be long-term outperformers. Despite short-term periods of higher volatility among technology stocks, earnings growth ultimately drives stock prices over the long term, and in our view, we are still early in the spending trend supporting this dynamic segment. The AIC website includes a presentation he gave at its Investment Trust Showcase event in October 2024, in which he talks about some of the drivers that will determine technology stock performance over the coming decade. Charges. ATT's fees have come down a fair bit since Alliance GI was appointed in 2007, but you would expect that to be the case given the significant growth in net assets. The management fee started at 1% of market cap and was reduced to 0.8% in 2014. A tiered fee structure was put in place in 2018, and the current tiers are 0.8% up to $400 0.6% from 400 mailers to 1 Wukchan, and 0.5% over 1 BOR. The current market cap of 1.25 BN translates into a blended fee of around 0.65%. Management fees in 2023 came to 6.9 melos with 1.0 melos and other costs, for an ongoing charge ratio of 0.7%. The performance fee used to be 20% and was cut to 12.5% in 2014, and then again to 10% in 2022. The performance fee payable is currently capped at 1.75% a year, with any excess earned but unpaid carried over to future years. The usual arrangement for high watermarks is in place, so previous peaks must be surpassed before any further performance fees become payable. No performance fee was paid in respect of 2021, 2022, or 2023, but a chunky 25 melos was payable for 2020. If we use the 1.5 percentage point historical outperformance as a guide, that suggests the performance fee could add 0.15% to total costs, on average, each year. ATT is a little cheaper than PCT, its main rival, which charges 0.8% on net assets up to 2 BN, then 0.7% up to 3.5 BN, and 0.6% above 3.5 BN. Both trusts currently have a 10% performance fee based on the same benchmark. As PCT is the larger of the two, its ongoing charges ratio ends up being 0.8%, which is only a little higher than ATT's 0.7%. Directors and major shareholders. ATT currently has 5 directors, all of whom are considered independent from the manager. There are no long service issues, as although one director was appointed in 2015, she is due to retire at the 2025 AGM. Her retirement was delayed for 1 year as another long-serving director retired at the 2024 AGM. All 5 directors own shares in ATT, holding around 70,000 between them at the end of 2023. They bought a further 16,000 shares in the first half of 2024 for a combined holding that is worth about £300,000. The shareholder list shows a strong retail presence, with the 2023 annual report having Hargreaves Lansdowne at 13%, Interactive Investor at 12%, and AJ Bell at 5%. Rathbones at 11%, Charles Stanley at 7%, and Evelyn Partners at 4% are the other notifiable holdings. Closing thoughts. ATT has delivered impressive returns for 3 decades, but especially so since Allianz GI took over running the portfolio in 2007. It has even managed to keep up with its benchmark in recent years when market returns have been concentrated in relatively few stocks. It features prominently in our tables of the best investment trust performance over 20 and 30 years. Although Mike Seidenberg has only been the lead manager for a little over 2 years, the long period in which he worked with his predecessor gives him a deep knowledge of the history of the technology sector, how it performs over various market cycles, and the best way to capitalize on the returns offered by new developments, such as the widespread adoption of AI. However, with technology valuations on the high side and the ever-present threat of greater regulation, returns from the sector are likely to continue to be volatile. Manager's view. My message to investors is that technology is a journey, and it's been one that precedes me investing in it. I think it'll continue to be a journey. It is part of the way companies create competitive advantage. I don't think that's changing, and I think it's important whether you own ATT or own another product, that you really should have exposure to it. If you think about the world we live in, it's a fairly short list of leadership, and technology is one of the leaders. The continuation of the journey is not going to be a smooth line. Things zig and zag, but if you have a long-time horizon, it should continue to be a place to create value. Moneymakers profiles. You can read Stuart Watson's in-depth fund profiles and access much more exclusive investment trust analysis and information by becoming a member of the Moneymakers Circle. Just go to moneymakers.co membership, join for full details of how to sign up. The aim of the fund profiles is to cover a wide range of trusts that invest both in equities and alternative assets, providing a long-term perspective on what drives their performance and setting out the key points potential investors need to know. More than 160 profiles have been published to date, and new ones appear on a weekly basis. The content is independently produced. We don't offer sponsored or broker-led research. Some of the most recent trusts that have been featured are Aberdeen UK Smaller Co-Growth, Edinburgh Investment Trust, Oryx International, Henderson European, Fidelity China Special Situations, Schroeder Asia Pacific, BlackRock Smaller Companies, Scottish Mortgage, RTW Biotech Opportunities, Henderson High Income, Chrysalis Investments, Mchattie Investments, Bankers, Migo Opportunities, JP Morgan Indian, Schroeder UK Midcap, Gore Street Energy Storage. Aberdeen Asian Income by Stuart Watson. Aberdeen Asian Income, AAIF, was launched in 2005 and has grown its dividend by nearly 6% a year since then, including a bumper 17.5% increase to 11.75p a share in 2023. Unlike some income trusts, its yield is not based on a set percentage of its net asset value, and its dividend has been covered by earnings every year apart from during the pandemic in 2020 and 2021. The trust's dividend yield is around 5.5%, and shareholders have seen total share price returns of around 8.6% a year since its 2005 IPO, ahead of its regional benchmark. Aberdeen Asian Income is one of the younger trusts investing in the Asia-Pacific region, having joined the market in December 2005 when it raised 110 pellets from investors at 100p per share. It has provided steady returns since then, targeting a total return for its investors from a selection of Asian-Pacific stocks that pay an above-average and sustainable dividend yield. The dividend for 2006, the trust's first full year, came to 4.5p, but the payout had grown to 11.75p by 2023. That is a compounded growth rate of 5.8% and a yield at the time of writing of an attractive 5.5%. There is a high level of income from the portfolio, and that is boosted by modest gearing of 7% and the current double-digit discount to NAV. AAIF's dividend has been covered by earnings in all but 2 years to date, those being 2020 and 2021, when the pandemic affected payouts across the globe. The dividend did increase slightly in both of those years, and it is notable that the payout has been increased every year to date except for 2008, during the height of the global financial crisis, when it was held at 475p. From its IPO to the end of 2023, a period of 18 years, AAIF had generated an annualized NAV return of 9.2%, ahead of the 8.1% a year generated by its benchmark. Share price annualized returns have been a little lower at around 8.6% due to the trust sitting on a double-digit discount. The last decade has been somewhat tougher on both an absolute and relative basis. However, with AAIF generating an annualized NAV return of 6.6%, while the benchmark was marginally higher at 7.0%. IF is managed by Yujong Oh, Flavia Cheong, and Eric Chan, who can call on Aberdeen's 40-strong team of equity professionals analysing the region. Oh takes on most of the presenting duties. She's based in Singapore, joined Aberdeen in 2005 after graduating from Oxford, and has worked on the trust since 2016. Cheong is Aberdeen's head of equities for the region and has been with Aberdeen for 3 decades, while Chan joined in 2023 from Allianz, where he spent several years running Asian funds. One particularly pleasing move made in 2024 was the introduction of a new charging structure based on the lower of net assets and market cap, which was estimated could reduce the management fee by around a quarter. In addition, Aberdeen recently used 6 months of its fees to buy shares in AAIF, a policy it has employed across a number of its other trusts. While a lot of Aberdeen trusts have been engaged in mergers and other types of corporate action in recent months, according to comments from Ian Cadby, the trust's chair, AAIF sees no need to follow suit. Key statistics. Listed. December 1995 at 100p, no share splits to date. Domicile, Jersey. Management firm, Aberdeen since IPO. Managers, Yujong Oh, Flavia Cheong, and Eric Chan. Ticker, AAIF. AIC sector, Asia Pacific Equity Income, 5 trusts. Benchmark, MSCI AC Asia Pacific ex Japan. NAV update frequency, daily. Market cap, 330 million, September 2024. Costs prior to new management fee arrangements, ongoing charges of 1.0% in 2023, 1.3% per KID. Management fee, 0.75% up to 300 millers and 0.6% over 300 millers calculated on the lower of NAV and market cap. Performance fee, none. Discount control policy takes an active share buyback approach if the discount exceeds 5% in normal market conditions. Continuation vote, none. The trust has an unlimited life. Number of holdings, 58 as at 30 June 2024. Top 10 holdings, 42% as at 30 June 2024. Net gearing, 7% as at 30 June 2024. Year end, 31st December. Results released, April, finals, and August, interims. Dividends, 11.75p paid for 2023, so yields roughly 5.5%, and dividends paid May, August, November, and February. Financial history. Table 1 sets out AIF's financial history from its IPO up to its 2024 half-year results. See tables and charts in the free ebook. Table 1, AIF Financial History. AIF's share price moved between 80 pence and 120 pence for its first few years, and it proved to be more resilient than most during the worst of the global financial crisis. There was a period of a strong performance from 2009 to 2012, and AAIF regularly traded at a premium during this time. The last decade has been relatively tougher for Asian stocks, and AAIF's share price is about the same level it was in 2013, so shareholder gains since then have come entirely from dividends. Economic concerns across the region saw a high single-figure discount emerge in 2015, and this persisted for a few years. COVID knocked sentiment towards the region in 2020, and AAIF has suffered a slightly wider double-digit discount over the last few years as a result. The trust's share count increased rapidly in its first several years. From 2010 to 2013, 22 shares were added from the conversion of warrants issued at the IPO on a 5-for-1 basis, while 34 shares came from regular issuance between 2009 and 2015. A C share issue raised 60 Maltas in November 2012, and this added another 31 Maltas shares when these were converted into ordinary shares a few months afterwards. Since 2015, the share count has steadily declined as AAIF has a policy of making repurchases when its discount exceeds 5%. To date, it has bought back around 20% of its peak share count, but the rate of repurchases was stepped up significantly in the first 6 months of 2024. The current share count is still significantly higher than it was at the IPO back in late 2005. A modest level of gearing has been maintained throughout, so that is likely to have slightly boosted returns. The year-end average gearing level has been around 8%, and it has rarely moved much higher or lower than that in recent years. Performance. IF has used the same income-focused investment strategy since its IPO, and it measures its returns against the MSCI AC Asia Pacific ex-Japan Index. This index covers around 200 large and mid-cap companies across the region, but it is geographically quite concentrated with over 90% of its value made up by China, Mainland Hong Kong, India, Taiwan, Australia, and South Korea. Table 2 shows how AIF has performed against its benchmark each year. See tables and charts in the free ebook, Table 2, AAIF performance versus benchmark. There is quite a bit of variation between the trust and its benchmark in individual years, but overall AAIF has enjoyed a small lead of just over 1 percentage point a year. The trust produced a negative NAV return in 5 out of its 18 years, the largest drop being a relatively mild 10% in 2015, and it held up very well on a relative basis when the regional index struggled in both 2008 and 2011. AIF also provides a comparison against the high-yield version of its benchmark index. This trimmed-down index includes around 200 companies and attempts to screen out any stocks with deteriorating fundamentals that might cause a cut or reduction in dividends, not that dissimilar from AIF's approach. This high-yield index has returned 9.3% since 2005, although it was only created in 2012, so the figures prior to that have been created by backtesting. There is quite a bit of variation against this index on a yearly basis as well, suggesting AAIF has generally used a fairly active stock-picking approach. Against its peers in the Asia-Pacific equity income sector, AAIF's 8.6% annualized share price return since its 2005 IPO has outperformed Henderson Far East Income's 6.7% and roughly matched the 8.5% from JP Morgan Asia Growth and Income. Schroeder Oriental Income, also launched in 2005, has produced 10.1% a year, while Invesco Asia leads the sector with 10.5%. Both the JP Morgan and Invesco trusts now use an enhanced dividend approach, so are picking from a slightly wider pool of companies, while Henderson Far East Income seems to have prioritised higher yields at the expense of total return. Its shares yield 10%, but its share price is at roughly the same level as it was when the trust was relaunched in late 2006. The AIC's Asia-Pacific sector has generally produced slightly higher returns over this same period, with 4 of the 5 trusts returning between 10.4% and 11.7% a year, and the other 8.0%. Dividends. As AIF is an income fund, let's examine the dividend record in a little more detail. Table 3 looks at cover, annual increases, and yield. See tables and charts in the free ebook. Table 3, AAIF dividend history. Dividend cover has been pretty good overall, with an average of 1.06 times and, as mentioned earlier, just 2 years when cover dropped below 1 and revenue reserves were utilised. AAIF has never cut its dividend, and it was held once in 2008, so there is now a 15-year record of increases. 2024 looks set to make that 16, with the first 2 quarterly dividends being 2.5p, a 2% increase over last year. The official dividend policy is to pay 4 interim dividends a year, with an aim of growing dividends over time. The recent pattern has been to pay 3 identical interim dividends, 2.5 pence each for 2023, followed by a slighter larger 4th interim, 4.25 pence for 2023. At the end of 2023, following payment of the 4th interim dividend, the trust had around 40% of revenue reserves it can use should it need to do so. Dividend growth has been a little erratic though, with a strong period from 2010 and 2013 and then again in the last 2 years, with revenue generated from the portfolio being 27% higher in 2023 than it was before the pandemic in 2019. The current dividend yield of around 5.5% is quite a bit higher than the year-end average of 4.3% since the IPO. Investment policies. Nothing particularly notable stands out from a review of AAIF's investment policies. It can invest in listed equities, government debt, corporate debt, and derivatives, with no sector or geographic restrictions within the Asia-Pacific region. Fixed income exposure is currently 0.8%, consisting of corporate bonds issued by ICICI, the Indian bank. The use of derivatives appears to be fairly minimal too, and mostly restricted to writing options to generate additional income. Unquoted investments are only permitted if they are about to be listed or were bought prior to being delisted, and if it is considered appropriate to keep holding them. The guidance range for the portfolio is between 40 and 70 positions in a mixture of large, mid, and small cap stocks. There is a limit of 20% exposure to a single issuer. Portfolio. A universe of around 1,000 stocks is available for selection, from which around 300 stocks are actively monitored. The resulting portfolio contains around 60 stocks, with the largest country weightings as of June 2024 being Taiwan, 25%, Singapore, 18%, China, Hong Kong, 16%, and Australia, 16%. Relative to its benchmark, the trust is underweight both China, due to concerns about the quality of investing opportunities and the lack of income opportunities there, and India, where valuations are deemed to be less attractive following a strong market run. However, the fund continues to look in these markets for new ideas that fulfill their investment criteria. Even in India, where the domestic market dividend yield is a low 1%, the fund is invested in utility company Power Grid of India, which operates the national grid network and is a beneficiary of the state's grid upgrade and expansion plans as part of India's longer-term energy transition roadmap. Power Grid currently pays an attractive 4% dividend yield. The fund's main country overweight is Singapore, which acts as a gateway to the neighbouring faster growth economies in the Southeast Asia region. The 3 Singapore banks held in the fund have each diversified into new products to generate fee income growth such as wealth management and bank assurance, whilst also growing their distribution reach to foster growth in countries such as Indonesia, Thailand and Malaysia. Meanwhile, Singapore-listed CapitaLand India Trust invests solely in Indian business parks, offices and data centres, providing attractive underlying revenue exposure to India whilst paying a 6% dividend yield on the Singapore-listed trust. Unusually for an income fund, there is a significant weighting towards both technology stocks and small caps, therefore providing some dividend growth potential, and these sit alongside more traditional income stocks from sectors like financials and utilities. Around a fifth of the portfolio is small cap stocks with a market cap of up to 2 billion. For example, the fund uses the Taiwanese technology supply chain to find good quality small cap ideas that offer exposure to artificial intelligence, AI, demand growth, whilst maintaining their focus on cash flow generation and robust financials. Sun On Wealth is a small-cap company that manufactures cooling systems for servers and data centers globally. As servers become more complex with increasing data demands from continuous upgrades at the forefront of AI usage, these data centers generate more computing power, which generates more heat, which results in growing demand for better fans and cooling systems. Sun On Wealth provides exciting growth exposure for the fund, and also manages a net cash position on its balance sheet which supports their double-digit dividend growth rate and above-index average yield of 3.3%. The vast majority of AAIF's position sizes range from 4% at the top end to around 0.5% at the bottom. 2 positions stand out at the moment though, and they are Taiwan Semiconductor and Samsung Electronics, which were 12.2% and 6.4% respectively as of June 2024. Both these stocks are also major components of the trust's benchmark at around 9% and 4%, but AAIF is overweight in both cases. The trust's top 10 holdings typically make up around 40% of its portfolio, so it is not particularly concentrated overall. Each stock in the portfolio pays a dividend, and AAIF is not averse to increasing its weighting in positions just prior to a special dividend being paid out. While this boosts income, in theory at least, such an approach should not have that much impact on total returns. Portfolio turnover has recently been in the region of 35–40% and is expected to remain roughly the same, although it used to be around half this level historically. Directors and major shareholders. AAIF currently has 6 directors, all of whom are considered independent of Aberdeen, and 3 of which have experience of working in the region. Ian Cadby joined the board in 2016 and has been chair since early 2022. The other directors were appointed in 2015, but planning to step down at the 2025 AGM, 2017, 2018, 2021 and 2024. Each of the directors has a position in the trust, with a combined holding of around 80,000 shares worth around 0.2 ml. 9 major shareholders own around 60% of the trust's shares, including a 7% stake held by 1607 Capital Partners and 10% by City of London Investment Management. The 3 major retail platforms are among the 9 major holders, making up around 24% between them. Charges. AAIF started life charging 1.0% of its net assets, and its fee structure remained unchanged for a decade until 2016. Since then, though, there has been encouraging progress to cut charges. The rate was reduced to 0.85% in 2016, and then a cheaper tier of 0.6% was introduced in 2020 for net assets over 350 mil. They were around 400 mil at the time. With effect from January 2024, 0.75% is charged up to a slightly lower level of 300 millers and then 0.6% above 300 millers. However, the basis of charging has shifted to the lower of net assets and market cap. With the shares at a low double-digit discount, the new structure was estimated to translate into a significant fee reduction of around a quarter. AIF's market cap is around 330 mils and net assets are roughly 370 mils, so only a small portion benefits from the cheapest tier. AIF's ongoing charge was 1.0% in 2023, which made it one of the more expensive Asian Pacific trusts. But the first half of 2024 saw ongoing charges fall to 0.86%. The estimated annual management fee fell from 3.01 to 2.4 mesos, and admin costs are expected to be flat at 0.9 mesos. That potentially makes AIF one of cheapest of the 10 trusts across the Asia-Pacific and Asia-Pacific equity income subsectors, although they mostly fall into a fairly tight range from 0.8 to 1.0%. There is no performance fee at AIF, and it has not had one in the past either. Schroeder Oriental Income is currently the only one of the 5 trusts in the Asia-Pacific equity income sector that does. Gearing. AIF generally uses short-term loans as its main form of borrowing. Its gearing level is set by its directors, with a maximum level of 25% of net assets, but guidance that it is unlikely to exceed 15%. In practice, it has been rare for gearing to exceed 10%, and it tends to sit in a narrow range from mid to high single digits. IF publishes its gearing level weekly and in its monthly fact sheet, so it is simple for shareholders to monitor. In March 2024, AIF's previous 10 mint or fixed-rate term loan and 40 Bermuda revolving credit facility both matured and were replaced with a 50 meters one-year multi-currency revolving credit facility with its existing lender, the Bank of Nova Scotia. There is an option to extend the facility to 70 millers subject to credit approval. 32 millers was drawn down as of June 2024, just over half of which was in sterling with the remainder in US and Hong Kong dollars. The interest rates payable for each currency were roughly 6% a year. Closing thoughts. Asian market returns have failed to keep up with the US in recent years, and many would argue a reversal of this trend is well overdue. The region clearly has plenty of growth potential, although AIF's policy of looking for sustainable dividend payers may mean it lags a little in periods of strong market gains. Conversely, it should hold up better than most in more difficult market environments. There are geopolitical issues to consider as well, of course. While AIF is underweight China and Hong Kong, it is overweight Taiwan, so any escalation in hostilities across the region, whether in the form of increased tariffs or more direct action, are likely to have an impact. Manager's view. Now is an opportune time for investors to consider the Asian region in their hunt for income due to several compelling factors. Asia's improving fundamentals are a cornerstone of the region's strong dividend sustainability. Favourable demographics are driving a steady increase in consumption and GDP growth, which in turn is expected to boost returns to shareholders through higher payouts and increasing private sector buybacks. The region is home to many high-quality corporates with strong balance sheets and healthy free cash flow generation, offering robust coverage of dividends. This solid foundation supports the dividend story in Asia, where dividends now contribute over half of total returns. Moreover, income stocks in Asia appear relatively cheap compared to the overall market. High-yield equities are particularly attractive now that US interest rates have started to decline, a trend that has already been factored into bond valuations. As stock prices tend to rise during a rate cut cycle, companies are likely to improve their future earnings potential, making dividends a key contributor to total returns. Additionally, our local presence and extensive knowledge of the region, supported by a team of on-the-ground analysts, enable thorough due diligence and the discovery of new investment opportunities across various sectors and geographies. With the Aberdeen Asian Income Fund yielding 5.5% compared to the benchmark yield of 2.6%, we believe Asian equities are an overlooked yet attractive investment choice for investors looking to diversify their portfolio away from home markets, with many of the portfolio companies at the forefront of key investment megatrends. India Capital Growth by Stuart Watson. India Capital Growth, IGC, was launched in 2005 when it raised 75 million to invest in small and mid-sized Indian companies, particularly in illiquid opportunities that its managers believed could offer additional value. Its first few years proved difficult, but since Gaurav Narain took over as lead manager in late 2011, it has delivered strong absolute performance. The trust introduced a 2-yearly redemption opportunity a few years ago to tackle its wide discount, but although the discount has narrowed, it has remained quite volatile. The next redemption point is 31st December 2025. India Capital Growth joined the AIM market in December 2005 when it raised £75 million at 100 pence per share. India Investment Partners, a business that was 43% owned by Caledonia Investments, the Kaiser family's investment vehicle, ran the portfolio initially, and the Kaiser Trust owned around 30% of IGC's shares. The objective was to invest primarily in small and mid-cap Indian companies, with up to 25% in unlisted companies. The trust also had a value bias in its early years. The illiquid nature of the portfolio meant that a net asset value per share figure was initially only published on a monthly basis. Weekly NAV estimates were not introduced until 2012, with daily updates starting in 2016. The shares endured a very rocky ride during the global financial crisis, peaking at 135 pence in January 2008, but ending that year at around 30 pence and trading at a 30% discount to net asset value. The shares rallied in 2009 and 2010, but remained well below both their IPO price. IGC's directors decided that a radical rethink was required. Several changes were made to the overall strategy in 2010. The focus was to remain on small and mid-cap Indian stocks, but there would be an increased emphasis on liquidity. The portfolio would become less concentrated, going from 15 to around 40 positions, and, while still backing long-term structural themes, investments were to be approached in a pragmatic way, and where appropriate, take advantage of market volatility. In 2011, which was another difficult year for the Indian market, Caledonia bought the Rest of India Investment Partners, and the firm was rebranded as Ocean Dial. Gaurav Narain, the current portfolio manager, joined Ocean Dial and was appointed as IGC's lead manager in November 2011. Caledonia sold Ocean Dial to its management team in 2013, who in turn sold it to the KKR-backed Avendus Capital in 2017. In 2023, Ocean Dial was bought by Asset Co., the AIM-listed investment management group founded by former Aberdeen boss Martin Gilbert. Tackling the discount, IGC's share price moved sideways in 2012 and 2013, and its wide discount to NAV persisted. In 2014, there was a 1-for-2 subscription share offer in an effort to increase the size of the trust, and a 3-yearly continuation vote was introduced, conditional on performance. The next 3 years saw strong returns, so as it transpired, the 2017 continuation vote was not required. The subscription shares were exercised, and IGC's net assets passed the 100 million mark for the first time. The listing was moved from AIM to the main market in early 2018. Performance wasn't quite looking as good for the 2017 to 2020 assessment period, and then COVID struck. The 2020 continuation vote was brought forward with the board proposing to replace future votes with a 2-yearly redemption facility. A raft of other changes were also made at Ocean Dial. It hired more investment staff and modified its stock selection and selling processes, reducing areas like wholesale banking and consumer discretionary stocks. It also wound down an open-ended fund it was running, freeing up resources to focus on IGC. The management fee was cut and changed to the lower of total assets or market cap. The various changes were approved, with over 90% of shareholders voting in favour of the trust's continuation and the new redemption facility. The first redemption point was 31st December 2021, when 14% of shareholders opted to redeem at a 6% discount. The second redemption date was 31st December 2023, with shareholders offered the chance to redeem at a narrower discount of 3%. A slightly higher figure of 16% of shareholders opted to redeem. In early 2024, though, the shares briefly enjoyed a premium, and IGC used this opportunity to issue 10.5 million of shares from Treasury, just over a third by number of those it had redeemed just a few months previously. Financial history. The following table shows IGC's progress since its IPO. Note that no dividends have been paid. See tables and charts in the free ebook. IGC was a very small trust throughout its first decade, but strong returns in the subscription shares that were exercised in 2016 have made it a somewhat larger vehicle. The redemption facility and a modest amount of ongoing share buybacks since 2021 seem to have reduced its discount to NAV, although the 2-yearly nature of the redemption facility means that there can be quite a lot of discount volatility in between the redemption points. IGC has no debt facilities and usually operates with a small net cash position. Returns since the 2006 IPO are hampered by the trust's poor performance in its early years. On a NAV basis to June 2024, returns have been 4.4% a year, while the trust's benchmark, the BSE Midcap Index, has returned around 12% a year. Since the start of 2012, just after Gaurav Narain took on the main manager role, performance has been much better at 14.6% a year. However, the benchmark has done even better, returning around 18% a year. Most of that gap occurred from 2017 to 2020 and in the last 18 months. This table shows how the various S&P BSE indices that IGC refers to in its reports are made up. See tables and charts in the free ebook. Both the small and mid-sized parts of the Indian market have outperformed their larger cousins in recent years, but with a higher level of volatility, as you would expect. While IGC has trailed its mid-cap benchmark, it is more or less in line with the broader Indian market, especially when you factor in index tracking costs, which are between 0.65 and 0.85% for most of the available ETFs. In terms of its current portfolio, IGC has around 16% in large caps, greater than $8 billion, 40% in mid-caps, between $2 billion and $8 billion, 40% in small caps, less than $2 billion, and 4% in cash. Therefore, although it uses the mid-cap index as its benchmark, In practice, it does straddle all three sub-indices, although most of the large caps it owns were previously held as mid-caps and have continued to grow in size. One improvement IGC could make is the way it presents its performance data in its accounts. Although 5-year data is set out in the monthly fact sheets, you have to dig through the commentary of its annual report to find comparisons against the benchmark. Even then, only the figures for the last year are mentioned rather than the 5 or 10-year summaries that you usually see, either in table form or graphically. In contrast, there is usually extensive information on the Indian economy, the Indian stock market, and specific factors affecting portfolio performance over the past year. The Indian stock market has many attractive features. It has a huge and well-educated population of 1.4 BN, resulting in a large domestic market. Sector and stock concentration tend to be low. There is a strong institutional framework of regulatory bodies and judiciary, plus the Modi government is seen as business-friendly. The economy is predicted to become the world's third largest by 2030, overtaking both Japan and Germany. Although government debt is relatively high, both corporate and household debts are on the low side. The currency effect. With single-country trusts, exchange rate movements obviously can have a big impact on sterling returns, so it's worth being aware of the historical trend. Most trusts don't use any currency hedging, as it is typically not cost-effective over the long term, and IGC is no exception. Since the mid-1980s, the Indian rupee has steadily declined against sterling from around 15 to 110 as of October 2024. It was around 85 when the trust was launched in late 2006 and then fluctuated around that level over the next decade or so before climbing from 2017 onwards. That means returns for UK-based investors have been slightly lower than for domestic Indian investors in recent years, although IGC does point out that currency movements have become steadily less volatile over the last 2 decades. The trust's managers, Ocean Dial, now sits under the River Global brand within Asset Co and should benefit from its greater marketing and infrastructure. River Global looks after 2 UK small-cap trusts, with combined assets of around 80 million, but the wider Asset Co business has assets under management of 12 billion. In contrast, IGC was the only fund that Ocean Dial ran. The core investment team has remained the same following the acquisition, and continues to be led by Gaurav Narain. Narain joined Ocean Dial in late 2011 after spending 21 years as both a fund manager and an equities analyst working at New Horizon Investments, ING Investment Management India, and SG Asia Securities India. He leads an investment team of 6, who are mostly based in Mumbai and have recently moved into new premises. There are also staff in London as well, where dealing in Indian equities takes place. There is a minimum of 12 months' notice on the investment management agreement, although that reduces to 6 months if more than 50% of shares are put forward for redemption. Investment policies and process. The Trust's objective is to provide long-term capital appreciation by investing predominantly in listed mid- and small-cap Indian companies. However, ICG can also invest in large-cap listed Indian companies and in companies incorporated outside India which have significant operations or markets in India. IGC can invest in bonds, convertibles, and other types of securities and, for the purposes of hedging and investing, use derivative instruments such as financial futures, options and warrants. The portfolio is expected to consist of 30-40 stocks, so it is relatively concentrated, although it is noted that the number of holdings may increase if the trust grows in size, and the maximum in one position is 10%. IGC starts looking for stocks within a broad investment universe of around 4,000 companies. It looks to reduce this to around 120 or 140 by focusing on market caps of between 100 million and 8 billion and excluding complex businesses, those with ESG concerns, those involved with commodities, conglomerates, global rather than domestic businesses, and companies that lack scalability or that don't add economic value on a sustainable basis. A proprietary ranking tool aids with portfolio construction. Portfolio. Although the portfolio is not as concentrated as it was in the Trust's early years, it is still fairly focused. The latest fact sheet said there were 37 holdings with just over 40% made up by the top 10. Position sizes typically range from 1 to 5%, with the full portfolio listed in the annual accounts, the top 20 in the interims, and the top 10 in monthly fact sheets. Portfolio turnover tends to be fairly low at around 15%, with 7 additions and 7 full disposals over the year to September 2024. Low portfolio turnover is particularly useful as from 2020 onwards, the Trust has become liable to pay Indian capital gains tax at 12.5% for positions held for more than a year, and 20% for less than 1 year. These rates were increased from 10% and 15% respectively in July 2024. As this is still a relatively new phenomenon, so far it has had only a limited impact on returns versus the benchmark, but it's likely to be an increasing consideration in future years. It's something that affects all 4 trusts in the sector, so it is not unique to IGC. The Trust's daily NAV releases show a figure both with and without CGT. In early October, the post-CGT NAV was 198.5 pence per share, while it was 211.5 pence pre-CGT, making the difference around 6%. Most of the names in the portfolio won't be familiar to UK investors given their relatively small size. The monthly fact sheet contains a brief description of what each of the top 10 positions does, such as Federal Bank, 5.3% of the portfolio, a well-run mid-sized private sector bank, attractive valuations, 5.7 billion market cap. The sector breakdown shows the industry weightings are fairly close to the benchmark in most sectors. A quality growth slant can be seen in the lack of energy, property and utilities, although combined these account for less than 10% of the BSE mid-cap index. Although the Indian market remains richly valued and has been for many years, the managers continue to strike a positive note about its future prospects. This is what they had to say in the 2023 annual report. Entering 2024, there is broad consensus that India's growth story is structural and GDP growth should average 6 to 7% per annum for the next few years. The foundation has already been set. A favourable regulatory environment, improved infrastructure, healthy corporate balance sheets and policies geared towards investment-led development. What has come as a bonus is geopolitics. The rush to de-risk supply chains is accelerating investment by global firms into India, many of whom are viewing India as an alternate to China, especially since demographics are extremely favourable. We thus believe the momentum in the economy will remain strong. We, however, see several trends which are different from what we have seen in the past. 1. India's growth until now has largely been consumption-led, but this phase is driven by investments. Even within investments, a different set of sectors, like renewable energy, green hydrogen, electronic manufacturing, etc., are leading investments. Also, Make in India is a big focus. Policies are geared towards encouraging local manufacturing, and the impact is visible in sectors like defence, railways and electronic manufacturing, which until now have been import-dependent. What is more exciting is the pace of execution. Earlier, execution seldom matched targets, but this has changed as bottlenecks and legal hurdles have been addressed through policy changes. 2. Consumption patterns are surprising. Premium products are doing well, while mass-market products are struggling. This trend is across categories ranging from automobiles, housing, to consumer electronics. Though it is being attributed to inflation, the weakness has been prolonged. We do believe the trickle-down effect will lead to consumption being broad-based, but this is also creating new opportunities. 3. India's low-cost digital infrastructure is also impacting business models and behaviour patterns. Our own industry is a case in point, with domestic mutual funds now being the driver of the equity market as opposed to FIIs. The ease of online transactions is leading to individuals from smaller towns channeling savings which were traditionally deployed in bank fixed deposit real estate or gold into equity markets through mutual funds. The rising domestic flows into funds is influencing market behaviour, with funds struggling to deploy the flows. Digitisation remains a big disruptor and a great opportunity. IGC's portfolio tends to be valued on a similar level to the broader Indian market, but is forecast to have higher earnings growth. As of September 2024, the forecast average multiple across the portfolio was 28 times for 2025 and 22 times for 2026, with earnings growth of 18% in 2025 and 30% in 2026. Return on equity based on 2026 forecasts was 19%, but the average dividend yield was just 0.5%. Performance against the sector. How you judge IGC's performance very much depends on your starting point. Since its IPO to October 2024, its annualised share price return has been just 3%. That compares to 10.4% a year for Aberdeen New India and 8.0% for JP Morgan Indian measured over the same period. The RBDN Trust was launched a year before IGC, but the JP Morgan Trust dates back to 1994. Both of them are focused on larger Indian companies rather than small and mid-caps. Since Narain took over in November 2011, the picture is very different. IGC boasts an annualised share price return of 11.2%, Aberdeen New India is at 9.8%, and JP Morgan Indian is at 7.6%. Note that IGC's figures are a little lower than quoted earlier due to dilution from the subscription shares and a slightly different starting point. Having looked at the history of the trust and its early dalliances with illiquid stocks, this feels to me like a fairer starting point for making comparisons, although such things are always very subjective. Ashoka India Equity was listed in July 2018 and has been the best performer in the sector since then, with an annualised share price return of 17.2%. IGC comes second at 11.6%, Aberdeen is at 9.4%, and JP Morgan is at 6.4%. However, most of Ashoka's outperformance came in its first 18 months, when its returns held up a lot better than the other three Indian trusts. Since the start of 2020, the returns of Ashoka and IGC have been very similar. Ashoka is the closest match for IGC in terms of the structure of its portfolio, with around 40% in large caps, 15% in mid caps, and 45% in small caps. In terms of size, the JP Morgan Trust is the largest with around 900 million of assets, with Aberdeen and Ashoka at around 500 million and IGC at around 180 million. Rating. IGC was rated at a premium for the first year after its IPO, but the financial crisis and its poor early returns soon brought that state of affairs to a screeching halt. A discount appeared in early 2007 and it reached 40% near the end of 2008. The change of management team in 2011 saw a slight improvement, but it wasn't until the redemption facility was introduced that the discount narrowed to single figures. Over the past 3 years, IGC's discount has averaged 9%, while the Aberdeen and JP Morgan trusts are much wider at around 18%. Ashoka regularly trades at a premium and issues new shares, which has seen its share count rise from 45 mil in 2018 to over 160 mil today. IGC has warned in the past that a sizable take-up of its redemption facility might cause a problem if the trust becomes too small to be viable, although that may be less of an issue now that its managers are part of a much larger group. Despite the 2 redemptions in the last few years, the market capitalization remains above 150%, which for a specialist trust investing in small and mid-cap equities may be sustainable, albeit dependent on retail rather than institutional and wealth manager support. IGC will no doubt be hoping to have further opportunities to issue new equity after its short window of trading at a premium earlier this year. The other 3 trusts in the sector are all noticeably larger, but IGC's superior performance record over 5 and 10 years, combined with its mid-cap focus, gives it a strong story to tell when marketing to private investors. It also helps to explain why its discount is significantly narrower than the much larger Aberdeen and JP Morgan trusts. Directors and major shareholders. IGC has 4 directors, all of whom are considered independent. Elizabeth Scott, recently chair of the AIC, was appointed as IGC's chair in late 2017. The other 3 directors joined in 2020, 2021 and 2022. There is plenty of experience within investment management and the trust sector, but no direct experience with the Indian market is mentioned in the directors' biographies. Scott worked in Hong Kong from 1992 to 2008, so has experience in emerging markets in a broader sense, while another director, Nick Timberlake, specialised in managing global emerging market funds for many years, which presumably would have included India. Director ownership comes to around 164,000 shares, roughly £300,000, which doesn't seem too unreasonable given the trust's specialised mandate and the fact that 3 directors are fairly recent appointments. The share register of the trust has changed noticeably over the last 2 years, with the 2 largest institutional investors, Lazard Asset Management and City of London Investment Management, who together owned around 35% of the shares as recently as February 2023, redeeming their shares and effectively being replaced by retail investors holding shares through the major platforms. The major shareholders as of February 2024 were Hargreaves Lansdown, 22.7%, Interactive Investor, 18.3%, West Yorkshire Pension Fund, 5.4%, AJ Bell, 7.0%, JM Fin, 4.2%. Nearly half the shares are held by the 3 main retail platforms. The trust has made a concerted effort to target private investors, and while the share count has fallen to 86 million as a result of the redemptions, it has clearly had some success in meeting its ambitions. Charges. From its IPO in 2005 to 2019, IGC charged 1.5% of total assets as its management fee, with a net cash balance, net assets, and total assets are the same figure. There was a reduction to 1.25% in 2019, and then, in order to help the continuation vote succeed in June 2020, a further change to 1.25% of the lower of total assets or market cap was agreed. Once other costs are thrown in, the ongoing charge comes to a fairly high 1.6% due to the trust's relatively small size. The KID puts total costs at 1.8%, with the difference coming from the inclusion of portfolio transaction costs. IGC is the most expensive fund in the sector. JP Morgan Indian, by far the largest, has ongoing costs of 0.8%, Aberdeen is 1.1%, and Ashoka is 0.5%. Ashoka is unusual in having no base management fee, just a 30% performance fee measured over a 3-year period. IGC initially had a performance fee payable on 10% of any gains over an annualized return of 10% from its IPO. However, with the NAV per share still 30% below its IPO level in early 2014, the performance fee was removed. Dividends. With a portfolio of growth-orientated medium and smaller companies, the underlying income from the IGC portfolio is quite low and usually much less than 1%, so it's more than covered the management fee and other administrative charges. As a result, IGC has never paid a dividend and doesn't look likely to do so in the near future. There is a deficit of just over 10 mils on the revenue reserve. Gearing. IGC can borrow up to 25% of net assets on a long-term basis, but it doesn't seem to have ever used any debt facilities. In recent years, there has typically been a net cash balance in the region of 5%, which seems sensible given the nature of its portfolio. Closing thoughts. Life was not easy for IGC in its early years, but its reinvention just over a decade ago can certainly be regarded as necessary and broadly successful. While its performance has been excellent in absolute terms since then, it's worth remembering that it has still lagged its benchmark a little, and, COVID aside, India hasn't endured any sort of bear market since the current manager took charge. As a single-country trust with a small and mid-cap focus, no doubt there will be bouts of extreme volatility at some points, as we saw happen in both 2008 and 2011. 2023 was the 8th successive year of positive stock market returns in India. That said, The near-term prospects for India continue to look promising on many fronts, although investors have to be prepared to pay up for the current rosy consensus. The manager highlighted his concerns about valuations in the latest interim statement, noting that it will be difficult to relocate the earnings growth of 20% per annum that has been seen over the last 3 years. The reduced majority that Prime Minister Modi achieved in the general election in mid-2024 may also slow the pace of pro-market reforms. The policy of regular redemptions at a small discount to NAV, coupled with buybacks, should provide some protection against the discount widening in the short term. It would be good to see some improved reporting of the Trust's key figures, and hopefully this is something that will happen soon with the greater resources available now that Ocean Dial is part of AssetCo. Pantheon International by Jonathan Davies. Pantheon International, PIN, was one of the first private equity trusts to be launched, raising £12 million in its IPO in 1987. It has produced an impressive annualised NAV return of 11.9% net of all fees over the last 37 years, which is 3.3% ahead of world equity markets. Today it has net assets of £2.3 billion. Originally adopting a fund of funds approach, it began co-investing several years ago, and together with single asset secondary investments, direct investments now make up just over half of its portfolio. Like most other private equity trusts, Pantheon International's discount to NAV widened 2 years ago and, while narrowing somewhat since, has still traded around 35% this year. Along with a number of other concerns, investors have raised questions about private equity valuations, and the Trust is now making a concerted effort to answer the doubters, attract new shareholders, and reduce the discount to more acceptable levels. A short history. Pantheon International was initially called GT Venture Investment Company when it was launched in September 1987, just a month before Black Monday and a year before Kohlberg Kravis Roberts launched its infamous $25 billion buyout of RJR Nabisco. Things started slowly. By mid-1988, Pantheon International had only made 6 investments and 85% of its assets were in a short-term gilt. However, the pace soon quickened, and it was nearly fully invested a year later. It was around this time that Pantheon Ventures, the Trust's management company, was created via a management buyout of the private equity division of GT Management. In 2010, Pantheon Ventures was acquired by Affiliated Managers Group, a New York-listed company valued at $6 billion. Pantheon currently manages a total of $67 billion, with around 500 staff spread across 13 offices. Most of its assets are private equity related, although it has branched out into infrastructure, listing Pantheon Infrastructure on the London market last year, and also into debt strategies. The Trust itself was renamed Pantheon International Participations in 1992, it's sometimes still referred to as PI-POL, and then the name was shortened to Pantheon International, PIN, in 2015. Pantheon International's long-term record of double-digits returns stands comparison with the best global public market equity funds. The annualised NAV return since inception, at 11.9% per annum, is comfortably ahead of both world and UK markets, and the share price return, although 1% per annum lower because of discount movements, has also been in double digits. See tables and charts in the free ebook, Pantheon International's long-term record, as reported in its 2023-24 annual report. Performance was particularly strong following the global financial crisis, apart from during that episode when the net asset value tumbled by around 30% in the year. Ended May 2009 and took 2 years to recover. The NAV has only fallen in one other year since the IPO, which was in 2002, NAV down 19%. Because of discount movements, the share price has naturally been more volatile, however. Investment style. Pantheon International says its aim is to maximise capital growth with a carefully managed risk profile. It makes unquoted investments by subscribing to new private equity funds, primaries, or acquiring direct holdings in unquoted companies, co-investments and single asset secondaries, where it invests in conjunction with a private equity manager on substantially the same terms. Although only a small part of Pantheon's global private equity business, the Trust effectively gets access to all the investment opportunities available to Pantheon, although what gets chosen is a product of its overarching strategy. It tends to invest in most approved co-investment opportunities that are presented to it, but mostly restricts new secondary investments to single asset single investment funds. Pantheon has access to scores of invitation-only primary funds across the globe, from which the Trust selects a subset of around 30 managers to invest with on a primary basis. This portfolio of funds gives it a wide range of diversified investments, which complement the co-investments and single asset secondary transactions. The full underlying portfolio, including direct investments as well as funds, has become more concentrated over time. About 80% of the portfolio consists of around 500 companies, managed by 70 different private equity firms with a bias towards the technology and healthcare sectors. The Trust had outstanding fund commitments of around £790 million, as at 31st May 2024, £22 million in net cash, £83 million drawn on its £500 million credit facility and £118 million of outstanding loan notes. Like other private equity investment trusts, Pantheon International will typically overcommit, which means that it will make commitments that exceed its currently available cash, on the basis that the necessary funds will become available from a combination of future distributions, borrowing, or fundraising. The mandate is global, and the trust aims to diversify by geography, sector, and investment stage, although no specific limits are set in this regard. Valuations of the underlying funds are usually received quarterly, with quoted positions valued at market prices at the end of each month. The underlying fund updates tend to become available on a rolling basis rather than at the same time. Pantheon International updates its own NAV figure on a monthly basis, listing out what percentage of its portfolio is valued at various dates. Pantheon doesn't use currency hedging, as it says both the timing and amount of any hedging required are very hard to forecast. Its underlying managers don't tend to hedge their funds either. It says around 75% of its portfolio is based in US dollars, so dollar strength tends to boost NAV and weakness is a drag. Pantheon has made a couple of important changes in recent years to its corporate structure and the way it invests. In 2013, it gradually started to invest more in co-investments, i.e., taking a direct stake in a business itself, whereas previously it had mostly invested via other private equity funds. Direct investments, meaning co-investments and manager-led secondaries, now account for 54% of Pantheon's portfolio, giving it more control and reducing the impact of additional fund fees. In 2017, it also tidied up its dual share structure in order to create a single share class. The discount challenge, having navigated the dot-com bubble and bust with relative ease. By June 2007, Pantheon International's net assets were over £600 million, and the share price was up 12-fold from launch. Then the financial crisis hit, and private equity trusts across the board got absolutely walloped. An experience that still, over a decade later, to some extent colours some investors' perceptions. Many of them had taken on too much debt, expecting the good times to continue indefinitely, and they were unable to fund their sizable fund commitments. Realizations dried up as well, cutting off another source of potential funding. Discounts across the sector soared, and some investors, fearing a repeat, have been wary of touching private equity trusts ever since. Using data from Pantheon International's annual reports, this chart shows the full history of the trust's year-end discount to NAV and its year-end commitments as a percentage of its net assets. See tables and charts in the free ebook, Pantheon International, Discounts and Commitment Ratio. Taking commitments first, it's interesting to see how little Pantheon International was required to stump up until the mid-1990s. That changed dramatically in the late 1990s, with the commitment ratio rising to in excess of 80% in the run-up to the financial crisis. That figure tumbled in 2010 and 2011 as Pantheon International sold some of its funds at a discount, together with the undrawn commitments attached to them, and took on very little in new commitments. Over the last decade, undrawn commitments have varied between 20% and 35% of NAV, which seems to be a lot more manageable. On average, Pantheon International says that between 20% and 30% of outstanding commitments at any one time have been called over the following 12 months, which translates into between 5% and 10% of NAV based on the commitment range seen in recent years. Pantheon International gets regular distributions as its underlying investments are sold. These amounts are variable and have swung between 10% and 35% of NAV over the last several years. The average annual distribution rate since 2012 has been 21%. The idea is that distributions should always be sufficient to cover the probable level of calls, and that remains the case. The valuation issue. A particular issue for the private equity sector for the past 3 years has been skepticism about the reliability of the published NAVs that are reported to shareholders. One factor is that there is inherently a time lag in reporting performance data, as the private equity funds in which listed private equity trusts invest only produce quarterly figures, which take time to produce. Although Pantheon International notes that valuations tend not to be written up aggressively when stock markets rise, the recent issue for analysts stems from the fact that while publicly listed stock markets fell sharply in 2021 to 2022 before recovering, the earnings multiples applied to most private equity valuations have barely budged, and at 17x remain high by historical standards. The comparable figure for 2019 to 2020 was 12.7x. With memories of what happened during the global financial crisis still lingering and debt costs rising, the share prices of nearly all private equity trusts were marked down heavily, with discounts widening right across the listed sector. In Pantheon International's case, the discount fell from its typical 15% to 30% range in the 2010s to more than 50% at its lowest point in 2022. The same trend was of course happening to discounts right across the investment trust universe, but it plumbed greater depth in private equity. The fact that there was no new demand for the shares even when they traded at half the reported NAV underlines the extent of the challenge that boards have faced in restoring confidence. Opinions have divided between those who still say that the NAVs are simply overstated and those who say that if the NAVs were actually correct, as the trusts insist is the case, It should be incumbent on the boards of the trusts to tackle the issue of the poor share price performance and show that they are aware of the loss of value that shareholders may have incurred as a result. Responding to the challenge. To its credit, Pantheon International has been in the vanguard of boards responding to the challenge. In March 2020, Helen Steers took over as the partner at Pantheon with responsibility for the trust. She replaced Andrew Liebus, who had carried out the role since 2002. Steers has been a partner at Pantheon since 2004 and has been closely involved with the trust since 2015. She has also chaired the British Private Equity and Venture Capital Association, BVCA. The appointment of Steers has resulted in Pantheon becoming a lot more active on the marketing front. She was joined as co-manager in June 2024 by a second co-manager, Charlotte Morris. Vicky Bradley, the investor relations and communications manager, has been involved in the trust since 2016. In October 2021, it started to buy back shares on investment grounds, and in 2021 split its shares on a 10-for-1 basis. The next year, following the appointment of John Singer as chairman, the board embarked on a three-pronged strategy to restore confidence amongst its shareholders and attempt to reduce the discount. The strategy had three components: an initial 200-metre share buyback programme, designed to invest in its own portfolio and allow a significant number of legacy shareholders who wanted to divest to do so. The mechanism of a 150-metre reverse auction tender was launched to find a strike price, which cleared at a price of 305p. Including the tender offer, PAP invested a total of 196.7 million in share buybacks during the financial year to 31 May 2024, and they added 4.7% to the NAV per share. The announcement of a capital allocation policy designed to establish parameters for the allocation of the company's cash flow between share buybacks, debt repayment, and reinvestment. The wider the discount under the new formula, the more cash will be committed to buybacks. The logic is that while new investments that add shareholder value can still be made, the potential returns need to be measured against the potentially higher return that existing shareholders will make by purchasing the trust's own shares when the discount is very wide. A renewed commitment to attract new investors, including private shareholders, with a mixture of measures that includes greater information and disclosure, an improved annual report and increased PR activity. This year the trust has also appointed a marketing consultancy to assist in this process. Restoring confidence. The initial £200 million share buyback programme had an immediate effect on the discount, bringing it back to around 35% by the end of 2023, but since then it has mostly tracked sideways. While the discounts of some other trusts have narrowed significantly, others, notably the pure fund of funds trusts, such as Harbourvest, have remained marooned below 40%. Clearly, therefore, as Mr. Singer has acknowledged, there is work to be done for the sector to restore confidence amongst shareholders, both as to the reliability of its reported numbers and the perception that lingers of boards of trusts not appearing to care about the persistence of those embarrassingly large discounts. It is important to show the shareholders that we on the board are putting their interests first, he says. In the past, we have mostly focused on the net asset value and growing that. The performance of the sector has actually been stunningly good on that basis, but because of the discounts, it hasn't been doing everything that the investors want. He wants to see boards take a more proactive approach to formulating and broadcasting their corporate strategy, explaining its capital allocation, use of leverage, and buybacks in more detail. We need a 5-year business plan for the trust, not just a plan for where and with whom we invest. Most of all, we have to try and build trust in what we are doing, and that it is all being done for the benefit of shareholders. We have to demonstrate and show people how strong our culture and our values are. Are the NAVs valid? On the issue of valuations, private equity trusts are sticking to their guns in saying that the NAVs they report are soundly based, despite an evident slowdown in the private equity cycle, and earnings multiples remaining higher than they have been for the past decade. They point out that realizations, though fewer in number, are still taking place at a significant margin above recent carrying values. In its latest reporting period covering the 2023-24 financial year, the average uplift for Pantheon International was 20%, which is healthy, though 10% below the 10-year average. The ratio of realizations to cost, at 3.2x, was actually a fraction above the 3.0x 10-year average. The underlying operational performance of the companies in the portfolios was also positive, with revenue and earnings, on an EBITDA basis, continuing to grow at double-digit rates on average, comfortably ahead of listed companies in the MSCI World Index. Nevertheless, it is clear that the slowdown in the global equity cycles has had an impact on the trust's performance in other ways. The average holding period of private equity portfolio companies has been increasing, with IPOs and M&A activity slowing to a level below recent historical experience. Private equity firms are seeing the net cash inflow from their portfolios decline as a result, cramping their ability to raise new funds, invest their existing capital, and reinvest in new opportunities. These trends are evident in Pantheon International's results. The latest annual report covering the year to 31st May 2024 shows that the industry's cyclical downturn has squeezed some of the Trust's key performance measures. The NAV per share return of 6.1% was some 5.8% below the average Pantheon International has achieved since it listed on the London market in 1987, albeit impacted by the strengthening of sterling during the period. Around 75% of Pantheon International's NAV is USD denominated. Net cash flow from the portfolio was £200 million down on 2 years ago and, at £37 million, the lowest net inflow for 10 years. As a result, cash on the balance sheet has fallen from £230 million to £22 million since the 2021 to 2022 year, and the Trust saw its debt exceed cash as a percentage of net assets for the first time in its 3 annual reporting periods. The undrawn coverage ratio, while down from 98%, remained healthy at 89%. Perhaps a more significant metric to be aware of, though, is the average valuation multiple. The multiple the Trust uses to illustrate this is the ratio between enterprise value and EBITDA. This has almost doubled in the last decade and remains high relative to its historical record. Pantheon International's sector mix, with its bias towards higher growth sectors, plays a large part in this, given that the portfolio has moved from the largest sector, being consumer 10 years ago, to the largest sector, being technology today. But the jump in the average multiple remains noticeable. These figures are produced on a sample of Pantheon International's portfolio using all the information it has available. It is based on a sample of around 50% of its holdings, according to its latest annual report. Pantheon International's multiple is at the high end compared to most other private equity trusts. Only HG and Apax appear to be higher, and both of these trusts also have a large weighting to technology. And it's also near the top when it comes to debt multiples at around 5 times EBITDA. These levels are, however, significantly lower than the debt multiples seen ahead of the global financial crisis. Assessing performance. Nevertheless, Helen Steers and Charlotte Morris, the 2 partners in Pantheon with lead responsibility for the investment trust, say that the portfolio performance has stood up reasonably well to the downturn in private equity activity. The biggest contributions to the NAV increase came from the impact of the share buyback program, which accounted for 4.7% of the 6.1% return, and from a valuation gain in the portfolio of 5.1% over the 12 months. These 2 positive impacts were offset by adverse currency movements, expenses and taxes. Encouragingly, however, the share price total return was higher at 19.9%, helped significantly by the narrowing of the discount in response to the share buybacks. As noted above, the average uplift over valuation of the portfolio company exits that were completed during the year was 20%, and the average ratio of realizations to cost was 3.2x, slightly ahead of the 10-year average. While only amounting to some 8% of net assets, the exits that were achieved, in other words, showed no evidence of overstated valuations, but brought in less cash than in previous years. The individual companies in the portfolio also performed well in aggregate, with average compound annualized growth rates of 14% for revenue and 17% for earnings before interest, tax and depreciation. These were respectively in line with, and slightly higher than, the comparable figures for publicly listed companies in the MSCI World Index, against which the Trust measures its performance. Steers and Morris also dismissed suggestions that the valuations of its holdings are being artificially inflated for reasons of self-interest, another charge you hear expressed. In Pantheon International's case, as the Trust covers the full range of private equity activity, from venture capital to mega buyouts, it is in a good position to review and compare valuations across the industry, and can adjust a manager's valuation where it is felt to be too aggressive, although there are no specific details on how often this has happened. By design, none of its employees sit on both the valuation and investment committees, so there is no inherent conflict of interest between them. In any event, they point out, there is no immediate financial incentive for the underlying funds to overvalue their investments, as their annual management fees are either paid on commitments or invested cost, not on current valuations. Performance fees are only paid on cash generated upon realization and are subject to whole fund hurdles. Portfolio breakdown. There's plenty of information on Pantheon International's portfolio in its annual reports, which are well laid out and comprehensive. The sector mix shows a heavy bias towards technology and healthcare, which collectively account for half the portfolio. The US accounts for half the portfolio as well, but the geographic mix is not that dissimilar from global equity indices. There is also a bias towards growth and small and mid-cap buyouts, but relatively little in the riskier venture capital market. There is wide diversification across the 70 private equity managers that Pantheon International invests with. Insight Partners is the largest at 7.1% of NAV, followed by Index Ventures at 3.6%, but there are only 9 managers in total that account for 2.0% or more. At the individual company level, the largest position is 1.2% of NAV, with the top 50 companies accounting for 26%. Directors, shareholders, and managers. Pantheon International currently has 6 directors, all of whom are considered independent. The directors collectively own 4.6 million shares, worth some 12.5 million, up from 9 million 2 years ago. 4 of the non-executive directors increased their shareholdings between the 2022-23 and 2023-24 financial years. John Singer says the board has adopted a policy of appointing more non-executive directors with extensive private equity experience. Charges. Pantheon International's charges are consistent with private equity norms. The basic fee is 1.5% on the first £150 million of investment assets and 1% above that level. There is also a commitment fee of 0.5% at the current level of commitments that adds another 0.15% of NAV in annual charges. What the managers say now. Recent industry surveys, says Helen Steers, support the idea that deal value in private equity is picking up from the lows of the previous year, particularly in Europe. You are actually starting to see it in the numbers that the research analysts are reporting, so we are starting to feel that the recovery is real. The build-up of dry powder is mostly in the largest private equity funds, she adds, which are traditionally more cyclical than the small and middle market companies, which account for the majority of Pantheon International's global portfolio. Nevertheless, the timing is very difficult to put your finger on. Will the new deals come first, or the exits? I honestly don't know. Charlotte Morris agrees. It is extremely difficult to time your entry and exit into private equity. It should be a long-term holding, not something that you trade. But the fundamental drivers haven't changed. The number of listed companies in public markets continue to shrink, the private companies in our portfolio continue to grow more quickly than public companies, and there are certain sectors which you just can't find in public markets and therefore offer greater diversification potential. You have also got the alignment of interest between the investors and the managers, who have the control or influence to effect change, which coming out of a more difficult economic environment is particularly valuable, and that is before you take account of the discounts in the sector. When your shares are sitting on a 35% discount to NAV, and you have faith in that NAV, as we do, the discount feels abnormal. Outlook and summary. Pantheon International has had the odd hiccup along the way and suffered along with its peers from the fallout from the global financial crisis, but it has clearly proved its worth over its more than 3 decades as a listed vehicle. Over its life, an 11.9% annualized NAV return, net of fees with just 2 down years, is impressive, even though some other trusts in the sector have produced higher total return numbers. It is worth remembering that 3/4 of its portfolio is denominated in dollars, though as this can have a significant short-term impact on its NAV. The trust only accounts for between 3% and 4% of Pantheon's total assets, but it has been its public face for 37 years, so as a shop window for the wider group, it's clearly in Pantheon's interest for it to continue to do well and be responsibly managed. The trust is making positive moves to address its discount with more marketing and buybacks and a clear statement of its capital allocation policy. Experience suggests that it will take time for a re-rating to occur, and macroeconomic conditions will play a part, as they always do. If the valuations are indeed justified, then should a re-rating occur, or the private equity cycle turn the corner, shareholders will be well placed to benefit from the double whammy effect of an increased NAV and the narrower discount. Trust data and analysis. Trust basics. For first-time investors in trusts, here is an overview of investment trusts, what they are and how they invest, from editor Jonathan Davies. What is an investment trust? Investment trusts, also known as investment companies, are a type of collective investment fund. All types of fund pool the money of a large number of different investors and delegate the investment of their pooled assets, typically to a professional fund manager. The idea is that this enables shareholders in the trust to spread their risks and benefit from the professional skills and economies of scale available to an investment management firm. Funds are able to buy and sell investments without paying tax on realized gains. Collective funds have been a simple and popular way for individual investors to invest their savings for many years, and investment trusts have shared in that success. Today, more than £250 billion of savers' assets are invested in investment trusts. The first investment trust was launched as long ago as 1868, so they have a long history. Sales of open-ended funds, unit trusts, OEICs and UCITs funds, have grown faster, but investment trust performance has generally been superior. How do they differ from unit trusts and open-ended funds? There are several differences. The most important ones are that shares in investment companies are traded on a stock exchange and are overseen by an independent board of directors, like any other listed company. Shareholders have the right to vote at annual general meetings, AGMs, on a range of things, including the election of directors, changes in investment policy and share issuance. Trusts can also, unlike most open-ended funds, borrow money in order to enhance returns. Whereas the number of units in a unit trust rises and falls from day to day in response to supply and demand, an investment trust is able to deploy permanent capital. What are discounts? Because shares in investment trusts are traded on a stock exchange, the share price will fluctuate from day to day in response to supply and demand. Sometimes the shares will change hands for less than the net asset value per share of the company. At other times they will change hands for more than the NAV per share. The difference between the share price and the NAV per share is calculated as a percentage of the NAV, and is called a discount if the share price is below the equivalent NAV, and a premium if it is above the NAV. What is gearing? In investment, gearing refers to the ability of an investor to borrow money in an attempt to enhance the returns that flow from his or her investment decisions. If investments rise more rapidly than the cost of the borrowing, this has the effect of producing higher returns. The reverse is also true, meaning that gains and losses are magnified. Investment trusts typically borrow around 5 to 10% of their assets, although this figure varies widely from one trust to another. What are the main advantages of investing in an investment trust? Because the capital is largely fixed, the managers of an investment trust can buy and sell the trust's investments whenever they need, rather than having to buy and sell simply because money is flowing in or out of the fund as unit trust managers are required to do. The ability to gear or use borrowed money can also potentially produce better returns. The fact that the board of an investment trust is directly accountable to the shareholders is important. So too is the ability of boards to smooth the payment of dividend income by putting aside surplus revenue as reserves. Because their capital base is permanent, investment companies are free to invest in a much wider range of investments than other types of fund. In fact, they can invest in almost anything. Although many of the largest trusts invest in listed stocks and bonds, the biggest growth in recent years has been in a range of more specialist areas such as renewable energy, infrastructure, debt securities, music royalties, and private equity. Investment trusts offer fund investors a broader choice and greater scope for diversification, in other words. And what are the disadvantages? The two main disadvantages are share price volatility and potential loss of liquidity. Because investment trusts can trade at a discount to the value of their assets, an investor who sells at the wrong moment may not receive the full asset value for their shares at that point. The day-to-day value of the investment will also fluctuate more than an equivalent open-ended fund. In the case of more specialist trusts, it may not always be possible to buy or sell shares in a trust at a good price because of a lack of liquidity in the market. Investors need to make sure they understand these features before investing. How many trusts are there? According to the industry trade body, the Association of Investment Companies, there were just over 380 investment trusts with more than £260 billion in assets, as at the end of August 2022. They are split between a number of different sectors, reflecting the regions or type of investments in which they invest. Scottish Mortgage, the largest trust, has approximately £14 billion in assets. What are alternative assets? While investment trusts have traditionally invested primarily in publicly listed stocks and shares, whose values are known every day, the last decade has seen significant growth in so-called alternative assets. These are trusts which invest in longer-term assets which are mostly not traded daily, and therefore can be valued only at less frequent intervals. Examples include commercial property, renewable energy, infrastructure, and private equity. Many of these alternative trusts are popular because of their ability to pay higher levels of income. How are they regulated? All investment companies are regulated by the Financial Conduct Authority. So too are the managers the board appoints to manage the trust's investments. Investment trusts are also subject to the listing rules of the stock exchange on which they are listed. The board of directors is accountable to shareholders and regulators for the performance of the trust and the appointment of the manager, and are legally bound by the requirements of successive Companies Acts. How do I invest in an investment trust? There are a number of different ways. You can buy them directly through a stockbroker or via an online platform. A few larger investment trusts also have monthly savings schemes where you can transfer a fixed sum every month to the company, which then invested into its shares on your behalf. If you have a financial advisor or a portfolio manager, they can arrange the investment for you. What do investment trusts cost? As with any share, investors in investment trusts will need to pay brokerage commission when buying or selling shares in an investment trust, and also stamp duty on purchases. The managers appointed by the trust's directors to make its investments charge an annual management fee which is paid automatically, together with dealing and administration costs, out of the trust's assets. These management fees typically range from as little as 0.3% to 2.0% or more of the trust's assets. What are tax wrappers? Tax wrappers are schemes which allow individual investors, if they comply with the rules set by the government, to avoid tax on part or all of their investments. The two most important tax wrappers are the Individual Savings Account, HISA, and the Self-Invested Personal Pension, SIPP. The majority of investment trusts can be held in an ISA or SIPP. There are annual limits on the amounts that can be invested each year, currently $20,000 for an ISA. Venture capital trusts, VCTs, are a specialist type of investment trust which also have a number of tax advantages, reflecting their higher risk. VCTs invest in startup and early-stage businesses. Who owns investment trusts? 25 years ago, life insurance companies were the biggest investors in investment trusts, which they used to manage their client funds and pensions. These days, such institutional investors mostly manage their own investments directly. Other than some specialist types of trust, the largest investors in trusts today are wealth management firms, formerly stockbroking firms, other types of intermediary, and increasingly private investors. The growing number of individual investors reflects the growing influence of online platforms, which give individual investors the ability to choose their own investments for ISAs, SEPs, and taxable share fund accounts. Are they as difficult to understand as some people say? Investment trusts are a little more complex than a simple open-ended fund, but no more difficult to understand than most types of listed company. It is important to understand the concept of discounts and premiums before you start to invest, but buying, selling, and following the fortunes of your investment could not be easier. If you like the idea of making the connoisseur's choice when investing, you will find the effort of understanding investment trusts worthwhile. Key terms explained. Investment trusts, aka investment companies, pool the money of individual and professional investors and invest it for them in order to generate capital gains, dividend income, or both. These are the most important factors that determine how good an investment they are. Share price. The price, typically in pence, you will be asked to pay to buy or sell shares in any investment company. Your interest is to see it go up, not down. Spread. The difference between the price per share to pay if you want to buy and that you will be offered if you wish to sell can be anything from 0% good to 5% or more bad. The bigger the trust, the tighter the spread should be. Market capitalization. The aggregate current value of all the shares a trust has issued, in essence therefore what the market in its wisdom thinks the investment company is worth today. The market is not always wise and would be a duller and less interesting place if it were. Net asset value, NAV. The value of the company's investments less running costs at the most recent valuation point. Typically, and ideally, that will be yesterday's quoted market price, but for some types of investment trust, whose assets are not traded on a daily basis, it might be 1 or more months ago. Net asset value per share. This is calculated not surprisingly by dividing the NAV, see above, by the number of shares in issue. You can compare it directly with the share price to find the discount or premium. Discount/premium. When the share price is below the investment company's net asset value per share, it is said to be trading at a discount. If it trades above the NAV per share, then the trust is selling at a premium. Dividend yield. How much a trust pays out as income each year to its shareholders, expressed as a percentage of its share price. The usual figure quoted is based on the dividends a company has paid in the previous 12 months. Over time, you hope to see the dividend increasing at least in line with inflation. Dividend hero. A catchy term invented by the industry trade body to describe trusts which have increased their dividend every year for more than 20 consecutive years. See the data section for a full list. The fund manager. The person, or team, responsible for choosing and managing the investment trust's capital, will typically be professionally qualified and highly paid. How much value he or she really adds is a lively source of debate. The board. Investment companies are listed companies, so they must comply with stock exchange rules and appoint a board of independent directors who are legally responsible for overseeing the company and protecting the interests of its shareholders, which ultimately means replacing the manager or closing down the trust if results are not good. Gearing, a fancy word for borrowing money in order to try and boost the performance of a company's shares, a case of more risk for potentially more reward. A number of different types of borrowing, e.g. with fixed or variable interest rates, can be used. Fees and charges. What it costs to own shares in an investment trust, a figure that, confusingly, can be calculated in several different ways. More important than it sounds on first hearing. OCR. Short for ongoing charge ratio, one of the most commonly used formulas used to measure the annual cost of owning a trust. Expressed as a percentage of the NAV's sectors. Investment trusts come in many shapes and sizes, so for convenience are categorized into one of a number of different sectors based on the kind of things that they invest in. Performance, a popular and overused term which tells you how much money an investment trust has made for its shareholders over any given period of time. By definition, a backward-looking measurement. It does not guarantee future performance will be as good. Benchmark, the outcome against which a trust and its shareholders have agreed to measure its performance. This is typically a stock market index relevant to the area or style in which the portfolio is being invested, e.g. the FTSE All-Share Index for trusts investing in UK equity markets. Total return, a way of combining the income a trust pays with the capital gains it also generates, you hope, over time, so as to allow fair comparisons with other trusts and funds, shown either as a simple percentage gain over the period or as an annualized gain. The compound rate of return per annum. Risk and return. Riskier investments tend to produce higher returns over time, typically at the cost of doing less well when market conditions are unfavourable and better when they are more helpful. Risk comes in many disguises, however, some more visible than others. Beta. This is a term used in financial economics to measure the extent to which the shares of a company rise or fall relative to the stock market as a whole. The stock market has a beta of 1.0, so if the market rises 10%, then a trust with a beta of 1.2 is expected to rise by 12%, 10.2, If it falls by 10%, the shares should fall by 12%. Alpha. A statistical measure of the additional returns that a trust has made after adjusting for the relative risk of its portfolio. It is often used, not entirely accurately, as shorthand for fund manager skill. Active management. What is going on when the investment manager of a trust makes a conscious decision not to include in its portfolio all the stocks or shares that make up its benchmark index? The latter can be easily and much more cheaply replicated by a computer, what is known as passive management. All investment trusts are actively managed. Investment style. An attempt to characterize the way in which the manager of a trust chooses to invest. One common distinction is between value and growth. The former style aims to find companies whose shares are cheap relative to their competitors or historic price. The latter concentrates on finding companies with above-average sales and profit growth prospects. Is there any difference between an investment company and investment trust? Basically no. Strictly speaking, investment trusts are investment companies, but not all investment companies are investment trusts. Feel free to use either term interchangeably without fear of embarrassment. Closed-end funds. Investment trusts are an example of what is called a closed-end fund, meaning that its capital base is intended to be fixed and permanent, unlike unit trusts, OEICs and horribly named UCITs 3 funds, which take in and return money to investors on a daily basis and are therefore called open-ended. The distinction is no longer quite as important as it was, as it has become somewhat easier for successful investment companies to raise new money through regular share issues. Keep up to date. Why not join Jonathan Davies and his professional guests for the Free Moneymakers Investment Trust podcast, where they discuss the latest news from the financial markets and the investment trust sector. The podcast earned Jonathan the Best Broadcast Journalist Award in the 2024 AIC Media Awards. Go to www.moneymakers.co to sign up. To continue or not to continue? In our latest article aimed at private shareholders, Joe Winkley, head of investment trusts at Winterflood Securities, explains how continuation votes work and why they drive change in the investment trust sector. Continuation votes. Investment trusts are sometimes referred to as permanent capital or evergreen vehicles. The implication is that, like most listed companies, investment trusts have an indefinite lifespan. Looking at the enduring longevity of a number of trusts, with histories stretching back well over 100 years, it is easy to conclude that these companies will continue to exist for as long as they have capital to invest. However, this does not tell the whole story. While investment trusts are closed-ended in nature and do not have to fund daily redemptions in the manner of open-ended funds, the reality is that they are owned and controlled by their shareholders, and their ongoing existence is either tacitly or explicitly subject to maintaining shareholder support. This is often codified through the use of periodic continuation votes. A continuation vote provides shareholders with the ability to decide whether an investment trust should continue in its current form or not. There is a predetermined threshold of support, typically 50% of those voting, which is required for an investment trust to continue. What are the different types of continuation votes? A significant proportion of investment trusts have regular, periodic continuation votes. Now, these can be structured in a number of different ways. Continuation votes that occur on a repeating schedule, usually by means of a resolution proposed at a company's annual general meeting. This is the most common approach, although the frequency of a continuation vote varies from trust to trust and can take place annually, every 3 years, every 5 years, or on any recurring timescale that shareholders agree. Continuation votes that are triggered by specific events or performance hurdles. For example, a vote could be triggered by the company's NAV underperforming a benchmark index, or by a persistently wide discount to NAV over a period of time. One-off continuation votes. These can occur at moments when the board of an investment trust wishes to confirm shareholder support for the company. They are often linked to specific events such as a change in investment mandate or the appointment of a new investment manager. Continuation votes can be embedded in an investment trust's articles of association, or can simply be introduced as a board commitment. What is the difference between a continuation vote and a discontinuation vote? Most continuation votes are structured as resolutions in which shareholders have to vote actively in favour of the continuation of a company. However, there are some resolutions that are structured as discontinuation votes, whereby shareholders have to vote to discontinue a company if they are not happy with the status quo. While the effect of both votes is ostensibly the same, namely to ascertain that there is sufficient shareholder support for a company to continue, there is a slight nuance in the assumptions behind each vote. In the case of continuation votes, the assumption is that a company will not continue unless a majority of those shareholders voting vote for continuation. While in the case of a discontinuation vote, the assumption is that a company will continue as usual unless the requisite majority of those shareholders who vote decide otherwise. Some have argued that, for the reasons above, discontinuation votes offer a slight advantage to a company, with continuation being the de facto outcome unless shareholders vote to deviate from this. Skeptics have seen this as a cunning ploy to ensure that continuation is easier to achieve with a discontinuation vote. However, the main reason for the use of discontinuation votes is nowhere near as nefarious as this. Discontinuation votes are most commonly found in investment companies that are domiciled offshore, typically in Guernsey and Jersey, where they are used to ensure that the companies do not fall foul of the offshore funds rules. Without getting into the details, there is a risk that if a company's default state is not to continue unless shareholders vote otherwise, a continuation vote, it may potentially be subject to adverse tax treatment. The easiest way to mitigate this risk is to switch a company's default position to continuing unless shareholders elect otherwise, a discontinuation vote. What are the normal thresholds for continuation votes? Most continuation votes are put forward as ordinary resolutions, which require more than 50% of the shareholders who vote to support the resolutions. However, some votes, typically discontinuation votes, are structured as special resolutions requiring 75% of those voting to support discontinuation. However, these thresholds are a function of the normal voting requirements for ordinary and special resolutions, and we do not believe there is anything in UK company law that specifies the level of voting required for a continuation or discontinuation vote. As such, a company could, in theory, determine its own threshold. How common are continuation votes? Are they becoming more common over time? Continuation votes are very common for investment trusts, and while it feels that they have become more entrenched as a market norm over the last few years, it is interesting that the data does not really support this view. It appears that continuation votes have been an important part of the investment trust sector for some time now. According to data from the Association of Investment Companies, there are currently 143 investment trusts, excluding VCTs, that have some kind of periodic continuation vote. This compares with 121 investment trusts that had some kind of continuation vote 10 years ago. How many continuation votes have failed recently? Strangely enough, it is quite rare for a continuation vote to fail. This is not because shareholders are prepared to support investment trusts under all circumstances, but because the potential for a continuation vote to fail, for example because of poor performance, is usually flagged to a board by larger, typically institutional shareholders sometime ahead of the vote itself. This can provide a board with the opportunity to set out or put forward alternative proposals to shareholders ahead of a continuation vote, and even potentially to withdraw the vote before it occurs. There are also cases where continuation or discontinuation votes have been passed under direction from a board of directors. As an example, the board of GCP Asset-Backed Income Fund Limited announced earlier this year that it had concluded, following extensive shareholder consultation as part of its strategic review, that an orderly realisation and return of capital were in shareholders' best interests. As such, a discontinuation resolution was proposed at the company's May AGM, which was followed by an EGM on the same day seeking approval for policy changes to affect the realisation of the company. The only continuation vote that has failed in the last 12 months was the September 2024 vote for JP Morgan Global Core Real Assets Limited. This continuation vote was an ordinary resolution that saw 66% of those shareholders who voted vote against continuation. The company has since announced that following the failed vote it will consult its shareholders and, in accordance with its articles of incorporation, put forward proposals for the reconstruction, reorganisation, or winding up of the company within 6 months of the AGM, an outcome that would be considered typical in the event of a failed continuation vote. See tables and charts in the free ebook. Selected continuation votes from the past year. What happens afterwards? Most failed continuation votes do not lead to the automatic liquidation of a company. Instead, the approach of JP Morgan Global Core Real Assets is fairly usual, where a failed continuation vote, or a successful discontinuation vote, typically requires a board to put forward alternative proposals to shareholders within a specified timeframe. Such proposals will normally include a restructuring of the company whereby shareholders are offered a number of options in respect of their shareholding, almost always including the ability to elect to receive cash, potentially over time in the case of a company holding illiquid assets which may not be immediately realisable. Often this option will be offered alongside another option to roll over their investment into shares or units of another investment trust or OEIC. The rollover option is designed to allow investors who may have held the shares for a long time to avoid crystallising potentially taxable capital gains. Summary. In theory, there is no need for continuation votes. Investment trusts, like all listed companies, are subject to shareholder democracy. At any point in time, a majority of shareholders in an investment trust could, in theory, put forward resolutions to reconstruct the company. However, this would require a proactive and coordinated approach on the part of the shareholder base, and while such actions are not unheard of, they are far from common in the sector. A continuation vote is an easier route to canvass ongoing shareholder support and provides the opportunity for investors to consider and, if necessary, challenge the status quo. While continuation votes very rarely fail, they are often used as a catalyst for investors to demand changes and for boards to undertake comprehensive shareholder consultations to assess whether an investment trust remains fit for purpose in its current form. While the concept of a continuation vote may undermine the notion of permanent capital, it does provide a helpful, and arguably healthy, dynamic whereby boards and managers can never be complacent, and the ongoing existence of a company is explicitly subject to periodic shareholder support. The contrast with open-ended funds, where the decision to close a poorly performing fund has in practice historically been almost entirely down to the fund manager, is marked. Joe Winkley is head of investment trusts at Winterflood Securities. Sponsors. We are grateful to our sponsors for helping to distribute copies of the Investment Trusts Handbook to the widest possible audience, and they are required to remind you that the value of investments and the income from them can go down as well as up, and investors may not get back the amounts originally invested. Please remember also that past performance is not a reliable guide to future performance. Aberdeen Investment Trusts. If you're keen to capture the potential offered by global investment markets, turn to Aberdeen Investment Trusts. Managed by teams of experts, each trust is designed to bring together the most compelling opportunities we can find to target the investment growth or income you're looking for. Aberdeen is a global investment company that helps clients and customers plan, save and invest for the future. Our purpose is to enable our clients to be better investors. We manage and administer £506 billion of assets for clients as at 30th June 2024, and our strategy is to deliver client-led growth. We are structured around three businesses, investments, advisor and interactive investor, focused on the changing needs of our clients. The capabilities in our investments business are built on the strength of our insight, generated from wide-ranging research, worldwide investment expertise, and local market knowledge. Our advisor business provides financial planning solutions and technology for UK financial advisors, enabling them to create value for their businesses and their clients. Interactive Investor, the UK's second-largest direct-to-consumer investment platform, enables individuals in the UK to plan, save, and invest in the way that works for them. For more information and to sign up for updates on the range of investment trusts managed by Aberdeen, please visit aberdeen.com/trusts. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Allianz Global Investors. About Allianz Global Investors. Allianz Global Investors is a leading active asset manager managing €555 billion in assets for individuals, families, and institutions worldwide. By being active and investing for the long term, our goal is to elevate the investment experience for our clients and generate value every step of the way. Allianz Global Investors and its predecessors have been managing investment trusts since 1889, providing investors with access to investment opportunities around the world. Each trust is a company listed and traded on the London Stock Exchange that has its own independent board of directors, whose duty it is to look after your interests as an investor. Established in 1889, the Merchants Trust plc has, throughout its history, provided shareholders with an opportunity to benefit from investment in a diversified portfolio of leading companies with strong balance sheets and the potential to pay attractive dividends. Merchants aims to provide its investors with an efficient, competitive and cost-effective way to achieve an above-average level of income and income growth, together with long-term capital growth through a policy of investing mainly in higher-yielding large UK companies. The Brunner Investment Trust plc aims to provide growth in capital and dividends over the long term by seeking out the world's most exciting growth opportunities. We believe that it's the quality of the company that matters, not its location. So through Brunner, investors can access a spread of high-quality growth companies operating in different sectors and countries in a single portfolio. The trust favours large, well-financed businesses with global reach, pricing power and brand strength. Allianz Technology Trust invests in a diversified but focused portfolio of companies that use technology in an innovative way to gain a competitive advantage. Particular emphasis is placed on companies that are addressing major growth trends with innovation that replaces existing technology, or radically changes products and services and the way in which they are supplied to customers. The manager aims to invest in the most attractive technology shares globally, seeking to identify the leading companies in emerging technology growth subsectors. Investing involves risk. Past performance does not predict future returns. For further information about our trusts, please go to uk.allianzgi.com/investment-trusts. Allianz Global Investors UK Limited is authorised and regulated by the Financial Conduct Authority. AGT, AVI, Global Trust. AGT, nearly 4 decades of fundamental investing. AVI Global Trust, AGT, provides expertly managed exposure to the opportunities presented in various parts of the world. The investment objective is to achieve capital growth through a focused portfolio of global equities trading at discounts to their sum of the parts. The investment strategy identifies valuation anomalies to create a concentrated yet diversified portfolio of stocks where there are real catalysts and events for change, including the investment manager's activism. How we achieve our investment objective? We invest into a concentrated portfolio of stocks. We follow our distinctive fundamental value investment style. We seek out good quality, neglected securities trading at a discount to their net asset value, NAV. We improve shareholder value through active engagement. We build a contrarian benchmark agnostic unconstrained portfolio. We provide diversification due to the nature of our holdings. Our robust investment philosophy guides investment decisions. Emphasis is placed on three factors: companies with attractive assets, where there is potential for growth in value, or some of the parts discount to a fair net asset value, and identifiable catalysts for value realization. A concentrated high-conviction core portfolio of circa 30 plus or minus investments allows for detailed research which forms the cornerstone of our approach. AVI took over the investment management of AGT in 1985. The experience gained from nearly 4 decades of following our unique investment style is key to our in-depth understanding of our universe of opportunities in a constantly changing environment. AGT's long-term track record bears witness to the success of this approach, with a NAV total return well in excess of its benchmark. We believe this strategy remains as appealing as ever, and we continue to find plenty of exciting opportunities. For more information, visit www.aviglobal.co.uk. Baillie Gifford, Independent Global Investment Managers. Baillie Gifford is privately and wholly owned by its partners. This is the crucial underpinning of our approach. We have no short-term commercial imperatives and no outside shareholders to distract us. We can simply do what's right for clients, and that's what has sustained our business since 1908. We are one of the largest managers of investment trusts in the UK with a range of 13 trusts. We have an extensive range of OEIC sub-funds and manage investments globally for pension funds, institutions and charities. Some see the collective failure of active management as an argument to embrace passive. We see it as an opportunity to redefine our original purpose of deploying clients' capital into tangible, returns-generating activities. And we believe that redefinition is actual investment. Actual investment is not easy in our world of 24-hour news, where complexity and noise is confused with rational judgment. It requires the resolve to focus only on what really matters, to think independently, and to maintain a long-term perspective. It requires a willingness to be different, to accept uncertainty and the possibility of being wrong. Most of all, it requires a rejection of the now conventional wisdom that has led our industry astray. Investment management is not about processing power, trading and speed. It is about imagination and creativity, and working constructively on behalf of our clients with inspiring individuals and companies who have greater ideas than our own. The best investment ideas spring from thinking about future possibilities, not short-term probabilities. Our research covers the globe, and we set no barriers to the imagination of our investors, encouraging fresh perspectives and the use of diverse sources of information. We believe our approach to investing not only best delivers good outcomes for clients, but it also helps to develop great companies that provide for the needs and wants of people, thereby benefiting society as a whole. Investing responsibly for the long term is not counter to outperforming for clients, it's intrinsic to it. The value of a stock market investment and any income from it can fall as well as rise, and investors may not get back the amount invested. Your capital is at risk. Baillie Gifford and Company Limited is authorised and regulated by the Financial Conduct Authority. Columbia Threadneedle Investments. Columbia Threadneedle Investments is one of the leading investment trust managers, tracing its heritage back to 1868 when F&C Investment Trust, the world's oldest collective investment scheme, was launched. Today, Columbia Threadneedle manages 8 investment trusts with over £9 billion in assets, providing clients with a range of investment opportunities across equities, property and private equity. Each trust is tailored to offer clients different aims and objectives with the option of capital growth, income, or a combination of both, offered through portfolios with specific regional focuses or global remits. Clients can invest directly into Columbia Threadneedle's suite of investment trusts, via its own savings plan, or through a third-party provider. Columbia Threadneedle's investment trust business is part of its global asset management business, which is entrusted with £501 billion on behalf of individual, institutional, and corporate clients around the world. Footnote 6. Source: Ameriprise Financial. Q3 2024 earnings release. The business employs more than 2,500 people, including approximately 650 investment professionals based in North America, Europe, and Asia. Footnote 7. As at 30 September 2024, Columbia Threadneedle Investments. As well as investment trusts, Columbia Threadneedle offers clients a wide range of strategies across equities, fixed income, and alternatives, as well as specialist responsible investment capabilities and a comprehensive suite of solutions. Columbia Threadneedle Investments is the global asset management group of Ameriprise Financial, a leading US-based financial services provider. As part of Ameriprise, it is supported by a large and well-capitalized diversified financial services firm. Your capital is at risk. See tables and charts in the free ebook. Fidelity International. About Fidelity International. Fidelity International provides world-class investment solutions and retirement expertise to institutions, individuals, and their advisors to help our clients build better futures for themselves and generations to come. As a private company, we think generationally and invest for the long term, Helping clients to save for retirement and other long-term investing objectives has been at the core of our business for over 50 years. We are responsible for total client assets of £682.1 billion from over 2.84 million clients across the UK, continental Europe and Asia Pacific. Footnote 8. Source for all data, FIL International, 30 June 2024. Our UK investment trust business, Fidelity, has over 30 years' experience managing investment companies and manages over £5 billion in assets across 6 investment trusts. These are all focused on equity growth strategies. As a major platform distributor, Fidelity is able to offer its own investment trusts, and those managed by third parties, to professional investors and retail investors alike through a range of different product wrappers. Fidelity also promotes its range of trusts directly to institutions and wealth managers through its highly experienced in-house sales teams. We offer our own investment solutions and access to those of others, and deliver services relating to investing. For individual investors and their advisors, we provide guidance to help them invest in a simple and cost-effective way. For institutions including pension funds, banks and insurance companies, we offer tailored investment solutions and full-service asset management outsourcing. And for employers, we provide workplace pension administration services on top, or independently, of investment management. Invesco. About Invesco. Invesco is a leading independent global investment management firm with more than 8,000 dedicated people in over 26 countries. Our philosophy is about using our integrity, passion and expertise to solve the needs of our clients, helping them reach their goals. We manage $1.8 trillion of assets, offering investors a wide range of single-country, regional and global capabilities across major equity, fixed income and alternative asset classes, and including a diverse range of investment trusts. Investment Trusts by Invesco. We're completely focused on finding investment opportunities that others might have missed. We do this through meticulous research backed by decades of experience. We believe our long-term approach to seeking out the strongest returns could help investors make the most of the growth and income potential from financial markets. Our diverse range of investment trusts provide choice for income or growth investors alike. For more information on our investment trust range, please visit our website www.invesco.com/uk/n/investmenttrusts.html. Investment risks. The value of investments and any income will fluctuate. This may partly be the result of exchange rate fluctuations, and investors may not get back the full amount invested. Important information. As at 30 September 2024, unless otherwise stated, assets under management shown in USD issued by Invesco Fund Managers, Limited, Perpetual Park Drive, Henley-on-Thames, Oxfordshire, RG 91HH, UK. Authorised and regulated by the Financial Conduct Authority. Janus Henderson Investors. Who we are. Whatever your financial goals, a Janus Henderson Investment Trust invests for your future actively, expertly and diligently. Whether you're looking for growth or a steady income, our range of trusts aims for competitive returns across a diverse selection of global investments. Janus Henderson Investors has a long history of managing investment trusts. In fact, the first trust we managed was launched in 1936. Since then, we have diligently guided our trusts through booms and busts, always focused on the long-term outcomes for you, the investor. And, while our 11 investment trusts are companies in their own right, they are able to use the resources of a global asset manager. That means over 340 investment experts located around the world and deep research capabilities based on years of active investing experience. £285.9 billion in assets, 340 plus investment professionals, 24 offices globally, 2,000 plus employees. Why us? 1. A clear aim. Whether aiming for income, growth or both, our investment trust managers are focused on delivering consistent, reliable, long-term returns for our investors. 2. Experts, aligned to investors' interests. With decades of experience managing investment trusts, Janus Henderson Investors understands how to make the most of the investment trust structure to deliver value for investors. And as shareholders themselves, our managers are aligned with their investors' interests. 3. Deep foundations. Our investment trusts form part of a global investing business that counts £285.9 billion in assets under management. With over 2,000 expert employees located around the world, our investment trusts have deep resources to use for the benefit of investors. 4th, investment capabilities. Our 11 trusts primarily focus on equity investing, with individual goals focused on income, growth or both. The trusts make the most of Janus Henderson Investors' global reach, investing in a wide range of markets. 5. Income. We offer income-oriented trusts focused on UK, Asian, European, US and global equities. Drawing on the expertise of multiple teams, including sector specialists in healthcare and technology, our managers aim to deliver dependable, consistent income for their investors. At the same time, most of our income trusts also aim for some capital growth. 6. Capital growth. While we are well known for trusts that generate income, several of our selection are focused on growth. Our range includes options that invest in large or small companies, and trusts focused on UK, European and global investing. Our managers emphasise producing investment growth for shareholders over the long term. Important information: all sources are correct as of September 2024. This is a marketing communication, not for onward distribution, not for distribution in European Union member countries, issued in the UK by Janus Henderson Investors. Janus Henderson is a trademark of Janus Henderson Group plc or one of its subsidiaries. Copyright Janus Henderson Group plc. JP Morgan Asset Management. Introducing JP Morgan Asset Management Investment Trusts. As one of the UK's leading investment trust providers, we combine our global strength as a leading asset manager with local expertise to offer you a variety of investment trust options from which to build or supplement your portfolio. We focus on a team-based approach which combines disciplined processes with a breadth and depth of expertise covering every key asset class and market. Within this clearly defined structure, our teams are encouraged to develop and test groundbreaking ideas to widen our clients' investment opportunities. Our global scale and reach means you are accessing the expertise of a worldwide network of investment professionals. Our deeply resourced teams are able to take a research-driven approach, analysing every detail to uncover opportunities and risks, and help our clients build the strongest possible portfolios. With more than 150 years of investment experience behind us, you are tapping into proven success in investing across asset classes and regions through multiple market cycles. Our trusts are a well-established element of our investment solutions, with the age of some of our key trusts offering ample evidence of their power to deliver over the long term. Our wide range of trusts enables you to use variety to your advantage. Whether you are looking for income, growth, or a combination of the two, you will be able to find the right building blocks to create a robust portfolio. At the same time, options covering every global region, along with a range of asset classes and company size, allow you to diversify easily and effectively. Pantheon International plc. About Pantheon. Pantheon has been at the forefront of private markets investing for more than 40 years, earning a reputation for providing innovative solutions covering the full life cycle of investments, from primary fund commitments to co-investments and secondary purchases across private equity, real assets and private credit. We have partnered with more than 650 clients, including institutional investors of all sizes, as well as a growing number of private wealth advisors and investors, with approximately $67 billion in discretionary assets under management as at 31st March 2024. Using creative approaches informed by our specialised experience and delivered by a global team of professionals based in offices across Europe, the Americas and Asia, we invest with purpose and lead with expertise to help build secure financial futures. Key facts: more than 40 years of investing experience in private markets, $67 billion plus in discretionary assets under management. Footnote 9, as at 31st March 2024, $80 billion plus committed to investments since inception in 1982. Serving 650 plus clients, including both institutional investors and private wealth clients. 12 global offices across 3 continents. Global workforce includes more than 130 investment professionals. Pantheon's investment prowess is underpinned by deep relationships with hundreds of high-quality fund managers across all of our asset classes. Having invested in around 3,000 funds and with approximately 650 advisory board seats held. Across our platform, we leverage our network to provide access to differentiated and often proprietary investment opportunities, with a focus on partnering with best-in-class specialist managers in segments benefiting from strong structural tailwinds. Pantheon has actively managed 2 London Stock Exchange-listed investment companies, Pantheon International plc (PIP) and Pantheon Infrastructure plc (PINT), since they were launched in 1987 and 2021 respectively. About Pantheon International plc. Pantheon International plc (PIP), ticker code PIN, is a FTSE 250 investment trust that invests in a diversified portfolio of private equity assets managed by third-party managers across the world. An investment in PIP gives shareholders access to the growing private equity market, effectively making investment opportunities in private companies available to the public. PP is one of the longest established private equity companies listed on the London Stock Exchange, and its net asset value, NAV, has outperformed the FTSE All-Share and MSCI World indices since its inception in 1987, with annualized growth, net of fees, of approximately 12%. Footnote 10, as at 30 September 2024, assumes reinvestment of dividends, capital repayments and cash flows from the exercise of warrants. Past performance is not a guide to future performance, and a loss of principal may occur. PIP performance may be affected by changes in exchange rates, as well as investment performance. India Capital Growth Fund, River UK Microcap. The River Global Group was formed by bringing together River Global investors formerly known as River and Mercantile Asset Management, SVM Asset Management, and Saracen Fund Managers to create an investment company better able to serve financial advisors, wealth managers, institutions and their clients. The subsequent acquisition of Ocean Dial Asset Management, investment manager of the India Capital Growth Fund, further strengthened its capabilities. Specialising in long-only equities, the group offers a diverse range of UK, European, Indian and global strategies, all focused on delivering long-term investment returns. The company is committed to active stewardship, rigorously challenging its investments to ensure they provide genuine value for clients and effectively manage sustainability-related risks. River UK Microcap invests in a diversified portfolio of UK microcap companies, utilising the closed-end structure to invest in less liquid stocks, with a market cap of less than £100 million. The investment manager implemented a fundamental and value-disciplined approach that has compounded excellent long-term relative returns to investors through multiple cycles. Small by design, River UK Microcap has a unique redemption facility that enables the company to maintain an optimal size for the asset class being managed. India Capital Growth Fund seeks to provide long-term capital appreciation by investing in listed mid- and small-cap Indian stocks, but also has the flexibility to invest in unquoted Indian companies where the portfolio manager believes long-term capital appreciation will be achieved. The closed-end structure enables the investment team to target smaller, less well-known, and less researched companies. Although this approach can result in greater volatility compared to large-cap peers, it also presents more opportunities for mispriced investments and access to ideas that are not feasible for larger fund houses. These opportunities are often identified ahead of competitors and allocated on more favourable terms. River Global Investors LLP is the investment manager for River UK Microcap Fund and is authorised and regulated by the Financial Conduct Authority, FCA registration number 453087. Ocean Dial Asset Management Limited is the manager of India Capital Growth Fund and is authorised and regulated by the Financial Conduct Authority, FCA registration number 447424. This information does not constitute investment advice. The value of investments may go down as well as up. Past performance is not a guide to future performance. Schroders, about us. As a global asset and wealth manager, Schroders delivers a broad range of investments designed to meet the diverse needs of individuals, intermediaries and institutions. For over 200 years we have built principled partnerships with our clients, putting them at the centre of everything we do. They trust us to deliver through times of economic prosperity and of uncertainty. We are a global business managed locally. Our international presence supports us in understanding the needs of our clients and delivering them the right expertise from across the business. As an active investment manager, we believe that we have an important role to play in driving better outcomes for our clients and society as a whole. We bring together people and data to identify the trends that will shape the prosperity of individuals, businesses and future generations. Schroders Investment Trusts. Schroders has been managing investment trusts since 1924 and has established a strong reputation. Our specialist teams draw on Schroders' extensive investment resources, combining global insights with local market knowledge. We offer a range of investment trusts, with clearly defined investment strategies, helping investors to meet their financial objectives. Scan the QR code to sign up to receive our investment trust insights, QR code available in the free ebook. Acknowledgements. Producing the Investment Trusts Handbook 2025 is, as it has been for the last 8 years, an intensive and collective effort, thanks to all of those who have helped to bring it to fruition, whether as contributors or handmaidens to the production process. At Harriman House, Miles Hunt, Sally Tickner, Nick Fletcher, Tracy Bundy, Victoria Lawson-McKittrick, Christopher Parker and Charlotte Smith. Thank you also to Chris Wilde. From our sponsors, Louise Bouverat, Aberdeen, Oliver Largo, Alliance Global Investors, Lucy Draper, Asset Co, Kimberly Lau, Asset Value Investors, Vicky Toshney, Bailey Gifford, Rob Austin, Manish Chavda and Marianne Clark, Grace Columbia Threadneedle, Claire Dwyer and Dominic Newman, Fidelity, Will Ellis, Francis Elster and Stephen Smith, Invesco, Kerry Haxby-Dean and Sital Keshwala, JP Morgan, Vicky Bradley, Pantheon, Sunil Clare and Lisa Ferris, Schroders. Contributors: John Barron, Alan Briley, James Carthew, Ben Conway, Richard Curling, Alex Davies, Simon Edelston, Simon Elliott, Hugh Gimber, Nick Greenwood, Peter Hewitt, Alistair Laying, Anthony Leatham, Ewan Lovett-Turner, Andrew Mchattie, Sachin Saggar, Lucy Walker, Stuart Watson and Joe Winkley. Interviewees: Nitin Bajaj, Rhys Davies, Joe Bauernfreund, George Ensor, Paul Niven, Sue Noffke, Stephen Paice, Nish Patel. Research: Ewan Lovett-Turner, Deutsche Numis, Richard Pavry, Devon Equity Management, Christopher Brown, JP Morgan Cazenove, William Heathcote Amory, Kepler Intelligence, Anthony Leatham, Peel Hunt, Ed Martin and James Carthew, Quoted Data, Sachin Saggar and Ian Scowler, Stifel, Emma Bird, and Joe Winkley, Winterflood Securities. Statistics. Big thanks again this year to David Michael and Sophie Driscoll at the AIC for all their help in providing the performance statistics and a lot of other data. Thank you for listening to this audio production. The Investment Trusts Handbook 2025, Investing Essentials, Expert Insights and Powerful Trends and Data, edited by Jonathan Davies, read by Gareth, Authorised Voice Replica, published by Harriman House, text copyright Harriman House 2024, recording copyright Harriman House 2024. The right of the authors to be identified as the authors has been asserted in accordance with the Copyright, Design and Patents Act 1988. All rights reserved. Whilst every effort has been made to ensure that information in this book is accurate, no liability can be accepted for any loss incurred in any way whatsoever by any person relying solely on the information contained herein. No responsibility for loss occasioned to any person or corporate body acting or refraining to act as a result of reading material in this book can be accepted by the publisher, by the editor, by the authors, or by the employers of the authors. The views, information, or opinions expressed by the authors are solely those of the individuals involved and do not necessarily represent those of Harriman House or the editor.